state.
Big tech leaders Mark Zuckerberg and Jack Dorsey will face a grilling on Capitol Hill later, amid accusations from the Republicans that Facebook and Twitter censor conservative content. Senators are angry that several of President Trump's posts claiming voter fraud were labeled false or misleading in the wake of the election. Zuckerberg and Dorsey will be questioned by the Senate Judiciary Committee.
The strongest storm of a violent 2020 season has hit Central America, bringing destructive winds and torrential rain. Hurricane Iota has crossed the coast along the Honduras-Nicaragua border 2 weeks after Hurricane Eta killed at least 100 people. Iota is a Category 5 storm with sustained winds of 250 kilometers per hour and may bring a storm surge of 6 meters. That's 20 feet.
And Sydney has put on a show to help Qantas celebrate its 100th birthday during some of the toughest times it's ever seen. The city's famous Harbour Bridge was lit up like a birthday cake with a 787 Dreamliner blowing out the candle as it flew around 1,500 feet above. The carrier's event team was given a budget of $0 for the day. Not surprising, as most of the Qantas fleet remains grounded. And those are your first word headlines. Well, US and Asian stocks are records after Moderna's vaccine was shown to deliver a 94.5% effectiveness during the large late-stage trials. CEO Stefan Bancel told us that's what sets his vaccine apart.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
President-elect Joe Biden says containing the pandemic is key to the USA recovery, calling for cooperation between business and government in his first remarks on the economy since being elected. Meanwhile, ECB chief economist Philip Lane has also weighed in, and he says the central bank will provide enough stimulus at its next meeting to make sure governments, companies, and households have enough access to credit, cheap credit specifically. Joining us now is Evan Lucas. He's the chief market strategist at InvestSmart. Thanks for coming on the program. I look at the reaction in the bond market, which was quite muted in terms of U.S. Treasuries, and compare that with what we're seeing in stocks. Kind of struggle to really buy into this narrative that it's all hands on deck in terms of risk on and in terms of some of those value stocks.
Yeah, it's an interesting point, Yusuf, and good morning to both you and Marnus. I think there might actually be something that we've seen over the last 3 or 4 years between the differentiation between equities and bonds. Bonds have always, in the last couple of years, been very responsive to the here and now, and they are very much at the start of 2019. We're looking at the risks of the global slowdown. This year, they obviously picked up on the coronavirus very, very quickly. You could also argue that they're ahead of the curve with regards to how they look at from an equity point of view. And my argument and why I say that is that at the moment, your question realistically boils down, is the vaccine the most important thing to the market, or is it the number of cases that are starting to really explode, particularly in Europe and the US? And that's probably the way to look at this as well, is that if you go under market theory, equities are obviously pricing in 12 months ahead. It's clear from, not just coming from Moderna and Pfizer, that there won't just be 2. There could be as much as 10 different vaccines by this time next year. The probability that we will actually get towards some form of herd immunity through inoculation is also quite high. So is the equity market pricing that in over what the bond market is doing? Maybe. I'm actually a little bit more pessimistic. I am thinking what the bond market is telling me is something to be aware of. Clearly, confidence is going to be hit by the amount of cases in Europe and the US. Lockdowns have started, and they're probably going to get longer than currently forecasted. You'd also point out confidence goes to consumption. And leading into what is normally in the Northern Hemisphere, particularly in the Western world, a fairly large festive period where consumption is high, all of that comes down to it. So there is a chance of having a short-term shock in equities, in my view. The longer-term view in terms of 12 months and out, I agree the economic expansion story is there. Post-COVID, with a vaccine, there will be growth. Central banks are clearly going to be there. And what's different between the GFC and this time around is that governments most of them now, rather than a selective few, are actually also going to support their domestic economies with stimulus that we haven't seen. So that, I think, might explain the disconnect.
Evan, you've packed probably every macro theme into one answer, so well done. Let's break it down a little bit. The bond market, you say, is looking at the news from California, from Michigan, and the 7-day average. That's what the bond market's trading on. The dollar, Stephen Englander, I want to get your opinion on this. Citigroup are saying the dollar could drop by 20%. They've got all the vaccine narrative. That catalyses a leg lower in the dollar. But Steve Englander at Standard Chartered said the body blow could be an intra-Fed move on QE. How do you see the risk of an intra-Fed move by the Fed lumping up on QE?
Okay, and that also will probably bring about another big macro argument as well, Marnus, in terms of how you answer that question, because if they do the intra move, it wouldn't be unjustified, in my view, in terms of what they're doing. They do have a huge balance sheet capacity. They have been threatening to move on expanding QE significantly. And, it only took them 3 months to do what they took 3 years to do in the GFC this year. So they are willing, they are able. Again, what they've been trying to do, though, is trying to knock on the head that yield that you're talking about, trying to get it down towards probably more about 50 bips, even some are arguing as low as 25 bips in terms of the flattening out of that curve. That would require a lot of input to do that. The other part of that argument that's also very hard, and you can't not explain about this as well, is that the input of that amount of money will clearly push the dollar down initially. But if you look at that from the point of view that fiscal stimulus under a Biden-elect presidency, with the policies that he's likely to enact, the future economic growth in the US and what it will come with it, along with what we're talking about with the Fed being right in behind it, that's actually a positive in terms of what you see there. And you could therefore see the dollar pop up. You could therefore see that attraction coming back across the Atlantic, across the Pacific, of that international investment dollar that's clearly flowing into the US at the moment, would counteract what we're talking about.
Evan, let's get to a key quote that got my attention from some commentary from the Fed's Richard Clarida. He says that I've got more conviction in my baseline for next year, and even more conviction that the recovery from the pandemic shock in the U.S. can potentially be much more rapid than it was from the global financial crisis. Fiscal policy was so successful that this was the only downturn in my professional career in which disposable income actually went up in a deep recession, and a lot of that has been saved. How do you position for that kind of eventuality, that kind of scenario?
Yeah, and that's a beautiful question, because what this year has been is that this has been the fastest bull market and bear market in history. It's like nothing we've ever seen. The response also is different, because this isn't a financially generated decline. This is a government-imposed sanctions across their own domestic economies to safeguard them. Again, if you can sort of, and it's very hard to do this, I understand that, but if you can sort of look through what COVID has been and look at what was probably going to be 2020 ex-COVID, there was not what you would call explosive growth, but reasonable growth across the world. People were relatively happy and, moving in a wealth sort of creation basis. And I think there's a lot of, again, feeling, and what they describe in most markets is this animal spirits of getting back there quickly. Employment return has been incredible. If you look at economic bounce back, it's been incredible. Confidence bounce back has been incredible, because this isn't like anything we've seen from an economic standpoint. This has been a health crisis that has been imposed upon the population, and government response has been like nothing we've ever seen either. And as those government responses come off, the snapback feels more like what we were probably likely to have experienced in 2020 if COVID didn't happen. So I agree with that. I can feel that growth will come from a very low base, because we know what's happened this year, and the snapback will be stronger than we've ever seen it. And the US GDP numbers in Q2 and Q3 already highlight that. Their biggest fall on record, and also, one of their largest growth on record, over 30%. So that is why 2021 will be an incredible year, again, like anything we haven't seen, because of what this year has been. This year has been something that hasn't happened for over 100 years. Economically, we've never seen something that's actually been imposed globally from government to basically try and safeguard the global population from a health crisis.
OK, Evan, I think we can walk away with a word from that narrative. Go long. Evan Lucas stays with Yusuf and myself. Much more to come here on Daybreak Middle East. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
China's vice president is calling for a shift away from protectionism as Beijing grapples with the prospects of a new U.S. administration. That, as the likes of the former Secretary of State Henry Kissinger warns fraying relations could turn into a crisis on a scale of World War I. He spoke at the Bloomberg New Economy Forum along with other world and business leaders.
A competitive approach to China was inevitable, but keeping it healthy and not pernicious is vitally important, and that won't be easy.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
But what I do believe both sides are capable of through the highest level diplomacy at an early stage of the Biden administration is to define the parameters.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
The American administration is about to change, but the clock will not simply be rewound.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
Unfortunately, some forces are acting against the trend of the times. They have trumpeted the decoupling and willfully walked away from international commitments, posing challenges to multilateralism.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
A fairly substantial lineup there at the New Economy Forum, the voices and their views on China. I'm drawn to Kissinger, the former U.S. Secretary of State, warning Mr. Biden the U.S.-China catastrophe on a scale of World War I. Now, do you think that in this new administration needs to do something fast and substantive and, as it were, put a huge stake in the ground that China-U.S. relations are renavigating early, very early in the administration?
I think it'll be one of his main things to sort of start with, Marnus. What I would also point out, though, is that Biden has form on China. He has clearly pointed out that he will not necessarily take the line that the Obama administration took with regards to China, and was almost agnostic to how they sort of dealt with the Chinese over that period of time. There has been also a big movement since the changing from Hu Jintao over to Xi Jinping is also probably part of that change with China. He does need to go and meet with the Chinese pretty rapidly. The current deals that the current administration has taken on with President Trump is probably hurting all of above. The retaliation, the nationalism, as your forum is describing it, has certainly not done the kind of response that I think the president himself wanted, which was to see the amount of US manufactured goods increase, the trade deals with China come back to a more neutral level. All those things saw them being targeted with regards to particularly things like agriculture. It's also interesting to sort of listen to somebody like Prime Minister Lee and with the Southeast Asian sort of network and what they've experienced under this sort of scenario is that with the Chinese having to focus on the US, Asia and Southeast Asia in particular have certainly been left languishing and have had to deal with a fairly angry China that has certainly had to move away from dealing trade-wise with Southeast Asia towards the US. And they would be hoping very much so that there's a realignment as well.
Evan, in terms of asset allocation, I look at equities in China and CSI's price-to-earnings ratio is about 19. Topix is about 29, and you're looking at an S&P 500 PE ratio of about 28. So the highest level versus China in Bloomberg data going back as much as 15 years. Are you still a little bit cautious then, given the geopolitical tensions with the U.S., or do you go in?
Yeah, look, it's interesting you ask that because the other way to look at it, Yusuf, is if you look at the A50, for instance, it's powering ahead in terms of that space. I think the Asian story is there. I mean, you've also got to remember is that China was the first to have coronavirus, but it's also the first one that's probably able to get its economy back. We saw that it was actually expanding in Q2 in terms of where it's at. And we know that the Chinese do things incredibly well internally with getting themselves out of economic situations. They stimulate well. They have projects ready to go. You've seen that with their absolute thirst for particularly things like bulk commodities. So for where I live in Australia at the moment, we actually saw June, July and August as record outputs. June the record, July 2nd, August 3rd for iron ore. And the output for also things like coal and copper into China are at some levels that we haven't seen since basically the peak in China in 2013. It is clear they're stimulating. It is clear that they are building and bringing infrastructure spend ahead. So there will come a point where the CSI 300 particularly picks that up. You're also starting to see, Shanghai starting to pick that up again. But I would highlight, as I said, the A50 is the interesting one there. It has been doing significantly better than its Asian counterparts, probably not necessarily including Japan. But that's where I look at it, is that China's response has been there. It's probably been enacted now for almost 6.5 months. And again, it's ahead of the curve because they've got on top of the coronavirus and they are stimulating their way out of their problem.
Evan, thanks for coming on the program and sharing some of those ideas. It's Evan Lucas. He's the Chief Market Strategist at InvestSmart. All right, let's get now to the developments from this part of the world because we have the UAE Central Bank. They're extending the term of a loan payment deferral program. That's a pillar of the country's efforts to try and stave off the economic downturn that's been caused by the coronavirus. Simone Foxman has been watching the latest on the impact. She joins us from Doha. Simone, what exactly did the central bank say here?
Yeah, well, this loan deferral program, this is a $50 billion zero rate facility that was being extended from the central bank to banks, and they were intended to lend to small, medium-sized enterprises. Initially, these folks were going to have to pay this money back by January. Now they're going to get to June 2021. Look, this is not a surprising move. We've seen governments around the region turn to these sorts of loan deferral programs as their first way of extending stimulus measures. Even the central bank itself had really revised down its projections for UAE's growth to negative 5.2% back in September. And then we saw some really lackluster data coming in from Dubai earlier this month. Dubai likely to be most affected because small and medium-sized enterprises are the most important part of that Emirates economy. In specific, PMI data came in pretty weak there. We did have in the last hour a note out from our Bloomberg intelligence analyst Edmund Christo, and he said in fact that 10% of these deferred loans are considered at risk, and so in fact by deferring this loan repayment schedule, that might weigh on some of the UAE banks' recovery. So that's a place to watch as we go into the trading day today.
Now, Simone, we got a little bit of a peek into the Saudi Sovereign Wealth Fund, the PIF, in terms of some of their holdings, their U.S. stock holdings at the end of the third quarter. This is all about 13F. What was the narrative that we take away? That was the global splurge, wasn't it, earlier in the year?
Yeah, and we've seen a reversal of that narrative. Saudi's PIF selling off some of its stakes, particularly in U.S.-listed ETFs, real estate, chemicals, getting the axe there. But the Sovereign Wealth Fund doesn't have a lot of positions in the United States, and we're getting just a real glimpse into the portfolio, but taking down its overall holdings from $10 billion to $7 billion over the course of the quarter. Now, the thing to look at here is how much money the PIF is bringing back to invest in the local Saudi economy. Next year's expenditures going to amount to about 10% of GDP. This is more than the previous 2 years of investment from PIF combined. That the key focus as the country struggles to pull its way out of this twin impacts of oil price declines and coronavirus.
Simone, you've also been carefully tracking some of the latest developments on the Gulf Rift. Yusuf Al-Otaiba, an established name, of course, on the Gulf political scene. He's the UAE's ambassador to the United States and appeared to throw cold water on hopes for a swift resolution. What did he say?
He did. He said resolving the Gulf Rift is not on the top of anyone's priority list. But I'm going to throw a little cold water on him. I think what we've been hearing from our sources is that there is a lot of activity on this front. We've seen the Trump administration try and put pressure on the GCC countries to come to some sort of resolution in the past few months. But what we've seen since the U.S. election is that it's clear that Qatar has a little bit better of a bargaining position than it had before. The country, my sources tell me, going to be less likely to accept sort of a baseline deal. Notably, in fact, two other officials that have a lot of importance in the space were speaking at the same time as Mr. Yusuf Al-Otaiba. Robert O'Brien, he's the national security advisor in the U.S., say the Trump administration is definitely pushing forward with attempts to resolve this, would very much like to see some kind of marginal movement forward. Also, the Qatari foreign minister saying that he just wants to negotiate with other countries in good faith, in some way dissing perhaps the UAE and Saudi, implying that they are not yet on that page. Yusuf Manis.
Simone, thank you so much. Simone Foxman there. The Qatar Financial Centre in Doha, tracking the regional stories for us from there. Let's take a quick snapshot of US equities. We're just pausing for breath because the reality about what is happening on an average in the pandemic is really beginning to bite. Over the past 7 days, the numbers have jumped by 37%. S&P 500 down by 0.4%. Axis say we are transitioning from a defensive bull market to a more cyclically offensive market. Well, that's debatable this morning. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Daybreak, but Lisa, our top stories this morning.
Asian markets touch the brakes on the global rally, despite U.S. stocks hitting new highs after Moderna's encouraging vaccine results.
Optimism about a shot is being balanced by rising cases across the globe. Infections are climbing in every U.S. state, and Sweden is introducing its toughest restrictions yet.
Beijing calls for global cooperation and a shift away from protectionism in the next U.S. administration. We hear from China's vice president at the Bloomberg New Economy Forum.
And the United Arab Emirates will extend a key component of its coronavirus relief package. That's the loan payment deferral. That's going to happen through June next year.
So they are pricing the curve at Aramco right the way across. We've got the data crossing the Bloomberg terminal right now. It is on the strip. So you have 10-year bonds are going to pay 175 basis points above treasuries, above the benchmark. On 30-year paper, over 2%, 205 basis points over, and all the way out. Would you borrow money? Would you lend money to a major oil company 50 years forward for 230 basis points? Of course, last year, this company raised $12 billion. It was $100 billion oversubscribed when we covered it last year. This is a bond market, really, which is very, very strong. So, or the appetite, I should say, was very, very strong. Let's get to the rest of the markets. Jules is standing by in Singapore. Juliet, take it away. So, tapping the brakes, pausing for thought, on reflection. What's your phrase?
Yeah, well, we are still seeing Asian stocks, I guess, hold on to these records, Manus, but certainly we are seeing these overbought signals flashing through and a lot of these multi-year or record highs, perhaps a reason for investors to take a little bit of pause, but certainly that rotation trade is happening here in Asia. You can see those stay-at-home stocks on the Hang Seng Tech Index falling while the Bloomberg Airlines Index is up 2%, actually highest level there since February. Just putting in the Australian close there too, because of course yesterday trade was halted due to that outage, but back in action today in Sydney. Having a look, though, at my chart that really does start to show what Manus was alluding to there, that we've seen this big run-up coming through in stocks here in Asia. But when you look at the RSI for the 14 days, that might be my next chart. But we did have another chart I wanted to show as well that was just basically showing that what we were talking about, Yusuf, in terms of some of these moves here with the MSCI Asia Pacific Index showing that it is showing some signs of overbought signals as this rally continues.
Jules, in terms of some of the specific winners and losers here, I mean, the rotation trade is very much on. You're looking at some of the bullish calls when it comes to Chinese big cap shares.
Yeah, let's get back to that chart because we were speaking last hour, of course, about Morgan Stanley upgrading some of the airlines in China as we start to see some positive momentum coming through on the vaccine optimism. But analysts also turning bullish on the CSI 300 as a whole. Recommendations for this index as a buy, hitting the highest level since June 2012. This as we continue to see China's economic recovery continue. Now, we have seen this come as China continues to be one of the best performing equity markets in the world. That red line there pointing to the fact that you could see it get back towards those 2008 highs, which is a call that Morgan Stanley already had. The CSI 300 up nearly 20% year to date, Yusuf.
All right, thank you very much. That's Juliet Sally there with some of the details of the market action in Asia. Let's get more now on the news that the United Arab Emirates will extend a key component of its coronavirus relief package. That's the loan payment deferrals all the way through to June 2021. And that comes as news of another potential vaccine breakthrough has sparked an initial recovery in some of your key sectors of local stock markets. Let's get out to Jaap Meijer. He's, of course, the head of research at Arkham Capital. So, Jaap, you've undergone a portfolio rotation. You've made some big adjustments. This latest news, does that kind of confirm the direction that you are now headed towards?
Yeah, definitely. So obviously the extension of the central bank facility providing zero-cost funding for borrowers is helpful. On top of that, obviously the relaxation of the immigration laws, or the golden visas are now going to be handed out to a large part of the population are interesting. And on top of that, you have the UAE family laws being reformed in a dramatic way. Yeah, and obviously the Moderna news yesterday is obviously very positive. Even though you could see some profit taking now in Asia, I think the trading, let's say the rotation into value stocks, or let's say reopening stocks, better wording of that is ongoing, and I think has further legs. So what we did is we included the airline stocks, Air Arabia, in the portfolio because the one thing that stands out for this company is it has very limited short-term losses at the moment. And there's no risk of a dilution, as you can see with the global airlines. So I think it's a very attractive one, and our target price still obviously with 30% upside. Second one is a gym operator, Lijiang. Already they're benefiting from selective reopening at the moment. Obviously, that's a very nice growth story as well. Sierra, as a direct play on tourism, is obviously benefiting as well. And next to that, also in Egypt, we had Orascom Development, which benefits from tourism in Al Gouna. So we added that name as well. But the big one is Emaar. I think there's no single stock this cheap in our universe. And in fact, the latest data on the real estate market shows a lot more strength than we had ever expected by the beginning of the year. So I think particularly Emaar is a very attractive stock at this juncture. And finally, the other stock we added was Emirates NBD, because it's one of the best positions for rate hikes if those are being brought forward if we were to have a stronger recovery as a result of these vaccines.
I think there's a round table somewhere in the DIFC of everybody at lunch going, buy Emaar.
Have you been missing out on those?
I think maybe I've been missing out. Yeah, maybe you've been at that lunch table. So that's part of the dramatic overhaul, as you call it, of your MENA core portfolio. The breaking news we've had in the past couple of minutes that Yusuf and I are tracking is the Aramco bond issuance. This time, sort of January, February of last year, they put $12 billion. They raised $12 billion with $100 billion of over demand, bid to cover ratio of $100 billion. Here we are. For 10-year bonds, they're paying 175 basis points over. Is Aramco now a more risky bet than the sovereign? What do you make of that kind of pricing?
No, I think I see it as an extension of the sovereign. I see it very much as the same credit risk as the sovereign. And also, obviously, the shareholders have let's say investors have the option to buy the shares that gives you a 3.9% dividend yield for 5 years. Paid out on a quarterly basis. So that's the alternative. We think it's a little bit light in terms of credit spreads, but I still think it compares favorable to, for example, what TAQA, the Abu Dhabi entity, is offering with a yield which is sub 2%, also paid on a quarterly basis. So we don't like that yield on the, let's say, we call it the Aramco share. It's more like a preferred share rather than a real share, given the, let's say, the underpin to the dividends. And then obviously the 50-year bonds are obviously a reflection of what's the underlying strength of the sovereign. I think the sovereign itself is pretty robust. I mean the net assets are still highly positive. If you include PIF, the FX reserves are still very substantial. Yeah. Even though the debt to GDP is going to reach 34%, I think net positive. They're still positive. And then the fiscal austerity, they have the capacity to do the fiscal austerity on a very gradual way. Right. If you look at the Q3 numbers, the VAT raised quite a lot of money, about 8% of GDP. So a lot of things have already happened, so that's why I'm pretty comfortable with the sovereign
Sure.
of Saudi.
Yep. If I can just jump in here and just get to your view on crude oil, because we had, of course, the OPEC Plus deliberations, and the signals are becoming more and more stronger that they're going to push out any change in policy by about 3 to 6 months. Is that going to be enough to keep oil prices sort of where they are? Or is the real game changer going to be this vaccine and how it gets rolled out globally?
Yeah, obviously, the vaccine will help buoy the demand picture next year, I think. But obviously, they've scaled back the demand forecast again over the last month, I think 0.2 million barrels a day. So they are recognizing that demand picture doesn't look that great. So obviously, they will have to extend this. Gradually, it will have to unwind them into the new year. It has to be very gradual, and you have to keep a very close eye on the demand picture as economies recover. So I think they will definitely try to target at least oil prices at these levels. I think that's obviously no one can really afford Brent at below $40 a barrel.
Yep. Thank you so much. That's Siap Ma, Head of Research over at Arkham Capital. Thank you for joining us both this morning. Much more to come here on Daybreak Middle East. This is Bloomberg. Mazen Holdings has reported a 12% rise in the 9-month profits. It came in just over 10 million dinars. It's a Kuwaiti-based company leading the manufacturing and distribution of food and healthcare and consumer products in the region. Joining us now is the CEO, Gary Walsh. Gary, great to have you with us this morning. We're eating a lot, we're drinking a lot. You can have the healthy stuff, you can have the unhealthy stuff. But talk to me about where you're seeing signs of improvement. I look at the UAE in the 9 months. It absolutely fell off a cliff. So did Qatar. Kuwait remained robust. Where are the signs of the quickest and fastest recovery for you?
Sure. Well, I mean, so far, Kuwait has really done well. There's no doubt. It's nearly operated as a defensive bubble and really done well in terms of managing the whole process around COVID. But we are really heartened to see the UAE come back so fast. We really saw a real fall off through Q2 and a dramatic recovery through Q3. So, we have contracts with many of the key food service outlets in UAE. Most of them would be running at about 80% of their pre-COVID levels. So, very encouraging to see that coming back so quick. Obviously, the on-premise in UAE is still struggling. Naturally, there are less tourists, so there is less on-premise activity. But again, we're heartened to see that back running at about 50% of where it was pre-COVID. And within Qatar, bizarrely, we're actually seeing very strong growth through Q3 in our consumer business. So really,
I was going to follow up on that, Gary, if I can. on the outlook, because you are, of course, in control of the distribution of a lot of very famous brands. So everything from Dettol all the way to St. Pellegrino. Is a double-digit growth rate sustainable, or is this just a result of the initial bounce back in this recovery?
I think, look, in the longer term, absolutely. I think we're a very well-positioned business. We're broadly defensive. We're in sectors that continue to grow. We've been very fortunate to partner with people like Beyond Meat for the region, coming into new sectors. And obviously, we'll announce some more news around that over the next couple of weeks in terms of new activities. So very pleased to see that growth coming. Next year would worry me. Not worry me in terms of the numbers going backwards, but that the rate of growth might be a bit slower next year as we see some population drain in the UAE and in Kuwait, potentially in Qatar and Saudi as well. However, we're well positioned to take advantage of everything that's there. And then as we come out of that, we hope to go back to the historic rates that we've seen before. And that would be broadly reflected in the projections we've seen from our partner businesses as well.
I mean, you say you're worried about the expat exodus. Is that evident to you? And if so, where is it most manifest?
Well, if you take for us particularly, in Kuwait, for example, it's largely irrelevant. The wealth in Kuwait, the bulk of the purchasing is by the Kuwaitis. So even if the expat population does drop, it's not going to affect our business. We should still be able to make good progress. Within the UAE, I think we've all seen a drop in our business. I mean, however, longer term, the UAE is very well positioned. So we'd expect to see that come back, particularly as we go into Expo 2020 at the end of next year. And as the vaccine comes out and we start having more travel opportunities. But I think, for at the moment where we're probably seeing that population hit is here in the UAE. And then probably in Saudi, the impact of VAT and the increase in July has only now started to work its way out of the supply chain. And we're still seeing good growth there now as we go through the fourth quarter.
Gary, I mean, you have quite a bit of breathing room in terms of your balance sheet. One would think that this could be a chance to try and leverage that and go through inorganic growth. So try and take over some other companies, maybe merge with others. Are you in any active discussion, or would you rule that out at this stage?
Oh, we would never rule that out. I mean, if you look at the last 7, 8, 9 years, our growth has been really a mix of organic and inorganic. We spent $84 million acquiring a medicine business in Kuwait last year, Kuwait's only actual manufacturer of medicines. So we would never turn our back on an inorganic opportunity. At the moment, our debt to EBITDA is back down to 2.4, where it had risen to a historical high post that acquisition of 4.5. So yes, I think we, like everybody else, would be actively on the lookout for the right bolt-on acquisitions. I don't think we'd be looking at anything game-changing at the moment, but if we could find the right bolt-on opportunity, we'd be more than happy to execute that.
You can't throw Joseph and I a bone like that and not expect a follow-up. So we've got the classic bolt-on PR-driven response. Let's dig into that. Do you want to build out on the food, or is it more important to you to build out on the pharma? Come on, you cannot throw us that and not evolve the story.
That's fair. Look, we don't look at it as food or pharma. We very, very focused on, we are a consumer-led business. So what we, as a listed company, offer people is a window into the consumer in the GCC effectively. So where we're looking at acquisitions, we will look at anything that is consumer-led, whether it's food or pharma. For us, it's consumer-led. We're obviously more skewed towards manufacturing. That has been our drive over the last few years. That's what we got out of the acquisitions last year, was another manufacturing facility. But really, we're ambivalent on food or pharma as long as it's consumer-led and we believe it's positioned for growth.
Gary, thank you very much for running us through some of those highlights. It's Gary Walsh. He's the Mazen Holding CEO there. And we look forward, of course, to touching base again soon. Again, U.S. equity futures at the moment just ticking a little bit lower. We'll get back to the market action and plenty more. This is Bloomberg.
We're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail, right? We've seen that. So we're going to have to figure out how to retrain that workforce.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
Regional leaders are striking an optimistic view on global growth as the world climbs out of the pandemic. That bodes well for both oil and Gulf economies. I spoke to the ADNOC CEO, Sultan Al Jaber, and the Egyptian Minister of International Cooperation, Rania Al Mashat, and the Brookfield CEO, Bruce Flatt, at the Bloomberg New Economy Forum.
No one can deny the fact that the global economy has been hit hard this year. But at the same time, no one can deny that it has also shown remarkable resilience. And if we take only oil as a proxy for economic activity, and even at the height of lockdowns of March and April, the world still consumed 75 million barrels of oil per day. And demand only dropped below 90 million for just 12 weeks. And if you look at the different regions, if we look at Europe as a region, for example, their growth is slowing down due to new COVID restrictions. Having said that, the US recovery is in an extraordinary manner, is very robust, and despite the pandemic. And if we look at Asia, the Asian market is recovering very well. So yes, we need to remain cautious, but there is very good reason for us to be very optimistic. And I truly believe that we will get through this much stronger and also in a much healthier manner. What I think we need to do, though, is to remain resilient and to stay very much focused on what we can control. So if we take the UAE, for example, we are doing everything we can within our control to ensure the safety of our people and to also ensure business continuity. At the same time, we are enhancing the security of our supply chains to make sure that essential required resources and equipment are always available at all times.
Rania, can I take it to you? A new president, a new vice president. So what's your take?
Well, of course, we're happy that there's a woman vice president because that breaks the glass ceiling. But the relationship between the U.S. and Egypt is a very strong, long relationship. And the different administrations have been, coming, whether it's Republicans or Democrats, and that relationship continues regardless of which party is actually taking on. But in any event, we do look forward to a next period. We look forward to 2021 in general. I think that we are entering it with positive news. At least growth is continuing. I think that, again, we are looking at the different sustainable development goals, trying to achieve them, making sure that we are focused when we talk to our developers. Official development assistance continues. And so there's so much work to be done, but conducive work. And for those who are following Egypt, between 2011 and today, we've seen so much. So the word resilience is one that we have been to be in our DNA, if I can say it that way.
Where are the biggest opportunities for you geographically, if we say in this new frontier, in the regional powers? You know, you said in the United States, but you have offices all over the world. So where are the biggest geographic opportunities for you and industry opportunities?
Yeah, so I'll start with two things that both of them mentioned, renewables and infrastructure. And I think those two opportunities globally in almost every country in the world are going to be two of the big sectors over the next 10, 15, 20 years. And that's for two reasons. And with the head of one of the largest oil companies in the world here, I'll be very specific. Oil is used in transportation. Renewables is electricity, which does not use oil. But what is going to be converting globally is coal plants and some natural gas plants in the developed economy, as opposed to the developing economy. And the opportunities for renewables is enormous. It's many trillions of dollars to be invested. And the second reason why is global solar and wind costs have now come below what the alternatives are in many places of the world. So the renewable build out is going to be very significant.
And it's a week-long forum, so there's lots to come. Speakers coming up today include the Indian Prime Minister Narendra Modi, the ECB President Christine Lagarde, and Bridgewater's Ray Dalio amongst the lineup. Catch the conversations. We're online on the terminal, and the event's social channels are Twitter and Facebook. How are those markets?
Yeah, so at the moment, a little bit of consolidation in U.S. equity futures. Remember overnight that we had, of course, that all-time high. But under the surface, the rally is really showing signs of exhaustion against peers from the rest of the world. The Markets Live team is actually going as far as asking, when is the S&P 500 going to hit 4,000? But we are now lower by as much as 0.5% on the S&P 500 mini. Maybe this goes to echo on what we're seeing in the bond market.
Yeah, of course, Berkshire Hathaway in the 13F filings, Yusuf, they're long as long can be on pharma, Merck, AbbVie, Pfizer, and they've slashed their JP Morgan and Wells Fargo. Let's have a snapshot at the oil board. You know what? There's the dollar. It's actually bounced off its lows from this morning. And dollar yen, 104.51.
Yeah, bold call then from Citigroup. 20% downside potentially in 2021. This is Bloomberg.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
demoted. I was
got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know. with age and perspective that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning from Bloomberg's Middle East headquarters in Dubai. I'm Manus Cranny. It is Daybreak Europe. Your top stories this morning. Searching for a breakthrough, Moderna's vaccine sends U.S. stocks to record highs. The optimism is tempered amid fresh restrictions across the United States. President-elect Joe Biden calls for more stimulus. Pushback. Europe's crisis funding hits a roadblock. Hungary and Poland veto the current plans. The ECB emphasizes its next stimulus will focus on asset purchases and long-term loans. And joining the club, Tesla will become the S&P 500's largest ever member next month. The move comes after months of speculation and a near five-fold rally in the stock. Shares soar in extended trade. Warm welcome to the show. It's just gone 9 a.m. here in DIFC in Dubai and 6 a.m. in London. What is a vaccine? A vaccine is essentially a hedge against lockdowns if it is delivered in a timely and high-efficacy manner. Ben Amons at Medley Global Advisors put this together. The vaccine and AFCON, the correlation is beginning to look like a syncopated move. So this vaccine moving into the next trial period is going to help the AFCON situation. So that is the backdrop to markets. Why are we giving up a little bit of value this morning? Let me just show you what is going on, because record after record on the S&P 500, is it time to rotate? We will ask our guests. Let's have a look at the risk radar this morning. S&P futures are slightly lighter. You've got two beasts of vaccine coming to play. Stocks 50 at the moment. There's a little prevarication over the solution fund for Europe. So there you go. S&P 500 down by 0.5%. Axis say we're transitioning from a defensive bull market to a cyclical offensive market. Roll it over and have a look at what's going on, because I love the Citigroup note on the dollar in that get ready, because for them, as far as they're concerned, a vaccine is checking off all the tick boxes, the signposts for a new secular downtrend in the dollar, and it could drop by 20% through 2021. 20% through 2021. Of course, Steve Englander, and this was a tweet from Jonathan yesterday morning, Jonathan Farrow, showed us what Standard Chartered had suggested. It could be a body blow. It could be an intra-Fed meeting, an intra-Fed announcement, I should say, where they lump up on QE by 50%. Bottom of your board, it is, of course, a little bit of a different narrative going on Bitcoin. It's just belting it up. Have we crossed the Rubicon on Bitcoin? That's a question we need to ask ourselves. 16,652 is where we are. Let's talk about the optimism in markets. It's all coagulating around the Moderna vaccine. It was shown to have a 94.5% effective rate during the late-stage trials. The CEO, Stéphane Bancel, told us what's set his vaccine apart.
But what is very important with today's news is we can now, for up to 30 days,
have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
Joining me now is Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst and Director of EMEA Research. Week 2, Vaccine 2, game-changing narrative. Draw the most essential differential between Moderna and the Pfizer vaccine. Sam, good morning.
Good morning, Manus. So, to me, currently, the only difference that I see between these two vaccines is the fact that they have slightly different logistical issues with regards to distributing them. Well, I say slightly, they both need freezers, just one needs to be a lot colder than the other one during distribution. And these idea of being able to keep it in the refrigerator for 30 days for Moderna and only 5 days or so for Pfizer, those are all valid points, but these numbers change as companies continue to study their vaccines. Moderna's own number changed, so I expect to see the same kind of evolution for Pfizer over time. That's the key difference that I see, Manus.
Sam, 95%. I mean, we've been working on the flu vaccine for how many decades? And the efficacy of flu vaccine is what? I don't know. You tell me. You're the pharma expert. Do you trust the 95% efficacy numbers that we're being told? And how quickly can you deliver that kind of vaccine to the world in 2021? Give me the timeline.
Yeah, so on your first question, I do trust it as far as it goes. It is an early read of large trials. We are used to these kind of numbers. We have vaccines, Shingrix, Gardasil, that give you the sort of protection that this vaccine is suggesting. But of course, this needs to be proven to be the case for these COVID vaccines over longer term. Flu vaccine is a bit different. The flu virus has an incredibly rapid mutational rate, so it changes all the time. From 1 year to the next, the vaccine that you had last year just doesn't work against next year's virus. And, of course, there's a risk that could be the case with COVID, but we don't think so. And then finally, in terms of getting vaccines to people, I think the biggest challenge here is not at the moment worrying anymore about how effective these vaccines could be. We've taken the first step really well and strongly here. The challenge is how do you get people to come to the doctor's office and take a jab?
OK, well, I'm going to be one of the first in the queue for that when it is available. Sam Fazeli, Bloomberg Intelligence, thank you very much for your time. Georgina Taylor is a fund manager at Invesco Asset Management. Georgina, good day to you. I think as Sam just finished off there, it's about getting people to take the vaccine, and the Pew research is not that heartening. But let's not dwell there. Let's go to risk-on mode. We are seeing risk-on in equities, but the alpha wasn't as pronounced on Moderna as it was last week on Pfizer. Is V, capacity of V to restore reopening, priced into equities, global equities, at this juncture?
I think there is a lot priced into equity markets already because equity markets have enjoyed a great combination of a bit of recovery in earnings in the background, but also policy remaining incredibly loose on a relative basis to other asset classes. Equities have been pretty attractive. So I think we have a way to go to say what's the next leg of equity market performance. And, as Sam said in your previous session, I think human behaviour plays a part in this, how quickly we get economies back and opening again. So I think just a bit of a word of caution that this isn't going to happen quickly.
So we may as well get the value growth debate out of the way, tuck it away, because I think it will vacillate pretty much like a VIX index anyway. What does it take to get you convicted? Maybe that's the more salient question, because I look at the cheapest US stocks. We've had this spike. Everybody goes sell growth, sell tech, buy value. How are you doing that judiciously, if you are doing that at all?
I think it's really hard to segment the market into value versus growth. I almost feel the concept is something that we have to move on from, because value versus growth, a combination of factors influence that. So yes, absolutely, growth recovering is great for value because they typically are more cyclical segments of the market. But it also needs quite a marked change in the interest rate backdrop as well. So for growth to underperform, look less attractive in higher rates, and also for things like financials to sustainably outperform, they need a bit of a shift in the interest rate backdrop. And the two are slightly mismatched at the minute. You can get better growth news, but maybe the interest rate backdrop doesn't improve a huge amount, or interest rates don't go up because the world has not moved on enough to really justify a shift in policy. So for us, it's very much sector by sector, as opposed to an outright style shift across the spectrum of value versus growth.
I don't know whether you will answer me or not, whether you're long Tesla, whether you're allowed to actually answer me on that. It's a very cheeky question, but it's an explosive stock, and it talks to a whole host of themes. Where does that sit? Where does that sit in the narrative for you? EV, explosive growth on a stock like that.
I'm not a stock picker, so but I think what is interesting is that there are pockets of the market where there have been extreme moves, but also maybe the influence of the passive area of investments, that as soon as there is noise around, adding to an index, etc., then that is going to have a knock-on effect to price performance, not because of maybe the active community, but also because of the passive community as well. So I also think we have to be careful of how much, the world has changed to justify these kinds of moves and that level of dispersion in markets. I think that's a huge theme going into the new year. Definitely feeds into the value versus growth debate, but picking up on anomalies is the key thing for us, and a bit of a closure of some of those gaps. Maybe that is a theme, that plays out now, to really think about where that's justified or not.
OK, I'll come back to how do I identify anomaly in a moment, because I was delighted. I read the top lines of your notes, and I found a fund manager who wants to be long NOK sterling. But it's the principle of the beta here, isn't it? It's the principle of recovery, reopening, and is that the correct way to interpret your NOK sterling trade? And do I look to other high betas to complement that?
I think NOK sterling is an interesting one for two reasons. I think, Norway is definitely driven by oil, and therefore, if you do get a growth recovery, then there is some support for Norway, I think, through that higher oil price. I think for sterling, we've just got so many challenges that are out there, Brexit clearly being one of them, but also still very hostage to that global growth dynamic. So there are a couple of things, but also policy. We're leaving the door open to very loose policy in the UK, whereas Norway is just edging towards wanting to come away from incredibly low interest rates. So looking for divergences in policy around the world, it's hard because everywhere wants to keep their policy incredibly loose. But I think Norway versus the UK is one area where you might see interest rates move up a little quicker over the next few years in Norway versus somewhere like the UK, and that might support the Norwegian kroner over the pound.
OK, so it is really all about looking for those sort of little cracks of the anomalies and the divergence trades. Stay with me. Great to have you with me this morning. Kicking off the risk agenda, it is Georgina Taylor at Invesco Asset Management. Let's get the first word news flow for you. It's just gone 6:12 in London. The Trump campaign is withdrawing a key part of its lawsuit against the election result in Pennsylvania. It's abandoning demands that almost 700,000 mail-in ballots be thrown out because observers kept them too far away from the count. The challenge is now against a far smaller number of ballots, almost certainly just a fraction of Biden's lead in the state. The strongest storm of hurricane season has hit Central America. It made landfall late Monday in Nicaragua, bringing a catastrophic winds and torrential rain at 155 miles per hour. Its winds are powerful enough to crush homes, snap trees, and make areas uninhabitable for months. 4 astronauts have arrived on the International Space Station after a 27-hour voyage on SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew, has been ferried to the space station by a commercial vessel. Global news, 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Coming up on the show, the EU debt plan blocked. Hungary and Poland object to certain conditions tied to the funds. But Poland scored an own goal. That is the question we discuss. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
The real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
The big thing was preventing a financial collapse. The central banks acted definitively to do that. That's all that was ultimately historically important. The mistake is for them to vastly exaggerate their continuing relevance. They lack, starting at the zero bound where we are, the capacity to provide meaningful impetus to their economies in any way that is consistent with any concept of central bank functioning. They do not have the capacity to meaningfully affect the degree of inequality. They do not have the capacity to vaccinate people. They do not have the capacity to fight climate change. And they need to acknowledge the limitations of their influence.
That was Larry Summers, the former U.S. Treasury Secretary, speaking at the Bloomberg New Economy Forum with Stephanie Flanders. Turning to Europe, the ECB policymakers are focusing on emergency bond buying and long-term bank loans to boost the stimulus next month. The President, Christine Lagarde, said more support is needed and financial conditions must be kept favourable. So, with that in mind, the European Union leaders are rallying to their jointly financed recovery package, and it is facing delays. That's after Hungary and Poland both vetoed the deal. The two nations say the conditions tied to their rule of law unfairly stigmatizes them over the democratic standards. The move will likely force another round of fraught negotiations between the bloc's leaders. Georgina Taylor is at Invesco Asset Management, is still with us. Georgina, I'm drawn to the my favourite words of 2020 have been prevarication and procrastination. Okay, here we are, classic Europe. throwing a spanner in the recovery works. But they will get there. But do you think this delay is risky? If we don't get this recovery fund soon, how much of an injurious act would that be?
It's a real shame that there's another delay, to be honest, because I feel in the background Europe was gaining a small amount of credibility, that they were starting to really play on that policy stage a little bit more and kind of going up against the US, for example. And I think this just reminds us of the ghosts of Europe's past, that decision-making can stall. So I think it is a problem. I think there is an issue with the recovery fund anyway, in terms of the splits between grants, loans, how much of it will we actually see feed through into the economy. And I think there is a real issue here about trust across the member states. If they can internally build more trust so that they don't feel they will get penalised in the future, for example, on their use of the fund, etc., then I think, you know, Europe could do so much better. But unfortunately, this will stall. And against all the other uncertainties, it just makes us pause for thought about, you know, the shape of that recovery in Europe.
What does that do to your positioning? Because I look at, you like Eurozone mid-caps, Austrian and Taiwan, but you're concerned that industrials look expensive. Just talk me through that, why you like the mid-caps, and would that, dare I say, would that be a value trade?
It's a little bit of a value trade, so maybe there is a nod to that rotation. And Europe generally would benefit from a broader rotation into value. I think it is that at the moment you need some valuation support, and that premium for mid-caps has really reduced over the last few years. I think that there is a little bit of a green theme that can come through in some of the smaller cap companies, which is quite interesting, and a nod to, at some point, you know, some of this will get more visibility on the policy side in Europe, and maybe at the margin that does help the mid-caps. I think that sounds odd in contrast to the industrials being a bit cautious, but that really is, they've become so expensive and they've been the go-to sector in Europe. We don't have technology to any large degree. So a lot of those industrial large cap companies have become the growth proxy in Europe, and they have become very expensive. Now, there is a cyclical element to their earnings and their future profits growth. So again, putting the two together, a slight tilt towards maybe that value shift in Europe, doing it at that mid-cap versus industrials level rather than the style level that we discussed earlier.
Just very briefly, we were listening to Larry Summers, a fairly damning indictment of where the jumping-off point for this crisis was with central banks around the world. Limited capacity at the zero bound, limited. And yet I looked at Christine Lagarde, and her language is about recalibrating. Is the narrative of TLTROs and the extension of PEPP better for the European narrative rather than any risk of further rate cuts, which seems to be what they're trying to train us towards?
I think there has been a shift in the balance, and I think they want to do more targeted. You know, it's interesting, Lagarde's comments on, you know, trying to fuel that growth, you know, more organically in a sense through, you know, the corporate sector companies have to play their role in this. And unless that is facilitated and prompted, then we really don't have any longevity to the recovery. It has to come from the broader economy. So I think there has been a shift. I think there is a move away from just pure interest rates. I think that's healthy. It's just going to take us some time.
OK. Georgina, stay with us. My guest host this morning, Georgina Taylor at Invesco Asset Management on the markets. Coming up on the show, conflicting calls on the dollar. So just how should you be positioned into the year end? We look at the two contrasting views. That's next. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
Bill Clinton, former US president, speaking to Bloomberg at the New Economy Forum. Cracking lineup. You can get it all online on Twitter, on Facebook. Now, we're discussing big moves. Cities say the dollar could drop 20% next year amid the vaccine optimism. But TD Securities, other side of the trade, says before you see any weakness, watch out for some dollar strength. How do I tread lightly through the tulips? Juliet Sally has the answer to that. So take me through the middle ground, Jules.
Always lightly through the tulips matters. Yeah, TD Securities saying, look, you've still got a lot of COVID-19 infections happening, particularly in the US and Europe, and that is going to slow some growth trajectory coming through in the next month. So their short-term outlook here is that you could actually see some dollar strength coming through in the next month of around 2%. So a recovery from that about 1.5% drop we've seen from the dollar index over the last month or so. They do still have a fairly strong pullback in terms of their forecast for the dollar next year. But in terms of this shorter term move, they're saying you should be long US dollar against the Canadian dollar and that the euro is also facing some downside risks as they see these new restrictions imposed by governments in the US and Europe affecting growth indicators. Now, as we know, the Bloomberg dollar index has fallen around 11.5% from its March peak. And Citi is saying, look, expect more falls ahead. They're suggesting a 20% drop in 2021 if we do see this vaccine game changer. They're saying the distribution globally would check off all of their bear market signposts and allow the dollar to follow that similar path that you can see with that red line there on the chart of what happened in the early to mid-2000s. This according to Citigroup strategists, including Calvin Say. Now, they are saying subsequently what you should do here is go long on the Australian dollar and also the Norwegian krona. Both of these, they're saying, of course, the commodity-linked currencies could benefit if you do see that 20% decline coming through in the dollar index. And, of course, just adding to what would affect the dollar, not only the vaccine optimism, but the likelihood that you are expecting to still see the Fed remain fairly dovish as the global economy starts to normalise, we hope, Manus, in 2021.
Yeah, we shouldn't be just so risk-averse to the possibility of normalisation, Jules. You know, it could be good news if they actually raised rates and things got moderately back to normal. And then, Jules, you can get on a plane, and so can I. And to get on the big plane, you're going to need something to get it off the ground. Let's have a look at the oil market, because V for them, it's not exactly demand, but it is an optimistic narrative. So let's have a look at the oil market. There you go, up nearly 1% on Brent, 44.21. What will OPEC Plus do to bolster the story? This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
Our aim was from the beginning to have a portfolio of 6 to 7 potentially safe and effective vaccines. We've signed with AstraZeneca, we've signed with Sanofi and Johnson & Johnson. We will leave no stone unturned.
Good morning from Bloomberg's Middle East headquarters in Dubai. I'm Manus Cranny. It is Daybreak Europe. Your top stories this morning. Searching for a breakthrough. Moderna's vaccine sends US stocks to record highs. But optimism is tempered amid fresh restrictions across the United States. President-elect Joe Biden calls for more stimulus. Pushback. Europe's crisis funding hits a roadblock as Hungary and Poland veto the current plans. The ECB emphasizes its next stimulus will focus on asset purchases and long-term loans. And joining the club, Tesla will become the S&P's largest ever new member next month. The move comes after months of speculation. A near 5-fold rally in the stock this year. Shares soar in extended trade. That really is one of my favorite stories, I've got to say. I mean, Elon Musk docking with the space station, delivering a 5-fold ramp in the value of this stock. Are they Robin Hood raiders? Are they real investors for the long term? Whatever way you chop it up, it built into the S&P narrative last night. Now, we're giving a little bit back this morning. You've got 2 vaccines to play with. That loosens the FCON conditions. That is the narrative. And Axis say we are transitioning from a defensive bull market to a cyclical offensive market. SPOOs give a little bit back. There is the vaccine narrative. This is Medley Global Advisors. As the vaccine narrative rises, so the FCONs actually loosen up a little bit. And that's going to be good news for the Fed. That could, of course, run a slide rule against Standard Chartered's view from Mr. Stephen England that you could see an interim move. But let's roll it up. Have a look at the stock market. We're giving some value back this morning after you made a record on the S&P 500 across the markets. Berkshire Hathaway is buying pharma. They're buying pharma. Merck, AbbVie, Bristol, Myers Squibb, and they're slashing the banks. We'll talk about that in a moment. The dollar could drop by 20%. Jules just brought you that story from Citi. The big taster for me was Johnny Farrow's Twitter yesterday afternoon, probably, in the UK. Stephen Englander suggested the Fed could go in between meetings, lump up on QE by 50%, roll it up and have a look at the dollar. There you go, the dollar this morning. Let's just roll the board forward and have a look at the dollar, WTI and Bitcoin. The dollar's down. It's bounced off its lows this morning, but 11.50 is where we are. And the proposition from Englander, from Stephen England, is that they could deliver a body blow. QE could be up by 50%. To $120 billion. That could structurally change the narrative in terms of what the Fed is doing. But there are other changes afoot, and we now know what some of them are. The 13F filings are in, so we have those for the season. Among the investment giants reporting their third quarter holdings overnight, it was Warren Buffett's Berkshire Hathaway. And their filing reveals some pretty big bets on the vaccine. Danny, I touched on this. I didn't mean to steal your thunder. I just got too excited about the 13F filing. I got excited about Tesla. I just got excited about a lot of things. We need Anne-Marie back to bring the calm. How about the 13Fs?
Manus, you could never steal my thunder. Excitement is the name of the game. That's what we do here. And certainly we get some of that in the 13F filings. Look, what Buffett's Berkshire Hathaway filed for the previous quarter really continued along the theme that Buffett has been talking about, and that's more caution over the U.S. economy. But there's a lot of vaccine optimism injected into what he bought. So here's some of the additions he had for the third quarter. Merck, Pfizer, of course, this came months before Pfizer announced the success of its vaccine. Merck is developing a COVID therapy for its part, also adding to AbbVie and Bristol-Myers. Now, he also cut his financial holdings by a significant amount, about a 4% reduction in what he holds in terms of financials, well on his way to exit Wells Fargo and JP Morgan, slashing those stakes by as much as 96%, Manus.
And in terms of the Tesla story, I mean, let's stick with the U.S. because what a belter, eh? Set to join the S&P 500. They might even have to phase it in. It's so big. Talk me through the effect.
So, like you said, Manus, this is a really big stock, and adding it into a benchmark in one go could be very disruptive. To give you sort of a numbers to this, managers who track the benchmark would have to kick out about $40 billion worth of other stocks in the index to make room for Tesla. So this would, of course, have a very distortive effect for those stocks and what the benchmark itself does. And it's so disruptive that the committee for S&P Dow Jones has reached out to investors and say, hey, should we add this in two phases? And Tesla should also help supercharge the index. I mean, it's gained nearly fivefold. That's much more than the S&P 500 itself. So should those gains continue, that will likely to fuel it. I should say it also fuels Tesla shares. There are about $11 trillion worth of passive investments that track the S&P 500. So that passive injection into Tesla should only help it rally further. Tesla overnight rallying more than 10%. Elon Musk getting $15 billion more dollars worth to his wealth, jumping over Mark Zuckerberg. What a week it has been for Elon Musk, Manus.
Well, let's just put that in context for Elon Musk. Danny, great roundup there. Lovely numbers, set of data to consider. But consider this. I don't have this problem at the moment. My net worth hasn't gone up by 270%, but his has. In the space of the past, let's just have a look at it. There you go. 270% year to date. And as Danny says, he just trumps out Zuckerberg on the Rich Go. Yes, there is a function on Rich Go on your Bloomberg. I don't feature on that particular list at the moment. Some other people might. Let's talk about the relationship between the United States and China. It's at the lowest in a decade. You have a new administration. It's set to take place and take over in January. The top voices in business and politics, they're calling on both countries to reject unilateralism.
A competitive approach to China was inevitable, but keeping it healthy and not pernicious is vitally important, and that won't be easy.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
But what I do believe both sides are capable of through the highest level diplomacy at an early stage of the Biden administration is to define the parameters.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
The American administration is about to change, but the clock will not simply be rewound.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
Unfortunately, some forces are acting against the trend of the times. They have trumpeted the decoupling and willfully walked away from international commitments, posing challenges to multilateralism.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
Georgina Taylor is at Invesco Management. Let's see, does she share Mr. Schwartzman's optimism on a reset for China? Georgina, do you? Is this where your keywords could play, where there are anomalies of value that may come as a result of a reset, or perhaps a continuation of divergence for growth trades in China?
It's difficult. I don't think it's clear. I think that there is some optimism that a change in the administration in the US may lead to at least more visibility on how that relationship will work. So I think hopefully over the longer run, we get a little bit of better news flow feeding through. But I think in the near term, that's just not clear. And I think no one kind of doesn't feel like there's a first mover advantage here in laying that out. So for us, there are still difficulties when it comes to broader Asia. I think we have to think about currencies actually in the context of that, to say, well, maybe currencies will slightly be the release valve that resets this. They could also be used as tools by individual countries to make sure they remain competitive on the global stage. So for China, for example, we may see, a bit of a weaker currency, and maybe in other areas in Asia as well. So it's difficult. I think there will be a bit more stability there, but we've got a way to go.
OK, so that's a lot more cautionary than perhaps some people are who've been sort of quite full on China when they've come on. I want to circle back to the other big piece that I was covering this morning. This is from Stephen England. It came in a tweet from Jonathan Farrell yesterday, where you could see an intra-Fed move. Now, we didn't have one of those since 2008 until March of this year. So it was a long time. So when these come, they can be really quite interesting. Stephen England says over at Standard Chartered, you could have an intra-Fed move, scaling up QE by 50% and targeted measures, credit provisions. You see, this is all about filling the vacuum, isn't it? It's about filling the fiscal vacuum. It's about filling the reality of where we are in COVID. It's literally lashing from coast to coast in the United States of America. Do you see the risk of an intra-Fed meeting, or intra-Fed move?
I think calling for an intra-Fed move is a big one. I think they would have to balance filling the void, as you say, with further policy measures, with creating some form of panic in the sense of them feeling they really have to do more between meetings. However, the bigger theme, I think, is that they probably have to do more. And I think this circles right the way back to our earlier conversation on value, interest rates, bond markets as being a catalyst for that rotation. Because for us, against this backdrop, you've seen a gradual increase in bond yields in the US. And I think maybe that is too early. And particularly that widening gap versus Europe, if they still need to do more, the vaccine is still spreading, the virus is still spreading. The vaccine's great news, but that's going to take some time. And so for us, it just caps that move in bond markets. And maybe that's where we see the big move, maybe a bit of an influence on the dollar as well.
And you see that differential in the bond market. You've got a couple of key themes. One, you want to play a slightly longer-term steepener in the inflation narrative, the 5-10 steepener, but you also see US to European bond spreads moving. So just take me through those two trades.
So I think particularly US versus European bond yields, I think that gap has widened, and it makes sense. There's been that slightly better news flow potentially in the US versus elsewhere, and that's been reflected, but also the fiscal risk that was starting to be priced into the US bond market going into the elections. That's come out a little bit. But we just think over time, almost that US exceptionalism, that completely different growth track and inflation track for the US versus the rest of the world is probably overdone. So you'll start to see that narrowing again, US bond yields coming down, and in Europe maybe remaining stable or edging slightly higher, potentially linking to those different policy measures that they're looking to do in Europe. I think on the inflation steepener, it's quite interesting that the curve is relatively flat. And I think that for us, it's going to take quite a long time to really fuel inflation coming through in the system in the US. So just saying those nearer term expectations for inflation will edge down to reflect that. that slightly more cautious economic outlook, and maybe stay anchored at the long term with a bit of a belief in the Fed that actually they can get inflation back in the system over the longer run. But you end up getting that positive tilt to the inflation curve in the US, reflecting that policy shift.
OK, Georgina, thank you so much. Georgina Taylor there, fund manager at Invesco Asset Management, my guest host this morning. Let me get you up to speed with your first word news to Germany. The Chancellor there, Angela Merkel, has failed to push through a slate of tougher restrictions to tackle the pandemic. She's kicking major decisions until next week after being unable to reach a deal with the regional leaders. Instead, she's urging people to limit public and private gatherings. Flexible working could be the solution for businesses struggling to recruit women into senior roles. That's according to a new study by Zurich Insurance. Women applying for management jobs jumped 20% after the insurer advertised the roles with part-time and job share options. As a result, the number of women hired for senior positions jumped by a third. And the Spanish bank BBVA is in takeover talks with rival Sabadell to create one of the country's largest lenders. The move comes a day after BBVA announced it was selling its US arm, PNC Financial. That gives it the firepower to do the deal and boost its capital ratio. Global News, 24 hours a day on Bloomberg. Quick take, powered by more than 2,700 journalists and analysts in more than 120 countries. Coming up on the show, the prospects for a Brexit deal. We hear from the Irish Prime Minister, Michael Martin, at Bloomberg's New Economy Forum. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Daybreak. You're by Manus Cranny in Dubai. The New Economy Forum has been on a roll. One of the attendees is the UK, calling for more realism in Brexit talks with the EU. It says while some progress has been made, there is still a lot of work left to do. Speaking at the New Economy Forum, Ireland's Prime Minister, Michael Martin, said the contours of a Brexit deal between the UK and the European Union are clear to both sides as they struggle to reach a trade deal.
I would still hope there will be a comprehensive trade deal, but it will be challenging. And the three items that have been there now for quite some time, the three issues of a level playing field in terms of access to the single market in Europe, with the UK agreeing to adhere to that level playing pitch. That's proving problematic. My understanding is, my sense is if that got sorted, the area of a dispute resolution mechanism would get sorted then in terms of how does one arbitrate as to the behaviour of each party to the agreement. Thirdly, the fisheries is proving very difficult as well. A lot of progress has been made on other issues. My sense of if there's a political will in the United Kingdom to get a Brexit deal done, then it will happen. I think the European Union want a deal. Of that, I'm clear. Not at cost, but it's our view, and it's Ireland's view as a member state, that it is in the interest of our citizens and the respective economies to get a deal that makes sense. And no deal would be very damaging to our respective economies. Logic dictates we should do everything we possibly can to get a deal. It's a responsible thing as politicians to do on behalf of the citizens that we represent.
But we now have an incoming US president who's made very clear his views on the Good Friday Agreement and the importance of there not being a hard border between Northern Ireland and Ireland. Do you think that changes the calculus? Do you think that makes it more likely that Boris Johnson would compromise with the EU?
I think it's helped. I spoke to Joe Biden during the week. Very warm, clearly very proud of his Irish heritage, and makes no secret of that. And we're looking forward to his presidency, to be frank, from that perspective. But I think the more broader issue is the prospects of a Biden presidency being more multilateral in its thrust and its impulse. That was clear from my conversation with the president-elect that he was going to engage with Europe. Now that's probably more significant in terms of the impact on the UK's response, because it seems to me that the United Kingdom values its relationship with the United States and vice versa. I think President Biden-elect would too. And so therefore, I think the US, the new presidency, would prefer a deal between Europe and the UK. I think the UK is conscious of that. And the president-elect is very committed to climate change. I think Boris Johnson would like him in Glasgow, for example, for the COP. So I can see an alignment of interests here, sparked by the president's commitment to multilateralism and to resetting, if you like, the sets of relationships between the US and Europe that might be better, or might enhance the prospects of a deal.
But there has been, you've said in the past that both sides have to compromise in order to reach agreement on those three things. But there has been some question about whether the European Union feels like it now has to compromise, given this change of emphasis from the US. If Boris Johnson now feels more pressure from the US, and maybe that trade deal with the US being in doubt without a deal, does Europe need to compromise at all?
Well, look, I think I wouldn't overstate that. I think Europe wants a deal. And I think also it's in our interest that there would be a comprehensive trading deal between the UK and the European Union.
Michael Martin there, the Prime Minister, the Taoiseach of Ireland, speaking at the Bloomberg New Economy Forum. Coming up on the show, US stocks hit record highs in the cash market as Moderna one-ups Pfizer in the vaccine race. The details next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered. The
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It's Daybreak Europe from the DIFC in Dubai, our Middle East headquarters. I'm Manus Cranny. Moderna's vaccine, it's shown to be 94.5% effective during large late-stage trials. Sam Fazeli is the Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. So we talked about this extensively yesterday, Sam, as you've had 24 hours to think about the Moderna vaccine. What does it mean? In addition to Pfizer, does it set the stage for multiples to come? What's the most important thing in the past 24 hours re-Moderna?
Yeah, I think the key thing here is that first, people should not assume that the Moderna vaccine is better than the Pfizer one based on these very early data that we've seen. And the second thing is that obviously the company has the product that Moderna has developed appears to have easier logistics requirements with regards to the cold chain, how low a temperature it needs to be kept at while it's being distributed, than Pfizer's. But the reality is that we are going to have so many dose requirements that the two companies will have to, the two vaccines will have to be used at the same time until we get more.
What is the biggest challenge here? Is it distribution or convincing the majority of the world to take this vaccine?
Yeah, that's an excellent question, Manus. And I have to say that distribution is a mechanical process, for want of a better phrase. We can get freezers put in places, etc. So that should be solvable, given that we deal with much bigger and more difficult logistical issues than this. I think the convincing people to go and get a jab in their arm is going to be the most difficult one. And I'm sure you, as well as everybody else who's listening, knows people who say, no, I'm not sure I want to take a vaccine. So, the more people they say that, the harder it will be to control the pandemic. But the more important it is that we have a very effective vaccine. The higher the efficacy, the fewer people you need to vaccinate in order to be able to protect the population.
OK. Sam, thank you very much. The challenges in terms of the next step in the vaccine debate. And that vaccine debate has reset the equity market debate. Are we transitioning to a defensive bull market with a more cyclical offensive? Not my words. Far too smart. That's AXA. We're giving a little bit back this morning. We're off record highs. So the question is, do we adjust to a new vaccine reality? This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
I'm a huge believer in UK financial services. It's a significant part of the UK economy, obviously employs lots of people across the country, and importantly is something that we're globally best in class at. We want to be a leader in green finance.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. An hour to go until the start of the European equity trading day. Let's get to your headlines. Value play. The global rotation picks up pace as optimism grows over a vaccine. But US and European futures slide as America prepares further lockdowns. Landing zone found. Ireland's Prime Minister tells Bloomberg the outline of a UK-EU trade agreement is clear to both sides, but he's not convinced Boris Johnson truly wants a deal. And Tesla is set to join the S&P 500 next month as its biggest ever new member. Good morning, everybody. So just under an hour to go until the start of the European equity trading day. Let's get to some breaking news. We have numbers coming through from EasyJet, so the low-cost airline. Let's get to the numbers there. Full year capacity down by 47.5%. So we should bear that in mind when we're looking at these numbers. This is a full year set of numbers, of course, bearing in mind when the end of the EasyJet full year is at the end of September. Full year revenue, £3.01 billion. That is in line, a touch below the estimate of 3.08. They're set to fly. In fact, I won't read that one because I'm not sure entirely the sense of it. Let's get to some I can make sense. So full year headline pre-tax loss, 835 million. So there is one of the facts we need to understand. They won't be recommending payment of a dividend, as you might expect. A big question for EasyJet then, when we get to speak to the CEO of EasyJet, Johan Lundgren, is this the worst of it? Is November the worst of it? HSBC saying that November may be as bad as it gets for European airlines. Does it feel that way from the aviation flight deck right now? Or could things get further more difficult? Could things become more difficult as we go through the winter? A lot will depend, of course, on the lockdown or no lockdown measures put in place or lifted in various parts of Europe. So we will have that conversation a little bit later on in the programme. Let's get to the broader markets and have a look at where we are on futures. Futures have looked a little mixed in terms of the US, a little weaker in terms of Europe as we've been going through the Asian session. In yesterday's session, the US and Europe were both higher. Vaccine news, of course, was very much to the fore, certainly in the European afternoon. This time it was the turn of Moderna. And we did see a continuation of that risk rally that had been started the week before with the Pfizer and BioNTech news. And some of that is now spilling into Asia as well. In yesterday's session in Europe, we saw banks higher, autos higher, pharma and utilities were the sectors that lagged. So it was that classic sort of risk on move that we were seeing in equity markets. And we'll ask about where the rotation is now, whether we're still seeing that rotation into value, whether that has further to go now or later. We'll do that with our guests. We'll also focus in on Tesla. Incredible moves, more than 10% higher after hours. The 21st of December, an early Christmas present, perhaps, for those with Tesla shares. It will be admitted into the S&P, and that will be part of our next conversation. Let's talk about the global stock rally as it perhaps runs out of steam. S&P 500 and FTSE 100 futures pointing a little in the red. That's after US equity benchmarks set new records yesterday on vaccine hopes. Let's get to the markets now with Mark Cudmore, our Bloomberg Markets Live managing editor, who joins us from Singapore. Mark, when you look at where we are at this point, I was reading with interest your macro view this morning. You're talking about how sometimes you might see detail that makes you question the big picture, but sometimes you just got to go along with the big picture. Is that where you find yourself right now?
Yeah, I think that. Look, there's been a lot of people with kind of different approaches to the market this year. And certainly some people since quite early in the year, not Harry hindsight or anything like that, there's been some people since about March, April, who have been very clear that they've got the message from central banks around the world that they're going to pump up assets because it's the only kind of inflation that they can guarantee. And therefore, that means you generally buy risk assets. It's also in favor of buying things like gold or even more so things like Bitcoin. It's about a devaluation of fiat currencies slowly over time, not necessarily in anything dramatic, but it means that you just keep on buying assets and you're constantly focused on the upside. It's not about risks because central banks have made clear that if there is any extreme sell-off, then they'll do something even more extraordinary again. And therefore, you just got to stop worrying about what's going to happen in the economy, stop worrying about the virus, stop worrying about companies and earnings and all those things that we used to use to value markets. And instead, just time. It's all about timing about when you buy more and when you maybe take a little bit of money off the table, only so you can rebuy a little bit later, though, not because you expect anyone to care about the economy or earnings again in the future. And I think that's kind of been, those people who've had that approach in the market have been very, very successful this year. And I don't see any reason for that to change, but it's very, very hard for other people in the market, like myself, who haven't ever operated in that way, to suddenly switch off from things like the economy and valuations and fundamental inputs that were so relevant for all of market history up until 10 years ago, and even, have now become redundant as of 2020.
Yeah, will they be relevant again? I liked your reference to the never-ending story in your macro view piece on the Bloomberg this morning, Mark. Let me ask you the question of the day then, because this perhaps links into our Tesla headline. Well, when will the S&P 500 hit 4,000? What kind of responses are you getting? I mean, is December 21st the answer, or is it a little bit later than that? Mark, can you hear me? I'm not sure if Mark can hear me, which is unfortunate because I was looking forward to getting his thoughts on what's happening in the S&P. We're covering that story, of course, around Tesla. Big moves in the Tesla share price after hours on the back of that news around the S&P. Thank you very much to Mark Cudmore, though, if you can hear me, Bloomberg Markets Live managing editor. We'll get more from the Markets Live team a little bit later on in the programme. Let's get a Bloomberg First Word News update. Here are the top stories we're covering for you this morning here at Bloomberg. The Trump campaign is withdrawing a key part of its lawsuit against the election result in Pennsylvania. It's abandoning demands that almost 700,000 mail-in ballots be thrown out because observers were kept too far away from the count, in the view of the Trump administration. The challenge is now against a far smaller number of ballots, almost certainly just a fraction of Biden's lead in the state. In Germany, Chancellor Angela Merkel has failed to push through a slate of tougher restrictions to tackle the pandemic. She's kicking major decisions into the future until next week, in fact, after being unable to reach a deal with regional leaders. Instead, she's urging people to limit public and private gatherings. The strongest storm of hurricane season has hit Central America. It made landfall late on Monday in Nicaragua, bringing catastrophic winds and torrential rain. At 155 miles per hour, its winds are powerful enough to crush homes, snap trees, and make areas uninhabitable for months. 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. 7 minutes past 7 here in London. Up next on the programme, vaccine breakthrough. Moderna says its COVID-19 shot has almost 95%, or was almost 95% effective in a late-stage trial. We will get the latest on the vaccine race next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Welcome back to the European Market Open. We are 50 minutes away from the start of the European equity trading session. This is what futures look for you right now. We've got those on the screen for you. European futures make moves to the downside. US futures negative, sure, on S&P and down. Nasdaq futures look a little bit more resilient. 10-year Treasuries back over 90 basis points in yesterday's session, and that remains the case. Let's get back to Mark Cudmore, our Bloomberg Markets Live managing editor, who we have refound, redialed, reconnected with in Singapore. Mark, sorry about that. We did get all of your first response around your market thinking, and I was just getting to the question of the day. When will the S&P 500 hit 4,000? Does it depend on the Tesla news?
I'm not convinced the Tesla news is as big for the S&P direction as people seem to think. Certainly it's very important for sentiment, and it's obviously great for momentum. We know that Tesla gets that excited retail investment, and it can really have these powerful surges, as we've seen over the last year or so. So I think there is some kind of positive vibe for the extra volatility in the S&P 500, which means if you're looking for one touches and for people who like buying those options that are on certain barriers, well, then there's more excitement when you've got a Tesla in there and a high volatility stock. But it shouldn't fundamentally improve the index just because Tesla is included.
It shouldn't. And indeed, we're going to get a few clues on US data perhaps a little bit later on, Mark. What are you going to be watching out for? We get retail sales as we head into the busy period in the run-up to the holiday season, the run-up to Christmas. Of course, a lot of focus on the strength or lack of for the US retail consumer. And indeed, a lot of focus on the state-by-state lockdown measures, or just not even lockdown measures, social restrictions that might be being brought in the United States. What are you looking for from the data later?
Yeah, we've got a real slew of US data today. I think it's a really, really important day for US data. I think one of the themes of the last couple of months is we've seen the resurgent virus in the US, and yet it's had no real impact on the economic data. I think very much a theme of the last couple of months has been the data in the US has been relatively resilient, and we don't see that virus impact that we see in Europe. And it's not just because there's stricter lockdowns in Europe where there's an official government reaction. the consumer does not seem to be as dissuaded in the US as it is elsewhere in Europe. And I think if we again see a resilient set of data today, I think that'll be a very, very positive sign into year-end for many risk assets that, you know what, the consumer in the world's largest economy, the most important consumer base, is going to continue ignoring the virus threat for a sustained period of time. And that brings us ever closer to when a vaccine can be distributed to an adequate amount of the population. So I think that'll be taken as a very positive sign. However, I am worried we don't get that positive, that strong data that is expected. But let's see what happens today.
Mark, thanks very much. Mark Cudmore, Bloomberg Markets Live managing editor. Now let's focus in on the latest vaccine news flow and what that does to stock market positioning. The global rotation into value has been gathering pace amid optimism about COVID-19 vaccines. Moderna's vaccine has shown to be about 95% effective, pushing the S&P 500 to a record high. Joining us now is Marcus Morris-Ayton with his perspective, European Equity Portfolio Manager at Allianz Global Investors. Marcus, very good to speak to you. And so I want to ask you about some of your convictions at this point. And I know one of them is around digital. I find this interesting, despite the questions that some people might ask about technology, if we are going to see vaccines driving a pivot into value and away from growth. You say digital is still a focus, but that doesn't mean necessarily buying tech stocks. It means other stocks that have a really good narrative around their digital product.
Absolutely, and good morning, Anna. Digitalisation, I think, is something that's often misunderstood. Everyone typically associates digitalisation purely with technology, but actually, as you rightly just said, it spans literally every sector across the universe. And that's really where we're finding the opportunities at the moment. Companies that embrace digitalisation, ideally pre-COVID, that therefore have the infrastructure in place to be able to manage their business during challenging times. And actually, what we saw during lockdown 1 was probably a greater gap between the winners and losers in society, but also in the corporate world, than ever before. And the winners were able to take market share at a much quicker rate than ever, and really build their business, while many of their others were struggling to stay alive.
And what do you make of the sort of bigger end of the tech market then, with the problems that I mentioned around vaccine success? What do you make of valuations there and also regulatory threats?
Well, the vaccine is interesting because markets are very much traded as if we're through the woods with COVID in the last week or so. And undoubtedly, as you said, the vaccine data points we've had have been hugely impressive in terms of their efficacy. But I think there are big questions that remain unanswered. And I think, particularly over the next few months, things unfortunately will get more challenging, but before they get better. In terms of how we approach that as an investor, we've clearly seen a huge amount of volatility in markets in recent weeks, and actually that creates opportunities, and that's certainly something we'll look to take effect of. Where we have to be a little bit careful as a long-term investor is you've seen a huge relief rally in many stocks that are perceived to be COVID losers because of the vaccine. But actually, that might be masking many of the structural challenges that some of these businesses face. And those challenges won't disappear overnight when we have a vaccine.
So where are those structural challenges? Which of the sectors do you think that get caught up in the value rally, pushed up by the value rally, but actually you need to ask questions about whether we've seen structural changes? Are you talking about leisure and tourism here? Do you not think it has structural reasons to come back at this point?
I agree. I think it is probably slightly more idiosyncratic than that. So leisure will undoubtedly rebound from a terrible year this year. But actually within the leisure sector, I think corporate travel is probably something that's structurally impaired. I expect moving forward, more and more of us will do meetings virtually like this. And COVID has actually taught us how well Zoom, et cetera, work. So I think you will see a structural deceleration in corporate travel from 2009 levels. And that will create challenges for parts of the hospitality industry.
Understandably, when we get positive vaccine news, we see investors flying to the areas of the economy that they think are going to rebound, and you see the more defensive sectors underperform. Interestingly, of course, that includes pharmaceuticals, even though the source of the good news is coming from some very good big work in pharmaceutical businesses. Where do you stand on pharma right now? Because all pharma is, of course, not the same. And what are the types of pharma stocks that you think can still carry on through a cyclical rebound for global stocks?
Yeah, pharma's been a great sector to be positioned in this year, particularly around the vaccine news flow. The trouble with the pharma sector is it's incredibly complex, with multiple moving parts, and often not a huge degree of visibility as an outside investor. So it's a sector that we're actually underweight. Within our healthcare exposure, we tend to be slightly more focused on the medtech side, where you tend to have slightly smoother, more visible earnings profiles. So it does come with slightly less risk than you see in the mega cap pharma stocks, where you suddenly have the blockbuster drug risks on the upside and downside.
And where do you see the best opportunities around ESG narratives, Marcus, around the environment, in particular around green stocks? Many people point to Europe and say we've got some really big businesses in Europe that could do very well out of this trend as it starts to gain momentum under a new US administration.
Yeah, I think ESG is probably one of the first points in recent memory that Europe actually has a material head start and first mover advantage versus the US and Asia. And certainly as we manage that transition, not just in ESG, but the energy transition towards cleaner energy, I think Europe has a real advantage here, and the opportunity to actually lead the technology transition from this perspective. And there's no doubt ESG will gather momentum globally. And actually PwC came out last week and outlined that expects 60% of mutual funds to be run under ESG guidelines by 2025. So there's no doubt ESG is here to stay. And if Europe can really cement that first mover advantage, there's a huge opportunity for European tech companies that are at the forefront of that.
Marcus, thanks very much. Marcus Morris-Ayton, stay with us. European Equity Portfolio Manager at Allianz Global Investors. Lots more to come from our conversation with Marcus in just a moment. Coming up on the programme, a Spanish affair. BBVA confirms it is in takeover talks with Sabadell. Up next, we talk about Europe's banking consolidation and where else in Europe we might see M&A opportunities. This is Bloomberg.
We're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail, right? We've seen that. So we're going to have to figure out how to retrain that workforce.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies,
That was Bill Clinton, former US president, speaking to Bloomberg at the New Economy Forum. And don't miss today's lineup, including ECB President Christine Lagarde and Indian Prime Minister Narendra Modi. European equity markets then still 40 or so minutes away from the start of the European equity trading session. Futures have been pointing modestly to the downside, down around 0.3% on Euro Stoxx 50 futures right now. US futures looking a little bit more mixed. Now, M&A was certainly a hot topic in yesterday's markets. BBVA confirmed overnight it is in takeover talks with its rival Sabadell to create one of Spain's largest lenders. Banks in Spain are at the forefront of a wave of consolidation in Europe. In September, CaixaBank agreed to acquire smaller rival Bankia. Unicaja and Liberbank are also in talks. So lots of M&A. You get the picture in the Spanish banking sector. Marcus Morris-Ayton, European Equity Portfolio Manager at Allianz Global Investors, is still with us. And Marcus, I don't think you've been all that keen on banks in recent years. Would M&A, even within country M&A, be something that would encourage you to look again at the banking sector, or is that not what you're waiting for?
No, I think investing in M&A alone is quite a risky game. But that said, there is no doubt that the European banking sector needs further M&A. It's a sector that hasn't consolidated enough, and that's one of the reasons why returns in the sector have been relatively weak for the past few years. So it's a sector, as you rightly said, that we haven't owned, and I think there are big structural challenges that persist in that sector. But actually, they're in a far better position than they were going into 2008. So I think there are reasons for optimism there for those investors who are prepared to look through the nearer term challenges.
We're some 13% down on last year in terms of the amount of M&A that we've seen in markets, Marcus, this year. I'm sure some of that was due to the hiatus and uncertainty caused by the initial coronavirus lockdown in the spring. Do you see M&A as a theme worth pursuing here? Do you think this is something of interest? Because in certain industries, bold chief executives like to tell us, this will be a period for consolidation, a period to buy up weaker rivals.
Absolutely, and I think M&A is something we'll hear more and more of in the coming months. As mentioned earlier, you have a very big divide at the moment between cash-rich companies who are looking to invest their capital and many weaker companies who are fighting to stay alive. And that typically creates quite a supportive backdrop for M&A. The one challenge that we hear time and time from companies who are looking to pursue M&A is actually it's very difficult to close deals in the current environment where you can't meet these companies face-to-face and do your due diligence at those sites. So that has certainly put the handbrake on some of this M&A that is in the backdrop. But I think as and when life returns back to normal, you could see a flurry of activity in this space.
Yes, and Marcus, just briefly, what about the UK? A lot of people talk about it looking cheap. Does that encourage thoughts of M&A in your mind?
There's no doubt the UK is cheap, but unfortunately the UK has been cheap for a long period of time now. The question is whether the UK is good value. And there are a number of issues that have led the valuations in the UK to be so low, not least Brexit, but also our COVID response. But I think longer term, there are structural issues that the UK needs to navigate. Unfortunately, a lot of the UK companies are old in terms of their constitution and probably need to adapt and change to the modern world. Okay. Unfortunately, you don't find many innovative tech companies based in the UK. It's very much reliant on old, heavy industries
Marcus,
like energy, utilities, etc.
Thanks very much, Marcus. Marcus Morris-Ayton, European Equity Portfolio Manager, Allianz Global Investors. When we come back, we'll talk to the CEO of EasyJet. This is Bloomberg.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to the European Market Open. 30 minutes until the start of the cash equities trading session. European stock market futures look slightly negative. US futures look to be a little more mixed this hour. Let's take a look at what is coming up today. Some of the things on the agenda to look out for. OPEC Plus will be holding a joint ministerial monitoring committee. That meeting taking place today. The producer group has inched closer to delaying its January output increase amid weak oil prices. And over in Britain, the Bank of England Governor Andrew Bailey will be speaking at the City UK's National Conference 2020. You can follow his speech at 11:15 a.m. UK time. Turning to the US, retail sales are forecast to increase for a sixth straight month in October, though at a slower pace and, of course, from a low base. Later, the CEOs of Facebook and Twitter have volunteered to testify before a Senate panel about their decision to restrict an article about the son of President-elect Joe Biden. So something to watch in the tech sector there. Now, the COVID-19 crisis has forced EasyJet to report its first ever annual loss. The British carrier has reported a full-year headline loss before tax of £835 million. Its revenue fell more than 50%, but vaccine developments have lifted its stock in the past 2 weeks. Joining us now is Johan Lundgren, Chief Executive Officer, CEO of EasyJet. Johan, very good to speak to you. Thank you very much for joining us. We sit here, of course, in a Europe that is partially locked down, that is full of restrictions on people's movement. I wonder, what is your most current experience, this November of flying around Europe? Paint the picture for us, Johan, about how tough things are.
Well, first of all, it's fair to say that as we speak, there's very little flying going on across Europe, in its totality. EasyJet, we're predicting to not fly more than 20% of the planned capacity for the quarter that we're in. But I also think it's fair to say that it's definitely a underlying strong demand for travel. We saw that when the Canaries was, for an example, moved from the quarantine list, the bookings went up with close to 900%. And as long and for every day that these travel restrictions are in place, it actually increases the pent-up demand there. And of course, the news of the vaccine is also a very helpful message, because it will ultimately give customers, more confidence to make future travel plans.
The bank, HSBC, analysts there have recently said that November could be as bad as it gets for the European aviation sector. Is that your working assumption as well, Johan?
Well, I think it's fair to say that, we have taken a number of steps throughout this pandemic to put us in a good position. We've been reducing the costs. We got access to liquidity. And of course, now we're seeing more of the good news coming out of it in terms of the vaccine, but also then, further development and also on how the quarantine can be more effective with perhaps less days that you would need to quarantine coming into countries. We see developments also in testing. And once again, just the announcement of the vaccine, the news of that, we saw an increase in bookings quite significantly. So it shows that the underlying demand is really, really there. And hopefully we can see a strong recovery coming very soon. I think it's fair to say that nobody knows exactly when it's going to happen. But what we do know is that the recovery will be strong when it comes, because ultimately people genuinely underlying want to fly and they want to travel.
How much flying do you want to do around Christmas, though, Johan? Is winter a sort of a lost cause for you, or are you still optimistic you can see an uptick in visiting friends and family, VFR traffic over that period?
Well, we know that customers, would like to travel and would like to make arrangements also for the Christmas and the New Year, and as you said, to visit friends and family. But it all comes back to what the travel restrictions will be. And the travel restrictions, as you know, is a consequence also about, how the infection rates are developing. But hopefully, if we are getting some testing in place, and if we can see also a refinement of the travel restrictions and its quarantine, we can also see that there might be an uplift as soon as Christmas and New Year. But it's it's still a lot of uncertainty around that. So we just have to wait and see what happens on that. And meanwhile, make sure that we are preparing ourselves and setting us up in a good way so we can bounce back and we can take part of the recovery when it comes. And that's what we've been spending a lot of time and focus on at EasyJet throughout this whole period as well.
Johan, do you need any more cash at this point? You've raised money in various ways, commercial paper, you've done a sale and leaseback. Are you looking for any more cash at this point?
Well, we believe that we are in a good position as we speak, but we will continue to review all the options that is out there, because still we don't know the extent for how long the travel restrictions will be in place. And we're taking a prudent and conservative point of view in terms of our planning, and that has been the right thing to do. And we'll continue to monitor the situation and see that we're always going to be able to cope with the circumstances that we are in.
What are the conversations like with European governments at this point, Johan? I think you've extended the payment terms for some of the help you've got from the UK government. Are you looking for further assistance from the German government?
Well, we're speaking to almost all the governments across Europe where we operate as well, to make sure that we can be recognized for the value that we provide and that we can get the support that is available out there. And we have been given support also from a number of governments that is out there, and we'll continue to do so. Aviation and EasyJet in these markets are, in many cases, a vital part of the infrastructure, and it will contribute tremendously to the economy when the recovery is going again. So that's why it's important to make sure that the whole of the sector is also there and intact when the recovery comes, because it would be, absolutely crucial and critical to help the recovery of the economy in these countries.
Are you going to see any of that European government support forthcoming, do you think, Johan? Should we look ahead for news on that?
Well, like I said, we've been accessing liquidity and also support from various governments via furlough system and an equivalent system as well. And that is a discussion that we are continuing to have with governments really across the whole of Europe. And we need to do that because we still don't know the extent for how long this will continue. In terms of the travel restrictions, we've seen some good news coming out lately in terms of the vaccine. But once again, the prudent thing is to plan, to be conservative, but preparing yourself also that you're there to bounce back strongly when the recovery comes. And that means that we also need to have funding in place. And like I said, I think we are in a good place for the time being, but we will continue to have discussions and look at the options that is available to ourselves also going forward.
Some airlines might come onto the market at this time, Johan. We're seeing talk of M&A in the Spanish sector, for example. Is M&A out of the question for a business like EasyJet because of the tough time that you're going through at this point? Or can this be an opportunity to buy up smaller rivals?
Well, I think the focus for ourselves at EasyJet, and I actually do think that is the primary focus for almost all the airlines that is out there, is really to manage and control the things you can control yourself. And in our case, we're taking swift and decisive action in terms of reducing the cost, managing the cash burn, and then also getting access to liquidity. So it's not entirely clear and apparent to me that there will be a lot of M&A, activity going forward from now, because I think that everybody's focused on dealing with what they have at their hands. But you never know these things. But I do think that what I've said earlier is that strong players such as EasyJet is going to come out stronger in this, and weaker player will come out weaker or potentially disappear. So it's not apparent either that there needs to be M&A activities in order to see changes into the competitive landscape, because some airlines will perhaps not just make it.
The lobbying force for the sector, or the lobbying message for the sector, Johan, has been very much around rapid testing at airports and where and how can that be implemented. Do you see that coming in any shape on any of your routes meaningfully soon?
Well, we certainly hope so, and we're waiting to see what the final recommendations will be here of the task force in the UK, as an example, when it comes to things like testing, and then also quarantine, and then also, how quickly we can see a rollout of the vaccination program. I've written to the Prime Minister in the UK here yesterday and offered the support of EasyJet. We have the largest fleet in the UK, and we have up to 4,000 of our fantastic crew that could be helpful in distributing and administrating this vaccine. And I think the more we can do and work together with all the stakeholders, airports, airlines, governments, and everybody involved in this to make sure that we can get these measures in place, the sooner we will see recovery taking place. And that's where the focus is from our side.
That's an interesting thought about the role that your employees could play at this time. Johan, just finally, when we think about the size of the industry, the size of the aviation industry, the low-cost industry in Europe going into this crisis, do you think it will be structurally smaller on the other side of this pandemic?
No, I don't think so at all. And I think that, we're going through different phases in this crisis. I think we're into the phase now where it's about the pandemic. It's about the infection in itself. And when that becomes under control, we're going to see then the recovery. And that will be more similar to previous downturns that we've seen in the past. And we know what's going to happen in downturns. We know that short haul will recover quicker than long haul. We know that leisure and holidays will recover quicker, the business travel as an example. And we know that people and customers will gravitate towards brand that they trust and that represents value for money. That has been the same trend in all the downturns. And those are really the core foundations of EasyJet's strengths, which makes us believe that we're going to bounce back from this very strongly. But I don't think for a minute that the sector, when we come out of this, is going to be smaller in years to come. What we don't know exactly when it's going to bounce back to, for instance, 2019 levels. I think most industry commentators have reckoned that would be around 2023 as an example, but it can come sooner and it can come slightly later, but we know it's going to happen. And the underlying demand for travel and flying is very, very strong. So when the restrictions are lifted or removed, we're going to see the recovery coming back again.
Johan, thanks so much for joining us. Really good to get your perspective this morning. Johan Lundgren, the CEO of EasyJet. Let's get up to date with your first word news stories. Here are some of the top stories we're covering for you here at Bloomberg this morning. Now, in Germany, Chancellor Angela Merkel has failed to push through a slate of tougher restrictions to tackle the pandemic. She's postponing major decisions until next week after being unable to reach a deal with regional leaders. Instead, she's urging people to limit public and private gatherings. Flexible working could be the solution for businesses struggling to recruit women into senior roles. That's according to a new study by Zurich Insurance. Women applying for management jobs jumped 20% after the insurer advertised the roles with part-time and job share options. As a result, the number of women hired for senior positions jumped by a third. 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Quick check on where we are on these markets then. In terms of the futures picture, the futures for Europe have looked a little sluggish through the Asian session, and European futures continue to point to the downside. US futures look a little more mixed, only flattered by Nasdaq futures, though. In terms of the pound, this move to the upside, just a fraction of a move to the upside we were seeing earlier. In fact, actually, some of that has pulled back. 132.04, fairly flat, really, on the pound. Now, Citi says the dollar could drop by 20% next year amid the vaccine optimism. But TD Securities says before any weakness, watch for dollar strength. Here to help us chart a course through the greenback is Juliet Sali in Singapore. Juliet, what are you hearing then on the dollar?
Yeah, stay tuned, Anna, because it's a bit of a whirlwind. But yeah, before we do see that, Bank TV Securities is saying you should see some dollar strength. You were just talking there to EasyJet, and they were hopeful of more mobility. But as we do see, most people still grounded, and a pickup in virus cases, particularly in the US and in Europe. TD Securities is saying you could see a comeback in the dollar, which is down by around 1.5% over the last month, and they're saying it could pick up by around 2% over the next month. They're recommending recommending being long the US dollar against the Canadian dollar and saying that the euro faces downside risks. As we know, though, the dollar index down around some 11.5% since its peak in March. And Citi is now saying you could see some even further weakness coming through in 2020. When you look at my chart, they're saying that this vaccine distribution, these hopes of vaccines being spread out globally, will check off all of their bear market signposts, allowing the dollar to follow that similar path to what it experienced from the early to mid-2000s, which is what you can see in that red bar there. They're saying investors should subsequently go long on the Australian and Norwegian krona. Both are commodity-linked currencies that could benefit from a cyclical global recovery. And Citi saying that in addition to the impact from the vaccine breakthrough, meaning that the dollar is likely to have this very substantial decline of some 20% in 2021, the likelihood that the Fed will remain dovish as the global economy normalises will also put some downward pressure on the dollar. So that's the longer-term outlook. But in the shorter term, if you follow TD's call there, Anna, a 2% upside for the dollar in the next month.
OK, I'm busy writing notes. Juliet, thank you very much. Juliet Sally there in Singapore on the dollar. Up next, Moderna says its treatment is 94.5% effective. The news sent US stocks to record highs. We discuss the details up next. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. A busy morning, but still 13 minutes to go until the start of the European equity trading session. European futures point modestly to the downside. Now, Moderna's vaccine is shown to be 94.5% effective during its large late-stage trials. CEO Stefan Bancel told us what sets his vaccine apart.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
Joining us now for more is Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. Sam, very good to speak to you. Friend of the programme, of course. So really great news then coming from this vaccine news flow on top of the Pfizer and BioNTech vaccine news flow in terms of stopping bad cases of the virus. Tick. We seem to have vaccines that can do that, which is incredible. What does this tell us about their ability to stop transmission? I understand it doesn't tell us much. And how important is it that we understand whether these vaccines can stop transmission?
Yes, good morning, Anna. So obviously it is great news, but as you rightly say, we need to know whether these vaccines are able to reduce the transmission of the virus from one person to the next. Given that they are making the disease less severe, we know, for instance, in the Moderna trial, there were no severe cases on the vaccine, whereas there were 11 on the placebo group. Then there's a likelihood that there is a lower transmission, but we won't know the answer to that. We know that asymptomatic patients can transmit the virus, but we won't know the answer to that because I don't think the trials were designed to actually answer that question specifically.
And another thing we perhaps won't know very much about is safety. We'll know enough about the first few months, what happens in the first few months after being vaccinated, because that is what the trials are all about. In your experience, when it comes to vaccines, is that all you need to know? Do any negative side effects typically emerge in those first few months after you've been vaccinated? So we don't particularly need to worry about things that might happen years ahead. Or is this an important part of the jigsaw that we won't know at the time that we administer this vaccine?
Yeah, so that's another excellent question, Anna. And I think you have to consider the fact that with any drug development, what you do with your trials tries to answer the question of are there any obvious, worrisome, acute side effects, things that you hadn't thought about. And then with any drug, especially a vaccine, you just then have to wait and see how that pans out. And unfortunately, even though these trials are done in 30,000, 44,000, 60,000 people, the full answer to that, for very rare cases of side effects, only come out over a year or two or three or four in large populations. That's just the way it is. You can't short-circuit that one.
Sam, thanks so much. Really important to get your details on these stories. Sam Fazeli of Bloomberg Intelligence, thank you very much for joining us. Minutes away then from the start of the European equity trading session. Up next, we'll get your stocks to watch, including EasyJet. We've just been speaking to the CEO of EasyJet. A lot of uncertainty still about the winter, it seems, but he suggests the balance sheet at least is in a good position, well positioned into the winter. We will talk about what to expect from the European trading day ahead. This is Bloomberg.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
Welcome back to the European Market Open. We've just got minutes to go, 7 in fact, until the start of the cash equity trading session for Europe. Let's get to your stocks to watch. Danny Berger joins us for a rundown. Danny.
Anna, I know you were just speaking to EasyJet, a fascinating conversation with the CEO telling you that he saw immediate demand with the virus vaccine news, but still needed testing for Christmas travel to really be saved. Though in terms of the stock market reaction, we are seeing them called lower by as much as 5%. Their liquidity might be better with the UK loan, but still slipping to a 2020 loss, posting a £835 million loss for the year through September. Imperial Brands, on the other side, forecasting a return to growth slightly ahead. It was able to raise some of its prices on cigarettes by about 6.7%. Vaping business also helped reduce its losses. And quickly, Anna, Iliad, the French telecom company, called up by 2%, shaking off some of the effects of the pandemic. It had more subscribers, so that really helped offset what it saw in terms of losses on roaming fees in terms of France and Italy. Of course, roaming fees really dropping with people not really traveling. But those subscriptions really ramping up, helping Iliad meet their estimates. Anna?
Thanks very much, Danny. Danny Berger with a look at EasyJet, Imperial and Iliad, some of the stocks that could be on the move this morning. The big picture story is, of course, that European equity market futures point to the downside, but only modestly down around 3 or 0.4%. So we'll see if we get that downside move at the open. The US futures look a little more mixed. Yes, they're negative on the Dow and S&P, but positive on the NASDAQ. So we'll see where the US session takes us. A lot of focus on the extent to which various states in the US will introduce new, tougher measures through the Northern Hemisphere winter. Plenty to talk about in our next conversation then with Grace Peters. The Open is up next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Minutes to go until the start of cash equities trading here in Europe. Here are your headlines. Value play. The global rotation picks up pace as optimism grows over a vaccine. But European futures slide as US state lockdowns pick up pace. Landing zone found. Ireland's Prime Minister tells Bloomberg he's not convinced Boris Johnson truly wants a trade deal. The pound erases its gains. And EasyJet posts a loss for the year. CEO Johan Lundgren tells Bloomberg he sees some European carriers exiting the market. Good morning, everybody. So the European equity session then for this Tuesday morning, just a minute or so, less than a minute away. And in terms of the futures, we were expecting to see a negative start to the European trading session. Concern really about the ongoing fight against the virus. Yes, we've seen vaccinations drive optimism in markets, drive rotations, drive risk rallies in markets, but still we have underlying concerns around just how bad things get for the winter. How much are we able to look through that? We'll see. In terms of the European equity market space, then this is how much we open to the downside right now. The FTSE 100 down around 0.2%. Some earlier optimism in the pound has been unwound. 130, 132 is where we trade right now, fairly flat. So that not much of a game changer for where we are on FTSE 100 trading right now, but the FTSE is down by 0.3%. That's the early mover on these markets. The IBEX also down just 0.1%. That's interesting in itself, given the large moves in Spanish banks we saw yesterday, the large moves in the IBEX that we saw this time yesterday. The CAC and the DAX making very modest moves to the downside, down just hundredths of a percent. European equity markets then opening modestly lower. That's after the S&P 500 closed at a record high following the news about Moderna's vaccine. Joining us now is Grace Peters, JP Morgan Private Bank Head of European Equity Strategy. Grace, really good to speak to you. I wonder if you could give us the context or the size and scope of the significance of the vaccine news we've had over the last couple of weeks from Pfizer, BioNTech, and now from Moderna as well. Is this something that prompts a wholehearted rethink of your exposure on European equity, or is it just tweaking at the edges? What is the size and scope of this for you?
So we think that we're in a recovery phase across global equity markets. Global equities will move higher over the next 12 months. But as they go up, you will see this broadening out of leadership. Leadership thus far has been extremely concentrated around growth equities. And we do think there's room for more cyclicals to also participate in the rally. And this is something we've been saying for a few months, actually. We've been advising that clients balance portfolio, adding cyclicality to complement areas of structural growth, and news around the vaccine and indeed greater clarity post the US election also just lend itself to the idea of a bridge to more normal economic growth, economic recovery, slightly higher bond yields that also help equities and help this more cyclical rotation. But we don't think it's about, cutting growth altogether. Growth and technology around digital transformation is still a key part of our conviction. But it is an acknowledgement that COVID has changed the investment landscape. There are new areas of growth that you can invest in, particularly those with an environmental tilt. And there's also parts of the economy that have been very heavily impacted by mobility restrictions that we've seen and may still be upcoming in some regions as well. And some of those parts of the market do look oversold when you start to bridge towards normality.
What is the relationship, Grace, that you see between value and 10-year yield? Of course, a lot of people point to rising bond yields as something that lifts banks' profits, and therefore value stocks tend to move in conjunction. I know that you've been looking at some charts recently that show value versus momentum and how that is indeed driven by 10-year treasuries.
There's a very strong correlation between bond yields and value equities. And you mentioned, Anna, financials, energy, also autos, mining, construction. There's a whole group of equities that tend to move very tightly with US 10-year yields. We expect bond yields to move up. Our target is 1 to 1.25% over the next 12 months for US Treasury yields. And therefore, that will help this more cyclical rotation. But I think it's not as simple as just looking at historic correlation predictions and extrapolating that going forward. In the world post the pandemic, there have been seismic changes and some sectors simply won't fully recover, even when we have a vaccine and that is mass distributed. So I think one has to be a little bit selective when picking the cyclicals or the value equities that one wants to re-enter. We like cyclicals that have also got some structural tilt. I mentioned environmental trends. We think the energy transition's had a huge boost from the COVID pandemic and also from various government commitments that have been made over the past 6 months. And when you use that as a pillar for making investment decisions, you can actually get really nice cyclical exposures through capital goods, through some semiconductors, utility companies, as well as construction. So we'd certainly be watching 10-year government yields, but we don't think that's just the be-all or end-all when it comes to choosing which parts of the market to rotate into.
And so, Grace, which are the parts of the market that you think will not fully recover then? Because a lot of people talk about, travel and leisure and tourism and all of those things as being obviously depressed at this point. But do you think they don't recover? Is it a subsector of that won't recover? Or is it retail? Where are you focused on sectors that won't rebound?
I think, I've mentioned the energy transition, and therefore the flip side of that is energy equities. Oil equities would be an area of the market that we think, still has quite secular challenges to it. Will the oil price recover as a vaccine is distributed? We expect yes. Will energy equities therefore rally off the back of that recovery in the oil price? Yes. But when we look around at the longer term picture, the fact that the energy transition, the shift away from fossil fuels towards renewable energy just makes economic sense. And you're seeing governments from China, Japan, the UK, obviously Europe with the EU Green Deal announced a few months ago, and potentially now the US under President-elect Biden, all pushing to accelerate the energy transition, then we do have a degree of caution when it comes to some of the oil equities, because they need to invest to make their businesses future-proof, and they need to balance that capex spending with the need to manage cash flows and pay investors a dividend as well. So that would be one area that we would certainly focus on. And as you say, Anna, airlines also, again, linked to the energy transition, the fact that they need to decarbonize themselves, as well as perhaps some structural changes around businesses having set employees up to work from home and made that investment and made it part of their resilience planning. There's little pockets that we must consider when we're thinking about what normalized earnings look like.
OK, and do you expect to see market volatility decline or increase from here, Grace? With some of the vaccine news, we see volatility perhaps of a positive nature, at least markets going higher in a hurry on some of the vaccine news flow. What are you expecting from volatility? And if we see dips, is that a good opportunity to buy here?
Yes, I think volatility will feature because, as we're seeing, again this morning, you've had some more positive vaccine news, but still the market looks ahead to lockdowns in Europe that are obviously happening now, and potential lockdowns in the US and other parts of the world that undoubtedly could impact near-term economic growth, because of course the vaccine doesn't really do an awful lot for the next quarter's worth of corporate profits, even if it does give us more confidence looking later down the line. So volatility is likely to still feature. We would be using those periods of volatility to add some of these cyclical equities that we've spoken about, but also not forget the growth component and the technology component. If one sees a drawdown in technology stocks, which we saw going into the US election, and obviously we've seen a rebound since, but we still think that technology is going to deliver some of the best growth over the next decade when it comes to equity earnings. And obviously, whilst we're talking about a rise in US Treasury yields, it's still off a low base and to ultimately a low number in a historic context, around 1.25%. So the backdrop still remains low growth, low inflation, low rates, which supports these longer dated growth equities, because growth is ultimately still scarce when it comes to investments across multiple asset classes.
Grace, thanks very much. Stay with us. Grace Peters, JP Morgan Private Bank Head of European Equity. We'll get further thoughts on strategy next. We'll get to Grace's thoughts on which sectors to indulge in right now and which to avoid. We're just getting some lines coming through from the German Chancellor, Angela Merkel, saying the pandemic situation remains very serious. The pandemic measures are among the toughest decisions in her time, she says. Virus numbers are too high. Contacts must be reduced. This in the context of the difficulty she's had in extending some of the more recent lockdown measures. More from Grace in just a moment. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
That was Bill Clinton, former US president, speaking to Bloomberg at the New Economy Forum. Now, EasyJet has reported its first ever annual loss amid the pandemic, but CEO Johan Lundgren told me the prospect of a vaccine has already boosted consumer confidence in the airline industry.
The announcement of the vaccine, the news of that, we saw an increase in bookings quite significantly. So it shows that the underlying demand is really, really there. And hopefully we can see a strong recovery coming very soon.
Grace Peters, JP Morgan Private Bank Head of European Equity Strategy, is still with us. And it's interesting because I asked Johan there, Grace, about whether he thought that the aviation sector and perhaps the leisure part of it, the low-cost part of it, might be structurally smaller on the other side of this pandemic. And he didn't seem to think so. He thought underlying demand was really strong and that it would bounce back to 2019 levels. Let's talk about some of the sectors that maybe are challenged by the energy transition. Do you see the future of aviation in the same way as the CEO of EasyJet there, Grace, or do you have a slightly different view?
I think that there's obviously pent-up demand on the consumer and the business side, but I also see that when we think specifically about the energy transition, the airlines industry, when it comes to the European Economic Area, contributes about 4% to greenhouse gas emission. And obviously, we're seeing huge seismic shifts when it comes to attitudes towards climate change, the energy transition. A lot of that is driven by the fact that renewable energy just makes economic sense. Over the last decade, the cost of wind and solar generation has come down materially, some 80% fall in the cost of electricity generated renewably. And now in many regions, renewable energy is actually cheaper than energy generated by fossil fuels. So when you get to the point that it just makes economic sense, you're now seeing governments come in and really accelerate that drive. The EU Green Deal really led on that front. But it's not just Europe. When we look at China's recent commitment, Japan, the UK, all moving in the same direction. And perhaps Biden re-entering the Paris Agreement is something that he's focused. So again, a real pivot in the US towards clean energy and climate change, then that is incredibly powerful. So for sectors like the airlines, but across the board, actually, investors need to be looking at carbon emissions and the potential for, whether it be through higher taxes or other ways it impacts the cost of debt, for that to impact all sectors of the market.
And when we look at the winners from the energy transition, Tesla, of course, incredible gains this year, now looks set to enter the S&P index, that coming in the middle to late December. Is that the way that you want to play the energy transition, through those sort of pure play businesses? Or are you looking at companies that used to do something else and are now getting the message on energy transition? How are you playing this, Grace?
I think you can play it through both, and sort of whether you're talking about the shift to electric vehicles or indeed the generation side, the supply side, where you've got some highly rated utility companies in Europe and in the US. Then I think that when you're talking about the pure plays, whichever sector they fall in, then you've obviously got companies that are quite highly rated, but highly rated for a reason, because they're really driving that push into new addressable markets and delivering superior revenue and earnings growth. So I would absolutely invest in those pure plays to get that superior, sort of revenue exposure. But there are a number of companies, if we take the utility sector or indeed the auto sector, that have undergone a period of transition. Businesses that have been investing for the last 10 years to get them to a point now where you can start to see either renewables be a higher percentage of their mix, or indeed on the auto side, hybrid or electric vehicles starting to be increasingly more meaningful. And certainly, we're at that inflection point where it will be a material contributor to corporate profits for, say, OEMs over the next 5 to 10 years. And therefore, if you invest in these companies in transition, you can not only get the revenue, the earnings growth, but also a re-rating potential as more and more of their business becomes impacted by these, the newer trends around the electricity, the energy transition. So I think there's opportunities in both.
Grace, thanks very much. Grace Peters, JP Morgan Private Bank Head of European Equity Strategy. Grace will be continuing her conversation with Caroline Hepker and I on Bloomberg Radio at 9 a.m. UK time this morning. Let's get a Bloomberg Business Flash then. Some of the top corporate stories that we're covering here at Bloomberg. The Spanish bank BBVA is in takeover talks with rival Sabadell to create one of the country's largest lenders. The move comes a day after BBVA announced it was selling its US-armed PNC Financial. That gives it the firepower for a deal and boosts its capital ratio. Airbnb has filed for its IPO, outlining widening losses and plunging revenue due to the pandemic. But it's projecting optimism for a rebound in demand when the economy does recover. The listing is set to be one of the biggest this year. Sources tell Bloomberg the company plans to raise as much as $3 billion. Santander is buying technology assets from Wirecard as the German payments company winds down its operations. The sale marks an end to the dissolution of Wirecard. The deal will help Santander build its global payments platform. About 500 employees who manage the technology will remain with the unit. That is your Bloomberg Business Flash. Coming up, landing zone identified. Ireland's Prime Minister says the shape of a Brexit deal is becoming apparent. That exclusive interview next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Our aim was from the beginning to have a portfolio of 6 to 7 potentially safe and effective vaccines. We've signed with AstraZeneca, we've signed with Sanofi and Johnson & Johnson. We will leave no stone unturned.
The big thing was preventing a financial collapse. The central banks acted definitively to do that. That's all that was ultimately historically important. The mistake is for them to vastly exaggerate their continuing relevance. They lack, starting at the zero bound where we are, the capacity to provide meaningful impetus to their economies in any way that is consistent with any concept of central bank functioning. They do not have the capacity to meaningfully affect the degree of inequality. They do not have the capacity to vaccinate people. They do not have the capacity to fight climate change. And they need to acknowledge the limitations of their influence.
Really interesting comments there from Larry Summers, former US Treasury Secretary, speaking to Bloomberg at the New Economy Forum on the limitations of central bank influence and activity. Now, the UK is calling for more realism in Brexit talks with the EU. It says while some progress has been made, there is still a lot of work left to do. Speaking at the New Economy Forum, Ireland's Prime Minister Michael Martin said the contours of a Brexit deal are clear to both sides.
I would still hope there will be a comprehensive trade deal, but it will be challenging. And the three items that have been there now for quite some time, the three issues of a level playing field in terms of access to the single market in Europe, with the UK agreeing to adhere to that level playing pitch, that's proving problematic. My understanding is, my sense is if that got sorted, the area of a dispute resolution mechanism would get sorted then in terms of how does one arbitrate as to the behaviour of each party to the agreement. Thirdly, the fisheries is proving very difficult as well. A lot of progress has been made on other issues. my sense of if there's a political will in the United Kingdom to get a Brexit deal done, then it will happen. I think the European Union want a deal. Of that, I'm clear. Not at the past, but it's our view, and it's Ireland's view as a member state, that it is in the interest of our citizens and the respective economies to get a deal that makes sense. And no deal would be very damaging to our respective economies. Logic dictates we should do everything we possibly can to get a deal. It's a responsible thing as politicians to do on behalf of the citizens that we represent.
But we now have an incoming US president who's made very clear his views on the Good Friday Agreement and the importance of there not being a hard border between Northern Ireland and Ireland. Do you think that changes the calculus? Do you think that makes it more likely that Boris Johnson would compromise with the EU?
I think it's helped. I mean, I spoke to Joe Biden during the week. Very warm, clearly very proud of his Irish heritage, and makes no secret of that. And we're looking forward to his presidency, to be frank, from that perspective. But I think the more broader issue is the prospects of a Biden presidency being more multilateral in its thrust and its impulse. That was clear from my conversation with the president-elect that he was going to engage with Europe. Now that's probably more significant in terms of the impact on the UK's response, because it seems to me that the United Kingdom values its relationship with the United States and vice versa. I think President Biden-elect would too. And so therefore, I think the US, the new presidency, would prefer a deal between Europe and the UK. I think the UK is conscious of that. And the president-elect is very committed to climate change. I think Boris Johnson would like him in Glasgow, for example, for the COP. So I can see an alignment of interests here, sparked by the president's commitment to multilateralism and to resetting, if you like, the sets of relationships between the US and Europe that might be better, or might enhance the prospects of a deal.
But there has been, I mean, you've said in the past that both sides have to compromise in order to reach agreement on those three things. But there has been some question about whether the European Union feels like it now has to compromise, given this change of emphasis from the US. If Boris Johnson now feels more pressure from the US, and maybe that trade deal with the US being in doubt without a deal, does Europe need to compromise at all?
Well, look, I think I wouldn't overstate that. I think Europe wants a deal. And I think also it's in our interest that there would be a comprehensive trading deal between the UK and the European Union.
That was the Irish Prime Minister Micheál Martin speaking at the Bloomberg New Economy Forum. Let's take a quick look at your movers. Sabadell, the Spanish bank, that stock is on the move once again. It was up strongly yesterday. Lots of talk about BBVA, and they have in fact confirmed their interest there. Imperial Brands also on the move on the back of their numbers, up by 2%. Fortum higher, 1.4% gaining after third quarter earnings. The Mayor of Greater Manchester says 3 million people in the UK have been excluded from the government's financial support during the pandemic. We will speak to Andy Burnham next. This is Bloomberg.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 30 minutes into your trading day. This is what we have for you on European equity markets right now. Moving in terms of the European equity story, we are moving, well, we're not actually moving very far at all, are we? I was going to say moving modestly to the downside, but barely worth a mention. Eurostoxx 50 fairly flat. We're flat in Paris, flat in Frankfurt, a little bit of downside in London. Let's get a Bloomberg First Word News update. Here are the top stories that we're covering this morning at Bloomberg. The Trump campaign is withdrawing a key part of its lawsuit against the election result in Pennsylvania. It is abandoning demands that almost 700,000 mail-in ballots be thrown out because observers were kept too far away from the count. The challenge is now against a far smaller number of ballots, almost certainly just a fraction of Biden's lead in the state. The strongest storm of hurricane season has hit Central America. It made landfall late on Monday in Nicaragua, bringing catastrophic winds and torrential rain. At 155 miles per hour, its winds are powerful enough to crush homes, snap trees, and make areas uninhabitable for months. Flexible working could be the solution for businesses struggling to recruit women into senior roles. That is according to a new study by Zurich Insurance. Women applying for management jobs jumped 20% after the insurer advertised the roles with part-time and a job share option. As a result, the number of women hired for senior positions jumped by a third. 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's talk about the latest vaccine news. Moderna's vaccine is shown to be 94.5% effective during its large late-stage trials. The CEO, Stefan Bancel, tells us what sets his vaccine apart.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too to keep in mind is our vaccine does not require dilution.
Joining us now with thoughts on the latest vaccine news flow, Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. Good to speak to you then, Sam. Really good to get your thoughts. This has been a good 2 weeks for mRNA, so the messenger RNA vaccines, that's the type that we're talking about here with Moderna and also with Pfizer and BioNTech. This is exciting, I suppose, beyond just the pandemic, and it is exciting enough about the pandemic.
Absolutely, Anna. I mean, the beauty of this platform, if it holds up to longer-term scrutiny in terms of how long the protection lasts, is that if God forbid we had a mutation that showed an ability to escape the vaccine, there could be another version of it developed very quickly. So that's where this really helps manage not just this pandemic, but potentially any other pandemics. Of course, they have to be studied when they happen.
Yeah, indeed. And interesting to see if it applied to other diseases that we talked about. But that's a story perhaps for another day, because, of course, the market and everybody's fascination and interest lies in the vaccine at this point. In terms of the longevity of protection that vaccines provide, is there a rule of thumb as to how worth it is to do a vaccine based on the amount of protection it provides? Like if a vaccine provides just 3 months of protection, is it worth doing? Obviously, if it provides a year, perhaps it is. I ask this also because we don't know. There's a lot we don't know about antibodies. We've got the Prime Minister of the UK self-isolating, even though he's already had the virus. He had it in the spring. I wonder what the latest thinking is on how long immunity lasts.
Yeah, I mean, there's a lot of questions in what you've just said. If I've had the infection before and I have been exposed to somebody, I may not get the disease, but I may still be a possible vector for the virus, in that it might still replicate in me, and if I speak and cough and sneeze, give it to other people. So that is something that why people have to self-isolate. What we need to figure out with vaccines also is whether people are still infectious once they've had the vaccine. That still has to be worked out. But in terms of durability, I think the data is strong enough today for us to not worry too much about how long this protection lasts. The question is how quickly can the virus evolve around the vaccine.
Okay, yeah, another question for another day. Sam, thanks so much. Thanks, sir, for joining us. Sam Fazeli from Bloomberg Intelligence. Prime Minister Boris Johnson has come under fire for reportedly telling a virtual meeting of Conservative MPs that devolution in Scotland has been a disaster. He also reportedly described it as former Prime Minister Tony Blair's biggest mistake. Joining us now is Andy Burnham, Mayor of Greater Manchester, somebody who no doubt has some thoughts on this devolution, also extending to some of England's cities and regions, of course. Andy, very good to speak to you today. I know you want to talk about those who've been excluded from help from the government through the pandemic, and we'll do that in just a moment. Let me get your thoughts first, though, on these comments from Boris Johnson around devolution. Devolution, a disaster. He wasn't necessarily referring to the whole devolution process, maybe just the way it's been used to push for independence in Scotland, which one might understand would upset a UK Prime Minister.
I think, to be fair to him, that's what he was saying, although they did feel a little off the cuff, and you could apply a sort of more broad interpretation, which would be worrying to me. As Mayor of London, Boris Johnson called for the devolution of power out of Westminster to the English regions, London in that case. I mean, I am making exactly the same argument as he did when he was mayor. You know, we do need to see power taking out of Westminster put closer to people, particularly in the regions of the north of England that often feels the same way as Scotland and Wales, that we are kind of subject to London-centric policies out of Westminster. So I would say to the Prime Minister, that is the best way to secure the UK in the long run. Create a better balanced UK, healthier in terms of the politics, less of a sense of alienation amongst people about what comes out of Westminster. So I think he needs to be careful now to clarify his remarks. I don't think it will have gone down well in Scotland for the Scottish Tories, because it gives independence a bit of a boost, unfortunately, comments like this. But I just hope he will now kind of set out clearly what he believes when it comes to devolution, because in my view, we've seen this year the limitations of trying to run everything centrally from government. It doesn't work well, and it's time for the UK to adopt a different form of governance.
Do you think that the virus will be a catalyst for further devolution, and over what timescale then?
Well, it should be, because obviously, as I was just saying, you know, if you over-centralise policy and you try and run everything from Whitehall, it doesn't work very well. And we're seeing that with the test and trace system. If we'd had that under control, we would have had teams out on doorsteps having conversations with people face to face. When Whitehall sets it up, they kind of outsource a massive contract. It's all about call centres, and surprise, surprise, it doesn't work very well. So you know, that, in a very practical way, is the difference between over-centralisation and localisation of decision-making and services. And I would argue that had we gone down if we'd localised rather than centralised at the start of this pandemic, we would probably have mounted a better response as a country.
Andy, I know that you've been writing about those who say they've been ignored by the government through the pandemic, those who have not received as much money as other parts of the community. Is this around those who are self-employed, who are maybe difficult for the system to target? Who is it that you think has not been paid enough through this process?
Well, there are 3 million people in all, and they're people in different categories. People who are PAYE freelancers, so people who pay their tax at source, people who have become newly self-employed, so haven't yet submitted a tax return, people who are paid as company directors of small businesses. When you add them all together, they amount to a lot of people. And to be honest, I don't buy the excuse that we're hearing from the government that it's all too complex to help these people. They are taxpayers. So we could go to what they've paid in tax over the years and see how they've been harmed this year. So I am calling on the Chancellor, who's making a spending statement a week tomorrow. You know, there will be 3 million people across the UK hanging on his every word. They are desperate for help now. And it's no exaggeration to say that jobs, homes, marriages, lives even depend upon what he's got to say. Because myself and the Mayor of Liverpool City Region, Steve Rotherham, we had a meeting last week with the campaign group Excluded UK. We met many of the people who've been affected in the Northwest. And, you know, it's quite heartbreaking actually to listen to them. And the truth of the matter is we have a growing mental health crisis here on top of a pandemic. And it's why the government really does now need to step in to help them.
Yeah, with that in mind, do you think that the lockdown measures should continue past early December? This, of course, an England-wide policy at the moment, the second lockdown that we're currently in. Do you think that those measures should be extended?
Well, I think we're going to have to see where the cases are, aren't we? But I do have a real problem with the idea of putting people under perpetual lockdown or restrictions. The World Health Organization is very clear that lockdowns and restrictions shouldn't be used in that way. They should be used as a short, sharp break to get cases down, but not sort of always in force. And I think what's happening here is the government are going for sort of halfway house restrictions that are just never lifted. And I think, as I say, that adds to what I was saying a moment ago about a growing mental health crisis in the country. So I would say we need a bit of a rethink here. We need to be more targeted in our use of these restrictions. You know, close down problem business premises, not all business premises. Encourage more compliance with face coverings when people are out and about, but perhaps not always go for the blanket restrictions approach. So that's the message that we've been giving to the government from Greater Manchester, and I very much hope the government will listen.
Andy, thanks very much for joining us. Andy Burnham, the Mayor of Greater Manchester. Time for something entirely different. 42 minutes into the European equity trading session, European equity markets look to the downside, but not by much. Let's turn to what hedge funds are doing with their money. It's 13F season. Among the investment giants reporting their third quarter holdings overnight was Warren Buffett's Berkshire Hathaway. Berkshire's filing reveals a big bet on vaccine makers. Joining us now to discuss is Danny Berger. Danny, good morning again. So what stocks or which stocks did Berkshire buy over the quarter?
And there's a really distinct flavor to Berkshire's bets, and this reflects what Warren Buffett himself has said earlier this year. It's caution over the U.S. economy, but they initiated new positions in stocks that would benefit from a vaccine. So just months before Pfizer announced the effectiveness of their vaccine, Berkshire added a new position to Pfizer, as well as Merck, which is currently developing a COVID vaccine, as well as some other pharma companies you can see there. Now, in terms of what they sold, it was all about financials. Berkshire Hathaway well on its way to completely exit JP Morgan and Wells Fargo, reducing positions by as much as 96% in some cases, also slashing some local banks as well in terms of exposure. Again, this reflects really some of the bearishness that Warren Buffett has on the U.S. economy.
And sticking with the US and the US equity story, we heard just overnight that Tesla is set to join the S&P 500 the 21st of December, I think, Danny. What sort of effect will that have on the benchmark?
Well, look, Tesla's huge. It's set to be one of the biggest companies at $390 billion of market value to be added into the S&P 500. And of course, that's a disruptive event. Asset managers who track the benchmark would have to sell about $40 billion worth of other equities to make space for Tesla. So Dow Jones, S&P themselves have gone out to investors and said, hey, should we do this in two phases? They're looking for feedback right now to ease the transition of Tesla into the index. Of course, with that index comes about $11 trillion of passive investments. And that's part of the reason why we saw Tesla have this huge move overnight once the news was announced, because investors will have to track that index, will have to buy into Tesla. It can also help the S&P 500. Look how much better Tesla has done than the benchmark. This is part of the reason the NASDAQ 100, which has Tesla, has outperformed the main U.S. equity gauge. I should say, with that, Elon Musk's wealth gets higher by $15 billion. surpassing Mark Zuckerberg to become the third richest person in the world. I mean, what a week it's been for Elon Musk between a coronavirus diagnosis, SpaceX launch, and now this latest with the S&P 500 inclusion of Tesla, Anna.
That is incredible. My week looks incredibly pedestrian by comparison. Danny, thank you very much. Danny Berger with details on Tesla and beyond. Up next, with US-China relations at their worst in decades, we will hear from speakers at the Bloomberg New Economy Forum about the way forward from here. This is Bloomberg.
A competitive approach to China was inevitable, but keeping it healthy and not pernicious is vitally important, and that won't be easy.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
But what I do believe both sides are capable of through the highest level diplomacy at an early stage of the Biden administration is to define the parameters.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
The American administration is about to change, but the clock will not simply be rewound.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
Unfortunately, some forces are acting against the trend of the times. They have trumpeted the decoupling and willfully walked away from international commitments, posing challenges to multilateralism.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
Just some of the really interesting views expressed by guests at Bloomberg's New Economy Forum, giving their take on US-China relations. And coming up later at the New Economy Forum, ECB President Christine Lagarde will be joining the proceedings. Don't miss that conversation at 4 p.m. London time. Let's get a Bloomberg Business Flash. Some of the top corporate stories we're covering for you here at Bloomberg. Tesla is joining S&P 500 next month as its largest ever new member. It follows months of speculation which helped the company's valuation skyrocket to almost $390 billion. It will be one of the index's most influential members, with a weighting similar to that of Berkshire Hathaway or Johnson & Johnson. The Spanish bank BBVA is in takeover talks with rival Sabadell to create one of the country's largest lenders. The move comes a day after BBVA announced it was selling its US arm to PNC Financial. This gives it the firepower for a deal and boosts its capital ratio. Airbnb has filed for its IPO, outlining widening losses and plunging revenue due to the pandemic. But it's projecting optimism for a rebound in demand when the economy does recover. The listing is set to be one of the biggest this year. Sources tell Bloomberg the company plans to raise as much as $3 billion. That is your Bloomberg Business Flash. Up next, when will the S&P 500 hit 4,000? We will put that question to the Markets Live team. Christine Aquino joins us next. This is Bloomberg.
I'm a huge believer in UK financial services. It's a significant part of the UK economy, obviously employs lots of people across the country, and importantly is something that we're globally best in class at. We want to be a leader in green finance.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to the European Open. 53 minutes into a European equity trading session that looks modestly negative for European stocks, down by 0.1%. US futures negative, actually fairly mixed if you include NASDAQ. Let's get to the Markets Live team. Christine Aquino joins us now. And I want to ask you about US equities. First off, the question of the day then, Christine. When will S&P 500, when will it get to 4,000? I know you've been taking soundings on this on the Markets Live blog. What have you been hearing?
Yeah,
Yeah, Anna, I mean, it's obviously difficult to put a number exactly on when, but I think the skew as far as the responses that we've gotten in and within the Markets Live blog as well is that it is more likely to go toward 4,000 than much lower from here, and the reason being is that the sentiment in the market really is that investors are very willing to take the S&P 500 higher. Every time we get bouts of good news, and yesterday we saw that with the Moderna announcement reaction, and we did get that positive reaction as well, similar to what we saw from the Pfizer announcement last week. And so we're kind of entering this period now where every time there's a marginally positive development on the vaccine front, equities are just very willing and happy to power higher.
And what about the things you're looking ahead to then, Christine? Because I know we've got US retail sales due out a little bit later. What's the expectation there?
Yeah, I think, that is going to be really a big one to watch, especially as we're entering the holiday period. It's been a absolutely shattering year for retail, and retailers are preparing to capitalize on this sort of new environment into the holiday period where there's still a lot of uncertainty regarding lockdowns in various U.S. cities and indeed in various countries across the globe. And the concern really is that whether shoppers are going to be as willing as they have in the past to pile into the holiday shopping period. Retailers are getting creative in capitalizing on that. They're trying to cater to this sort of different environment that we're in. But the question is whether that's going to be enough to turn around really just such a dour year. I think it really will remain to be seen whether consumer sentiment or the positive sentiment that we're seeing in equity markets translates very directly into the real economy via consumer sentiment.
Christine, thanks very much for joining us. Christine Aquino, who leads the Markets Live team here in Europe. That's it for this hour of the programme. Surveillance is up next. They'll be taking you through all the highlights from the Bloomberg New Economy Forum. European equity markets on the back foot this morning. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
The rally stalls. Moderna's highly effective vaccine sends U.S. stocks to record highs, but optimism is tempered amid fresh restrictions across America. Full speed ahead for Tesla. The electric car maker is set to join the S&P 500 next month as its biggest ever new member. And U.S.-China ties take center stage at the Bloomberg New Economy Forum. Bill Clinton says Xi Jinping's long-term reign has upended relations between Beijing and Washington. We'll bring you that conversation. Well, good morning, everyone. Happy Tuesday and welcome to Bloomberg Surveillance. We have another action-packed day for you. This is what the markets are looking at. Now, the focus, of course, is firmly on the vaccine trial data that was out of Moderna yesterday. The focus is, of course, on the fact that we could have a vaccine a bit quicker than expected, simply trial data that is actually a bit better than what economists or actually what analysts and watchers were thinking. Now, this global stock rally, though, powered by hopes that the vaccines will boost economic growth, was paused. This is partly because investors are also weighing the near-term spread of the virus. I think investors are also looking at valuations, and maybe there's a little bit of profit-taking getting underway. I did want to show you Tesla. I'll bring it in my next data check, but they jumped more than 10% in after-hours trading after that announcement that it will join the S&P 500 index on December 12th, and then in other asset classes, treasuries drifting with the dollar, WTI crude oil advancing above $41 a barrel. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. The Trump campaign is withdrawing a key part of its lawsuit against the election results in Pennsylvania. It's abandoning demands that almost 700,000 mail-in ballots be thrown out because observers were kept too far away from the count. The challenge is now against a far smaller number of ballots, almost certainly just a fraction of Biden's lead in the state. In Germany, Chancellor Angela Merkel has failed to push through a slate of tougher restrictions to tackle the pandemic. She's postponing major decisions until next week after being unable to reach a deal with regional leaders. Instead, she's urging people to limit public and private gatherings. Now, the strongest storm of hurricane season has hit Central America. It made landfall late Monday in Nicaragua, bringing catastrophic winds and torrential rain at 155 miles per hour. Its winds are powerful enough to crush homes, snap trees, and make areas uninhabitable for months. And finally, 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, I promised you the share price for Tesla after hours, so promise delivered. Here it is. It gained some 12% after that announcement yesterday that Elon Musk's car maker will join the S&P 500 index after December 21st. You can see pre-market at the moment gaining some 12.3%. Now, let's get back to our top story, vaccine optimism. Moderna's vaccine was shown to be 94.5% effective during its large late-stage trials. Now, the chief executive Stéphane Bancel told us what sets his vaccine apart.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
Now, for more on the vaccine, joining us is Sam Fazeli. He's Bloomberg Intelligence Senior Pharmaceuticals Analyst and Director of EMEA Research. Sam, a lot of optimism, and this was widely expected because of the nature of vaccine, which is quite similar to what the Pfizer vaccine trial actually gave us, and that was last week. What questions do you have to make sure that this is a vaccine that works and that we can roll it out quickly?
Yeah, so good morning, Francine. The Moderna did give us actually a little bit more than Pfizer did. So we know, for example, that they prevented so far the development of severe disease. So nobody in the vaccine group had any severe COVID. And also, it looks like it also works in the elderly, which is a crucial element of the analysis. And we don't know that about the Pfizer vaccine. I don't expect it to be necessarily different, but time will tell. So the key thing that remains for all of them is obviously more details in terms of, more patients, and we could always ask for more as well, but clearly the durability of the vaccines. And that's something that it would just be nice to see that data as it comes out and we get to analyze it.
Sam, give me a sense of exactly what these vaccines are. I mean, there's a lot of misinformation or there's a lot of misunderstanding about what these two types of vaccines are, which are RNA, which are different to any other vaccine that we've had before. Is it going to be hard convincing people to take this vaccine?
I mean, people shouldn't really, it shouldn't make any difference to anyone, because all that's changed here is that rather than making proteins that you inject or pieces of the virus that then you inject into people first in a lab, you're just giving them the genetic material that allows their own bodies to manufacture it. And we have extremely delicate systems and complex systems that control all this. So there's nothing that and RNA doesn't get into your genes, doesn't do any of that. It just doesn't do any of that. It's not possible. So it just sits there and allows your cells to produce the vaccine inside your body. And the beauty of it, of course, is that it's very easy to produce another version of it. So from that perspective, I wouldn't worry about it at all.
Sam, if somebody takes a vaccine, so it means that you're less likely to get sick or almost unlikely to get sick. Can you still be, a vector of transmission? Can you still give it to someone else?
Yeah, I mean, Francine, that's the question that nobody can answer today, including the CEOs of Pfizer and Moderna. And unfortunately, the trials were not conducted in a way that would allow this to be properly analyzed. So it has to be something that people look at further down the road. We don't know if people who are vaccinated, who do not get disease, are still infectious or not.
Sam, thank you so much for all of the insight. Sam Fazeli there of Bloomberg Intelligence. Now, to talk about the vaccine and the impact on the markets is Patrick Armstrong. He's Chief Investment Officer at Plurimi Wealth. Patrick, so we have some good news from Moderna after the very good news from Pfizer a week ago, but markets are wobbling a little bit. Are they worried about valuations, or is it, is there just too much good news priced in?
Well, markets have gone very far, very quickly. So month to date, the MSCI World's up more than 10%. So the pullback we're seeing today at a fraction of a percent is inconsequential, really, versus how things have rallied. I do think valuation will matter at some point. It's not something that matters right now. It's liquidity, central banks, reopening of the economy, and the vaccine pushing risk assets and in particular, cyclical assets, the reopening of the economy, that you can see that window happening with more certainty than just a possibility maybe it was a few weeks ago. And the pullback today makes sense given how far things have run. I still think there's headwinds for some of the cyclical sectors in the near term, even though you can see an end to those over the medium term now.
So, Patrick, where do you see value? If you were to, pick a part of the market that can still rise, given where we are, where is that?
Well, our most recent additions have been in some of the hard-hit value stocks recently. And it comes from that I believe that there will be the growth, the reopening of the economy. And it comes from I had a very big position in quality and growth leading into this week. And we've muted that out somewhat. So we've bought companies like Peugeot. I think some of the travel companies. You've got the Airbnb IPO filed yesterday. I guess there's a window for that opening up and travel emerging again. Those kind of companies saw their profitability decimated. And with the path back to profitability of these companies, I do think there probably is some value in some of those beaten down stocks at this point.
Patrick, so the big news yesterday, and I know a lot of people were tweeting about it, a lot of people were looking at exactly what that meant. Tesla on the S&P from December 21st. How did you react to that?
Well, it's not a surprise that the timing, you never know when it's going to come, when it's between board meetings, but the math is staggering on Tesla. If there's $11 trillion tracking the S&P 500, and Tesla's market cap on a free float adjustment of about 80%, will make Tesla the 7th biggest holding in the S&P 500. So that'll put it at about a 1.2% weight before today's price rise that we're going to get. And that'll mean $130 billion of passive money will need to buy Tesla shares. You're also going to have active money that is benchmarked against the S&P. And if you're worried about tracking error, from December 21st, you'll have a risk for not owning Tesla. So put that on top of the big short position on Tesla, it's you can see really strong demand that's just structural now for the next 3 or 4 weeks. So it's not a surprise that it's entering the index. The timing yesterday, no one indicated it was going to be announced yesterday. There's still some question. They may not do the full allocation on December 21st as well. S&P is asking for some guidance from investors if maybe they should do it in 2 stages as well.
Patrick, thank you so much. Patrick Armstrong there from Plurimi Wealth stays with us, and we'll talk a lot more about Tesla shortly. Coming up, we won't not only talk about Tesla, but of course valuation of that sector as a whole at almost $390 billion in value. Tesla set to become the biggest company ever added to the S&P 500. So we discuss more about the S&P 500 shortly. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Tesla soared in late trade on news that the stock is joining the S&P 500. The 17-year-old car maker will join the index on December 21st after months of speculation and a temporary setback when it failed to make the grade in September. Now, the anticipation has driven a near five-fold rally in the stock this year, making Tesla the most valuable company ever to be added to the gauge. Well, we also found out yesterday that Airbnb filed for its IPO, outlining why widening losses and plunging revenue due to the pandemic. But it's projected optimism for a rebound in demand when the economy does recover. The listing is said to be one of the biggest this year, while sources tell Bloomberg the company plans to raise as much as $3 billion. Let's get back to Patrick Armstrong from Perimi Wealth. Patrick, we touched on Tesla, and I want to go back to actually what will be in the S&P 500 for now. We saw also this huge rotation in the markets. Well, how long can that continue for?
It can continue. For value stocks to have a sustainable recovery, you need to have either a steeper yield curve or higher interest rates. And if that's driven by economic growth, where full capacity and full employment, I think you'll have a sustainable value rally in that scenario. Because when future earnings are discounted at next to nothing, you should pay a lot more for growth companies. If there is a dynamic that leads to the steeper yield curve, which a strengthening economy would lead to, all other things equal, you still have yield curve control, I guess, in the cards at some point. I think that's the real catalyst for value, that people believe in economic growth. There's a higher discount rate for growth multiples. And the cyclical companies generate their growth. The heavy lifting for them is done based on economic growth, whereas more the secular growth companies have their growth pinned to what their products are, to what their barriers to entries are, things like that. So much more consistent and stable growth from the quality growth companies, but the cyclical companies basically have that tailwind of the improving economy should we get that.
The question we're asking today, Patrick, on the MLive blog, and I urge everyone to check it out, it's really good as always, is when will the S&P hit 4,000? What will be the catalyst for that?
You'll have to see earnings growth. It can't just be multiple expansion at this point, I don't think. So 2020, 2019, earnings are not dissimilar to where they were in 2018, but the S&P is up massively over that period. So it was up 30% last year, and it's up 15%, almost 10% this year. So you do have to see earnings start to be a component of that expansion. With economic growth, we probably think the U.S. is going to grow at close to 5% next year. That's still not going to put it anything close to full capacity at full employment. So you will have economic growth that will obviously lead to some earnings growth. You put me on the spot, and I'm going to say 2023, January 2023 for 4,000.
Patrick, when you look at some of the other things that actually, we need to talk about, are we going to see a resurgence of IPOs, including Airbnb? Once we have a vaccine, does it suddenly just become back to what it was like in 2019?
You should have a surge of IPOs because there are these unicorns that were supposed to be mythical things that don't exist, and now there's hundreds of them that have basically billions and billions in market cap and traded basically not traded, but in equity issuance to private investors. With this kind of multiples you're getting in the public markets, it makes a lot of sense. There's tons of liquidity. That liquidity is increasing every month with what central banks are doing, keeping interest rates pegged at zero and buying bonds, treasuries, corporate bonds, all of these things push people into riskier assets. So I do think with these multiples, it's just a no-brainer for private companies to take the multiples they can get. And there's obviously demand. You see the oversubscription of all these high-profile IPOs. So I do think there will be a wave of IPOs in the coming year.
Patrick, what does a Biden administration mean for stock markets?
It depends on the Senate at this point still. So we've got 2 Senate races that are going to be finalized in January. It's looking like the Republicans will win those, but as you know, with elections, there's never certainty. If we do see the Democrats take control of the Senate, then it's a massive fiscal stimulus from Biden. So environmental spending on infrastructure, $2 trillion, raising minimum wages to $15, the U.S. manufacturing really pushing for goods that the federal government gives out contracts for to be manufactured in the United States. All of those things, very pro-growth. The consequence of those things would be higher taxes. But in our base case, you've got a Republican Senate that doesn't allow any of those things. So Biden will re-enter the Paris Accord. There'll be some tailwind for environmental companies, but the Senate won't approve the $2 trillion he wants to allocate there. They won't approve minimum wage being doubled to $15 an hour. So It's still iffy, depending on how the Senate races go. But with gridlock, I think you're going to have less ambitious policies from Biden just because they won't be able to get through.
What happens with China? So does the U.S.-China relationship get better from here, or could it actually get worse?
I don't think it gets worse. I think Biden's playbook will be ending of tariffs over time and basically synchronizing tariffs the U.S. do with Europe and its other major allies. So it'll be going from a one America, America first, to part of the old global order and the globalization where basically pushing liberal values and the benefits of globalization. I think that'll be going back towards how the previous regimes were in America. You probably don't get there fully. Won't be everything reversed. So I think it's probably good news for global trade, good news for China. But if the U.S. does coordinate with Europe, any tariffs and pressure they have will probably have much higher efficacy against China as well.
Patrick, thank you so much. Patrick Armstrong, their Chief Investment Officer at Plurimi Wealth. Now, coming up a little bit later, of course, it's day 2 of the Bloomberg New Economy Forum. One of our highlights is the discussion with the ECB President, Christine Lagarde. Don't miss that. It starts at 4 p.m. London time, and this is Bloomberg.
So when you went to Baltimore, you went initially to be an anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
demoted. I was
got demoted, but they didn't. They had a contract, so they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." Then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000. Right. So they kept me on and said, "We'll put you on this talk show just to run out your contract."
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
competitive approach to China was inevitable, but keeping it healthy and not pernicious is vitally important, and that won't be easy.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
But what I do believe both sides are capable of through the highest level diplomacy at an early stage of the Biden administration is to define the parameters.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject and protectionism.
When your economy becomes, so big, and your interests are all over the world, you have to protect your own interests.
The American administration is about to change, but the clock will not simply be rewound.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
Unfortunately, some forces are acting against the trend of the times. They have trumpeted the decoupling and willfully walked away from international commitments, posing challenges to multilateralism.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
Well, those were some of the guests from the Bloomberg New Economy Forum giving their take, of course, on their U.S.-China relations. Now, I was just looking at the markets, which is why I was on my phone. The market's really not too worried about what's coming up ahead in terms of U.S.-China. The focus, of course, is on the vaccine and the short-term number of infections. Coming up, a discussion with the ECB President, Christine Lagarde. Don't miss. That's at 4 p.m. London time. And this is Bloomberg.
we're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail, right? We've seen that. So we're going to have to figure out how to retrain that workforce.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
It will be available at first at the level of tens of millions of doses. I would suspect before the end of this year, some 20 to 40 million doses will be made available. We've already said 20 million of it will come from us. Then in going into the first quarter, that number should ramp up to as much as 50 to 100 million doses just from us. And that will ramp up through the year 2021 to 500 to 1 billion doses.
Well, that was the chair of Moderna speaking to us yesterday after the vaccine was found to be 94.5% effective in the latest trials. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. President-elect Joe Biden says containing the coronavirus pandemic is vital. He's vowing to spur a rebound in 2021, but also urging Congress to pass a stimulus bill this year to deliver immediate relief to Americans. Biden says it should be like the $2.2 trillion HEROES Act already passed by the House. Flexible working could be the solution for women into senior roles. That's according to a new study by Zurich Insurance. Women applying for management jobs jumped 20% after the insurer advertised the roles with part-time and job share options. As a result, the number of women hired for senior positions jumped by a third. And 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Bill Clinton says Xi Jinping's long-term reign has upended U.S.-China relations. The former president says America and its allies will need to take a more coordinated approach to dealing with Beijing. Well, he made the comments in a conversation with the former UK Prime Minister Tony Blair at the Bloomberg New Economy Forum.
For the new administration in the U.S., I think the big challenge with China is to get what I would call a strategic framework for dealing with China, rather than a series of ad hoc reactions to whatever the Chinese may be doing. And I don't know what you think about this, but I always think you just got to distinguish between two things. One is the power of China today is a fact, and it's a perfectly justifiable fact in the sense of it's a large population country, ancient civilization, huge economy. China is and should be one of the great powers of the world for the 21st century. The problem is the system is a different system. And whereas I think when you and I were in office, there was not an expectation exactly, but a hope that as China opened up and developed, then political development, not in terms of turning into a Western-style democracy, but political evolution in the direction of more liberalism. I think that was our hope. That was our hope, and possibly it certainly was my actual expectation. But you've got to say, in the last few years, there's been more external aggression and more internal repression. So that's what we're dealing with now. And I think the strategic relationship is very important to define, because you need America and Europe to work. I think it would be bad if, as it were, Europe is kind of navigating between the US and China. And I think that strategic, and I think that framework has to accept that there will be areas of confrontation, and you've just mentioned some now. there are inevitably areas of competition. Technology is going to be one. But you need to leave some space for cooperation. Because whether it's the pandemic or indeed what we'll talk about a bit later, climate change, none of these problems can be solved today without the participation of China. And, therefore we've got to, I think the analogies with the Cold War are kind of misplaced. And indeed, as some of the Bloomberg documents show for the forum, I mean, decoupling is going to be painful for both of us, for the West and for China. So I think this, if you can get as you rightly say, if the new president comes in and has a more strategic framework, then you can identify, consistent with that, areas of cooperation and at least offer China the possibility, whatever differences there are, for those areas of cooperation to be fruitful for both sides.
I agree with that. I also think we can strengthen our negotiating position, if you will, or our cooperating position by reestablishing the relationships that we had with other countries in Asia and Southeast Asia in particular, who were our allies, who would have been the principal partners in the trade deal that President Trump killed, the Trans-Pacific Partnership. Whether the new administration chooses to revive that or not, we can clearly do more to strengthen our partnership and work with them. And we have to recognize and just level with people, the old Chinese system, which was by no means a democracy, still guaranteed enough debate and play and openness because there was a regular rotation of leadership. And now that it appears that a person is in charge of China who intends to stay there for life, in essence, that changes things. But we shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies, a strategic partnership which will enable us to do good things together and try to minimize the bad things that we think will happen if we just walk away.
Former U.S. President Bill Clinton, former UK Prime Minister Tony Blair in conversation there at the Bloomberg New Economy Forum. And of course, we'll have plenty more from the New Economy Forum today. Coming up, Warren Buffett's Berkshire Hathaway has taken a big bet on vaccine makers. We'll dig down into his quarter's 13F filings. That's coming up next, and this is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Tesla is joining the S&P 500 next month as its largest ever new member. It follows months of speculation which helped the company's valuation skyrocket to almost $390 billion. It will be one of the index's most influential members, with a weighting similar to that of Berkshire Hathaway or Johnson & Johnson. Spanish bank BBVA is in takeover talks with rival Sabadell to create one of the country's largest lenders. The move comes a day after BBVA announced it was selling its US arm to PNC Financial. That gives it the firepower for a deal and boosts its capital ratio. And Airbnb has filed for its IPO, outlining widening losses and plunging revenue due to the pandemic, but it is projecting optimism for a rebound in demand when the economy does recover. The listing is set to become one of the biggest this year. Sources tell Bloomberg the company plans to raise as much as $3 billion. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. So it's a 13F season among the investment giants reporting their third quarter holdings in the U.S. Overnight was Warren Buffett's Berkshire Hathaway, and Berkshire's filing reveals a big bet on vaccine makers. Well, joining us to discuss all of this is Bloomberg's Danny Berger. Hi, Danny. First of all, what stocks precisely did Berkshire buy over the quarter?
So, Francine, as you mentioned, there were a lot of pharma stocks that Berkshire did add. This really reflects some of what Buffett has been saying all this year, some concerns over the U.S. economy. And these bets reflect hopes of a vaccine, or at least the benefit that the vaccine news could bring to these pharma companies. So he put new positions, and he and Berkshire as a whole put new positions in Merck. They're, of course, developing a COVID therapy. And just months before Pfizer rallied after announcing the success of its vaccine, Buffett added in the 13F. You can see some other pharma companies there as well. In terms of what Berkshire sold, they are well on their way to exiting positions on JP Morgan and Wells Fargo, in some cases exiting about 96% of the stock it owned. Overall, Berkshire reduced its financials position by about 4%. You can see they slashed some of the local banks, M&T and PNC as well, Francine.
Danny, sticking with U.S. equities, Tesla also set to join the S&P 500 next month. What sort of effect does this have on the benchmark?
Well, look, we've been talking about this today, about how massive Tesla is, and that can be a disruptive event to put a $390 billion market cap stock into the greater index. To put it in some figures, managers who track the index would have to sell about $40 billion worth of other stocks in order to just fit Tesla in. So Dow Jones, S&P, the owner and the committee behind the benchmark, is seeking now comments from investors saying, hey, should we do this in two parts? What's the best way to include Tesla? This could also just generally be a boon for the S&P 500. Tesla has rallied massively, part of what's driven Elon Musk's wealth here, about a five-fold increase for the stock. And that's part of the reason why the NASDAQ 100 has outperformed the S&P 500. So this could help the index. Certainly Tesla rallied overnight as long as a $15 billion gain in terms of Musk's wealth. Francine?
Danny, thank you so much. Our Danny Berger there with the very latest on some of these U.S. stocks. Now, a very busy day for the New Economy Forum. Business and political leaders taking on issues from the economic fallout of the pandemic to the future of global trade and climate change. Now, we also spoke to the United Nations Secretary General, Antonio Guterres, and he told me his hopes for getting to net zero carbon by 2050.
I believe that he has committed to a number of very important transformations in the U.S. economy. And again, the role of the U.S. private sector, the role of cities, the role of the different states has been so dynamic, and Mike Bloomberg has been so active in pushing for it, that we are already seeing in the U.S. Very important steps moving in the right direction. What happened to coal? And again, a very important Mike Bloomberg initiative is the proof of that. So I think that with the government committed to move forward, with the government committed to do the right thing, I believe the extraordinary dynamic of the American society will allow us to reach net zero emissions in 2050.
But Secretary General, how worried are you that the sitting president of the world's superpower and actually the largest UN donor has still refused to concede the elections?
Well, I think that that problem will probably be solved soon. We don't interfere in the electoral processes of any country in the world, and I must say I have total confidence in the solidity of the US institutions.
The United Nations Secretary General Antonio Guterres is speaking to us at the Bloomberg New Economy Forum. Now, coming up, when will the global economic recovery from 2020's coronavirus-related recession ease? UBS has just released its year-ahead outlook, and we'll be speaking to Mark Hafele, the company's global chief investment officer, next. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, when will the global economy recover from 2020's coronavirus-related recession? Well, UBS has this morning just released its year-ahead outlook. The wealth manager says its base case scenario is for economic output and corporate earnings to both rebound to pre-pandemic levels during 2021. Well, let's get straight to Mark Haefele. He's Chief Investment Officer at UBS Global Wealth Management and, of course, one of the authors of this report. Mark, great to have you on the day where you release this 2021 outlook. Is this based on having a vaccine, or are we going to see a rebound no matter what?
Well, I think that the vaccine is key to the speed of the recovery. And so a widely available vaccine by the second quarter is in our base case, and the effectiveness rates of this vaccine are particularly important for the speed with which we can start to see that normalization, which we would expect to be in full swing, say, third quarter of 2021.
I have to say, your year-ahead outlook, Mark, is simple to read. It's to the point. It's wonderful. I know we protect the copyright, but congratulations on, just 16 pages where it really breaks it down. Some of the questions that you ask is, what does it mean for the U.S.? How quickly can the world actually recover? What do those questions mean for where you want to put your money?
Well, I think that, we're calling it the year of renewal and renewed growth and new leadership, both in the market and the U.S., and then a real focus on the renewable future. So I think that gives you a couple clues. I mean, the first is we do buy into this view that we will rotate away from mega cap tech and into some of the laggards, which are going to catch up. Now, we've seen some of that already, but we think that that can continue for a while yet as we get this corporate earnings rebound. That should foster a lot of good things happening, including some companies, being able to refinance at lower rates, which can help earnings and things. We think that the leadership change in the United States is important for a couple of reasons. One is, while the U.S. voters chose kind of legislative gridlock overall, there will be changes, particularly towards sustainability. And that's important globally because what we've seen this year, this trend towards these big pledges for carbon neutral by the middle of the century, that leads a lot of investors towards what the next big thing is going to be.
Mark, what does it mean for, you say there's opportunity in the 2020 laggards. What exactly are those? I know you mentioned some of the mid-cap stocks. Where do you find them region by region?
Well, we like the UK market. I think that that is going to create opportunities because it has been beaten down so much, and compared to other regions and sectors that have improved, we like the cyclicals and industrials, which that is part of. So I think that's one of the ways that we would play this rebound. And then we're looking, I think, over the longer term, in tech, what do you do? Moving more towards these companies that are disruptors within sectors. So we're looking at fintech, we're looking at health tech, and we're looking at green tech, along with playing this 5G rollout, which is accelerated both by kind of the separation between U.S. and Chinese tech, but also by this rollout of things like the new iPhone.
Mark, if you're expecting a weaker dollar, how do currencies fit in a portfolio for 2021?
Well, I think that it's a backdrop that people have to understand, but I think in terms of their portfolio allocation, but we would expect most of the G10 currencies potentially could do better, but also some of the higher yielding currencies in Asia are more attractive. So one of these themes, this hunt for yield, means that we would expect that some of that money could, for example, flow into some of these higher yielding Asian currencies on the back of that as people go further abroad to try and earn a yield.
I was interested, Mark, in your call that you actually like some of the UK assets. Is that because they've been oversold, or is it just a matter of protecting yourself in a next downturn elsewhere in the world?
I think it's oversold. They haven't recovered in part because the index in the UK is so cyclically oriented, and so that and then of course we expect that there will be some resolution to Brexit going forward. So all those factors can help, and this all comes against the backdrop of the continued fiscal and monetary stimulus, which we think is going to be in place. So as people rotate out of the stay-at-home trade, we don't think that the market is necessarily going to sell off, but that people are going to look for the things that just need to catch up to what has happened in some of these highfalutin sectors of the market.
Mark, how do you protect yourself if things don't go to plan and we see a downturn?
Right. Well, I think that one of the areas that we often see our investors turn to is gold. Now, I think particularly if things are not going well, that's one of the places to diversify. And then the other thing that we see a lot of clients doing is using what is still relatively high volatility to try and harvest some of the premiums that they can achieve with structures, option structures, as a way to kind of cushion the potential for some of the downturn.
Mark, very quickly, what do you think is being mispriced in the market? Is there something that investors are not focused right now or overly optimistic about?
Well, I think what they're mispricing is, in some ways, the desire for people to return to normalcy. And when you have a vaccine that's this effective, I think in some ways that's still really being mispriced.
Mark, thank you so much. As always, Mark Heffler there, the Chief Investment Officer at UBS Global Wealth Management with his 2021 reports. Now, Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. Don't miss our conversation with the ECB President, Christine Lagarde. That's at the New Economy Forum, and that's a little bit later on. In the meantime, a global stock rally that was powered, of course, by positive news of vaccine paused today. Investors weighing the near-term spread of the virus against positive news of the vaccine. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The rally stalls. Moderna's highly effective vaccine sends U.S. stocks to record highs, but optimism is tempered amid fresh restrictions across America. Full speed ahead for Tesla. The electric car maker is set to join the S&P 500 next month as its biggest ever new member. And U.S.-China ties take center stage at the Bloomberg New Economy Forum. Bill Clinton says Xi Jinping's long-term reign has upended relations between Beijing and Washington. Well, good morning, everyone, and welcome to Bloomberg Surveillance. Tom and Francine from London and New York. Tom, a lot going on in the markets. If you look at the rally it's petering out, maybe taking stock of some of the valuations, maybe just focusing on the fact that even if we have a vaccine, we could have a lot more infected and a lot more people dying until we have a workable vaccine.
You know, the dynamics in the pandemic are real, and of course, the job economy is important. What we know, folks, is Francine's running a construction site. The room you're putting in, Francine, with the construction we hear, that's the shoes, right? Like that's just the shoe extension off the closet.
The neighbors, Tom, I'm not sure if you can hear it on air, but I was assured by the neighbors that it won't last very long. So can you? Great.
There we go. A little bit of hammer in there. It's like This Old House with Francine Lacroix. We welcome all of you here to the realities of the pandemic. And you're right, Francine. I mean, the pandemic is front and center, but there's a lot of other news. I would note Pacific Rim currencies continue strong.
Yeah, they certainly do. And actually, there's quite a lot going on also in pound, Tom. So let's not forget Brexit and the UK-EU relationship. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine Tom. The Trump campaign is withdrawing a key part of its lawsuit against the election result in Pennsylvania. It's abandoning demands that almost 700,000 mail-in ballots be thrown out because observers were kept too far away from the count. The challenge is now against a far smaller number of ballots, almost certainly just a fraction of Biden's lead in the state. And President-elect Joe Biden is starting to meet national security experts, but his transition team is still being denied access to government officials in key departments. To prepare for office, he's relying on experts from the Obama era and people who've left government during Trump's term. In Germany, Chancellor Angela Merkel has failed to push through a slate of tougher restrictions to tackle the pandemic. She's postponing major decisions until next week after being unable to reach a deal with regional leaders. Instead, she's urging people to limit public and private gatherings. And 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Let me look at the data right now. Equities, bonds, currencies, commodities. A churn to the market after the big day yesterday. Sort of what I call the anti-cyclical pay. Back to a little bit of a lift in the NASDAQ 100. Futures negative 12, Dow futures negative 63. We had a 22 handle on the VIX, 23.04 right now. Interesting to see how that develops through the week. In the yield space, well, churn to the markets there, a little bit lower yields. Can't say much. And the dollar fractionally weaker, as Francine mentions. A lot of dynamics in sterling. And I would note again, renminbi up to new strength, 6.55 is miles from 7.00. Francine?
Yeah, Tom, look, a global stock rally that had powered hopes that the vaccine will bolster economic growth maybe paused today. Investors trying to weigh also the near-term spread of the virus. A couple of things that jump out at me. First of all, Tesla. Those shares pre-market gaining some 12% after the car maker says, or, after it was announced the car maker will join the S&P 500 index on December 21st. And then I'm looking at treasuries rising, dollar falling, WTI crude oil advancing, and the pound rising on optimism over a Brexit deal, Tom. So we'll have plenty more to talk about. Now, U.S.-China tensions took center stage on the first day of the Bloomberg New Economy Forum. The former U.S. President Bill Clinton urged Joe Biden's incoming administration and America's allies to take a more coordinated approach to dealing with Beijing.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
Joining us now is John Norman, JP Morgan, head of cross-asset fundamental strategy. John, there's a lot, thank you so much for joining us, a lot to talk about. First about U.S.-China, Biden administration, but just overall this vaccine. Is there too much optimism being priced into the markets right now?
No, I don't think so. I think everything that's come out of both the therapeutic front and the vaccine front over the first few months, so not just the past week, has generally come out better than expected in terms of the quality of the results reported by the major drug makers. So it is right to think about the vaccine as really sealing the case for this being the last major wave of COVID. And if you believe that that's the case, then you have to bet on a stronger global economy without a lot of volatility next year. And that's what markets are reacting to. So I don't think the medium-term path that markets are anchored by is justified at all. The shorter-term path is different because we're starting to see increasing lockdowns in the U.S. One has to think this has an impact on growth. This is going to cause episodic drawdowns in risky markets, but I don't think it changes the direction of markets over the next several months.
John, what kind of recovery are you expecting once we have the vaccine?
I think once you have the vaccine, keep in mind that in the background, there's probably going to be more fiscal easing by the time the vaccine is actually deployed to the general public. So I think that's why 2021 is going to be a year where the global economy is printing above trend growth, why probably most DM and EM economies are printing above trend growth. Monetary policy will remain loose. Fiscal policy is a bit of a drag, but not enough of a drag to really pull growth below trend. I think that's a pretty impressive environment for financial assets. I mean, yes, some of them are rich, but I think that richness just sort of constrains the upside next year as opposed to forcing asset prices lower.
John, you write hyper detailed notes at a professional level and institutional level. Let me take it back to the core question for institutions and for all of our viewers. What do you do with cash? How do you deploy cash in the land of John Norman?
So I don't think you should hold much of it simply because anytime the global economy is growing above trend, the bias on equity markets is higher. The bias on credit spreads is tighter. So, hands down, other financial assets, ex cash and ex DM government bonds are going to give you better returns than the safe stuff. That's the basic point of this. I think the question, though, is would you hold any cash at all? And I think you should, simply because many financial markets are extremely difficult to hedge in an environment where DM bond yields are already so low. So one cannot hedge with German bonds anymore. And there's a limited degree to which one can hedge with treasuries. So the only way to sort of limit one's risk over the next year is to have some residual cash position, even if it should be a small one. Maybe it should only be a couple percent of the portfolio.
John, I'm going to rip up the script and go all Bridgewater on you. Think of Bob Princeton leading this charge at Davos. It seems like forever ago. If bonds are useless as a hedge, if full faith in credit U.S. is useless as a hedge, has John Norman and JP Morgan come up with a hedge alternative, or is that essentially a constructive impossibility?
Well, there are a bunch of second best alternatives. I'm not going to claim I have come up with them because they've been around for decades, if not even longer than that. So this is basic defensive assets in currencies like the yen or the Swiss franc. They're basic defensive assets in commodities like gold. And I still think treasuries have some residual value. They do not yield zero yet. They might only yield 90 basis points in 10-year U.S., but there is some scope for those yields to go down if the economy disappoints and the Fed extends the average maturity of its purchases. So bonds, I think, are definitely useless. So are JGBs. So are UK gilts. Treasuries have a lot less usefulness than they used to have, but that needs to be combined with some of these other defensive assets in currencies and commodities like the yen and gold.
John, where does the market find yield in 2021?
I think it's only in credit and emerging markets. Credit meaning high yield, high grade, I think has too much duration risk for an improving growth environment to make that a decent risk reward. So it's basically about high yield and probably EM local markets. I think there are still, if you have to find any central banks that are going to be easing policy next year, it's probably going to be those EMs that still have reasonably high real interest rates, Mexico, Russia, China, perhaps Indonesia. Those are places where people can earn yield and capital gains, but it's obviously just a subset of the fixed income universe compared to what people are used to thinking about as the yield options in this kind of environment.
John, overall, when you look at some of the dynamics of a Biden administration, are there sectors that will be hit more than others that we're not realizing yet?
I don't think so, because the Biden administration becomes hugely impactful on a sectoral basis if there's a Democratic sweep. So if the two Georgia seats went to the Democratic side of the ledger and the sweep dynamic became reality, then you could talk about regulatory changes and a number of changes on the environmental front that would amplify the rotation that's already going on because of the vaccine. But I think for most of 2021, the rotation that you're going to see is mainly driven by the vaccine. This is a global phenomenon, not a Biden phenomenon. And there's also a rotation that happens just from the global economy lifting. If you want to talk about something that really is going to endure beyond maybe the middle part of 2021 in terms of sector rotation, style rotation, I think that has to be based on a sweep, and we'll just have to see how the Senate races turn out on the 5th of January.
John, thank you so much. John Norman there of JP Morgan stays with us. Tom, can you hear that? It's quiet. It's quiet in the Lacqua household.
I think
the neighbors are watching Bloomberg. They heard you mention that they didn't, you didn't like all of the noise, and they stopped.
Or it's a union 3-hour lunch. It's probably a union 3-hour lunch.
Probably. Coming up today, during the Bloomberg New Economy Forum, Christine Lagarde, the ECB president, is an exclusive interview that starts at 4 p.m. 4 p.m. in London, 11 a.m. in New York. There is actually maybe a new, gold escalator going, being built next door, Tom. I don't know. I'll look into it and I'll report back. But don't forget to watch the Bloomberg New Economy Forum today on the social channels, on Twitter, on Facebook, but also on the terminal. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
Not only in terms of job creation, but also a sharp fall in
relative to population is still well
is keeping up or slowing down.
Good morning, everyone. Bloomberg Surveillance. Francine Lacroix in London. I'm Tom Keene in New York. Lots on a Tuesday to speak of with the markets on the move. John Norman with us with J.P. Morgan. We've been talking here about some of the relationships, the correlations across asset classes. John, I want to cut to the chase, which is the great underestimation coming out of any crisis and maybe even a medical national disaster, is that people adjust. Is there a great adjustment going on now, which is massively, massively underestimated, that corporations adjust, governments adjust, indeed the public adjusts, and that leads to a better outcome outside the gloom?
I think it's too early to tell, but I think this will become a lot clearer over the next couple of quarters. And what I mean by that is companies have become arguably much more efficient about delivering whatever service they focus on through the pandemic. So they moved to greater efficiency through staff working from home. They've moved to a digital platform in many cases for delivering a service. And if you think there's some inertia in that change in the business model that's going to keep costs low in 2021, what we might be surprised by is how strong profits are and how much or how resilient margins are in 2021 as the economy picks up. So even if we don't see a pace of growth which is 2 or 3 times trend, we might see an above normal profits recovery and margin expansion because they've retained some of these more efficient business practices well into the post-pandemic era.
And this is an unfair question to you, but I'm going to go with it. And it goes over to Joyce Chang and maybe equity market analysis. But let's keep it in your space. Is the great adjustment that we're under a digital adjustment?
Well, it's a continuation of a digital adjustment for many sectors, and it's sort of an adoption of digital practices in a lot of sectors that weren't following that path previously. And my expectation is that a lot of that shift is permanent, that the pandemic basically forced businesses to do many of the things that they should have been thinking about anyway. And we'll probably see that benefit in terms of efficiency, which then gets reflected in margins and profits over the medium term. Kind of beyond most people's projections. This is why you're probably going to see significant underperformance of the euro area economy in the current quarter versus other parts of the world. That hasn't had a very durable impact on markets. That was basically a phenomenon that affected the euro and also European equities in the month of October, but not in the month of November, basically because the vaccine success has really supplanted that. So I don't think there's a huge amount to differentiate European from U.S. markets going forward, mainly because the vaccine dynamic is so dominant that it's lifting all boats, even if over the short term, there's a pretty big gap between where European growth is going to be this quarter versus what it's going to be in some other parts of the world. So, Europe has gotten pretty lucky or European markets have gotten pretty lucky that the vaccine story is really driving everything currently.
Have UK assets been oversold? We could have a deal. It's unclear how negotiations are going, but they seem to be more on the positive side today.
I don't think they're oversold because UK assets are basically need to reflect the reality that even a skinny deal between the UK and the EU is a hit to long-term growth. It's not as big a hit as a no-deal scenario would be, but it's a markdown nonetheless. So I sort of struggle to see the outcome from the Brexit negotiations, which is going to cause a significant upgrade in UK growth relative to the rest of the world. If you see an upgrade in UK growth, it's because there's a common phenomenon, which is joint monetary easing or fiscal easing or vaccine developments. But I don't see an idiosyncratic, pro-UK market phenomenon developing in the next year.
John, to get out front of the year end and look forward notes that are going to be written, and I don't mean a J.P. Morgan call, but I'm just fascinated by where you calibrate where the euro is too strong or the yen is too strong? Do we grossly underestimate how quickly governments are going to adapt to stronger currencies off weak dollar?
No, I think there's central banks who historically have used verbal intervention much more than actual intervention to resist currency strength. So the G10 central banks tend to use verbal intervention much more than actual intervention. That's why if a currency appears expensive or appears strong, I don't think of that as necessarily a constraint on further appreciation. If the currency we're talking about is a G10 one, I think it's highly unlikely that the central bank is adjusting monetary policy or undertaking FX intervention in order to resist that trend. So, I feel like the intervention debate is really one that's very much about EM central banks and mainly EM Asian central banks.
John Norman, thank you so much. Greatly appreciated. Always a wonderful brief here. He is with JP Morgan, head of cross-asset fundamental strategy. Futures -14. NASDAQ futures a little green, red and green on the screen as well. Dollar fractionally weaker. On central bank discussion, what a wonderful effort by Stephanie Flanders yesterday at the New Economy Forum with leading central bankers. Let's follow that at 10 a.m. with a leading central banker, Alan Blinder of Princeton University. Stay with us worldwide. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg Surveillance, I'm Rishka Gupta with your Bloomberg Business Flash. Tesla is joining the S&P 500 next month as its largest ever new member. It follows months of speculation, which helped the company's valuation skyrocket to almost $390 billion. It will be one of the index's most influential members, with a weighting similar to that of Berkshire Hathaway or Johnson & Johnson. Airbnb has filed for its IPO, outlining widening losses and plunging revenue due to the pandemic. But it is projecting optimism for a rebound in demand when the economy does recover. The listing is set to be one of the biggest this year. Sources tell Bloomberg the company plans to raise as much as $3 billion. And EasyJet is extending the terms of its UK government-backed loan. That's to bolster its liquidity in the face of new lockdowns in Europe. Britain's biggest discount airline is posting a loss of over $1.1 billion for the year through September. It plans to fly no more than 20% of its usual capacity this quarter. And that is your latest Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, we're just getting some breaking news, and this was a little bit priced in the markets, which is why we saw pound move, but we understand that Brexit negotiators are very close on a trade deal. We understand that they're zeroing in on a trade deal as early as next week. Now, of course, we still have to see the biggest sticking points and whether that will actually go through. Talks are continuing in Brussels, and again, officials are now planning for the possibility of a breakthrough to be announced as soon as next Monday. I know, Tom, the sticking points are fisheries and fishing waters. That's one of the most thorny topics, so we'll see what's decided on that, but that's mainly the data check. That's what I want to show you is pound and then a little bit of movement on European stocks.
Buttressed right up against sterling strength on dollar. Dan Tillis tells me about euro and sterling, and of course that relationship not quite as enthusiastic, where euro sterling's got some real run to move to get through resistance at about 0.89. Michael Pence, or I should say the Vice President Pence, to get through 0.895 on euro sterling as well. Coming up away from Brexit, William Dudley of Princeton University with Alan Blinder. William Dudley, the former head of the New York Federal Reserve System, on the mysteries of our central banks. Stay with us. Futures -14. This is Bloomberg.
Our aim was from the beginning to have a portfolio of 6 to 7.
Europe.
The notion that the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential.
The big thing was preventing a financial collapse. The central banks acted definitively to do that. That's all that was ultimately historically important. The mistake is for them to vastly exaggerate their continuing relevance. They lack, starting at the zero bound where we are, the capacity to provide meaningful impetus to their economies in any way that is consistent with any concept of central bank functioning. They do not have the capacity to meaningfully affect the degree of inequality. They do not have the capacity to vaccinate people. They do not have the capacity to fight climate change. And they need to acknowledge the limitations of their influence.
It should have been a 1-hour panel yesterday, maybe even an hour and a half. This was a powerhouse of central bank thought, and you get that with Stephanie Flanders of Bloomberg News, our senior executive editor for Real Economics. Stephanie Flanders joins us now. What I love, Stephanie, is you went right to old world balance sheet dynamics. We don't do that in America. It's a very British thing about saving gluts tied into weak loan demand. It's the opposite side of the American dialogue. What are these esteemed people say about the fact is people are scared stiff, there's a savings glut, and there is weak loan demand?
I thought it was really striking, Tom. I mean, you'll remember Larry Summers, who was on the panel and was talking there about the limitations of central banking, has been banging on for a while about secular stagnation. And the core of that thesis was that you had this huge amount of this glut of savings sloshing around the world in search of a shrinking amount of real investment opportunities, and that was at the heart of financial instability, inequality, and the relatively slow growth we've had all these years. What was striking to me is, I've heard Larry say that a million times, what we had on this panel was Janet Yellen come very strongly agree with him that was the major macro issue. Raghu Rajan, the former head of the Indian Central Bank, saying the same, and Mervyn King, the former head of the Bank of England. They had slightly different views about what the best response was. I think the focus was on fiscal when it comes to Janet and Larry Summers, more than perhaps some of the others. But I thought that was very interesting. If you'd heard that a few years ago, you would have thought, wow. Right. The argument has moved in the direction of Larry Summers.
How close are we, Stephanie? And not only your esteemed panel, we talked to Governor King about this, The End of Alchemy, one of the great books out of the disaster we're in. Stephanie Flanders, how close are we to the land of Clement Attlee? How close are we to wage flattening or even outright nominal or real wage deflation?
You know, I think it's in different places we're seeing different things. I mean, the search for inflation and certainly wage inflation, has been on for years, and we thought we were going to maybe start to see it more this year, and then we had the pandemic, we had the crisis. I think what is going to be, a focus, and one of the things we tried to get into in the panel, is whether central banks can make clear to people that is what they're focused on. They're focused on the main street, on wages and on livelihoods, and not so much on Wall Street, which is, of course, the dynamic we've seen so much about them propping up stock prices.
Stephanie, good morning. How much power do they think central banks have left, or how much of a toolkit do they still have?
These are all people who've talked repeatedly, Lord King particularly, about the limits of central banks and how they can't do everything. In some sense, we would say that was recognized this year in the fact that it was really government fiscal firepower that came to the rescue in the crisis for the pandemic, and it was central banks that kind of underwrote that, made sure that they could actually fund it in the markets by expanding their balance sheets. So I think there's a recognition now that it has to be a two-sided thing, but all of them are pretty concerned that we still look first to central banks to solve all our problems.
But why are they not worried about the explosion of debt?
Yeah, it's funny. It didn't come up once, which, okay, it wasn't that long a panel, but if you look at the numbers, you might be surprised. It was striking to me, perhaps, the absence of concern around that. And we've seen at a global level, although actually the exception to that is there was a lot of concern from Raghu Rajan and others about emerging market debt. And I think there is a growing concern about what this pandemic in the end is going to do to private and public balance sheets in emerging markets. But as from the advanced economies, they just don't think that's the priority. And people like the International Monetary Fund would agree with them on that, with the cost of borrowing so low.
I look, Steph, at where we are in central banking, and there's just so many different ways to go here right now. Let me give you an open question, which is simply, what is your outcome for the linkage of fiscal and monetary policy for 2021? I know you're going to tell me each nation is different, but just what is the view of how central bankers, as the adults in the room, nudge or direct fiscal policy?
Well, you heard Janet Yellen there talking about that in a very explicit way. Look, the linkage is pretty clear when you just do the numbers. We've had our economists at Bloomberg Economics look at the amount of extra borrowing you've had by governments this year as a result of the pandemic in the advanced economies as a share of GDP. And you just compare that with what their central banks have done in terms of expanding their balance sheet, in terms of quantitative easing. The numbers are remarkably similar. Now, every central bank you talk to says, oh, we had our own reasons for doing this. We were looking at financial market functioning. We just ended up in in effect, helping to finance all of that extra borrowing. But I think that's what you're going to see going forward is actually, in the end, quite a lot of coordination between the fiscal and the monetary, but a desperate effort by central banks to defend what they're doing on their own merits and not as some kind of loss of sovereignty or loss of independence. Right. See why they would do that.
Real quick, Stephanie Flanders, did you talk to Janet Yellen? Is she our next Secretary of the Treasury? Anything you want to break here?
She wouldn't give me an answer to that. My own bet is that her skill set was better served at the Fed, but who could say? I think she's obviously in the mix, but there's plenty of other strong candidates. And she was... I do think she would be, for my personal opinion, she's better suited to the Fed.
Stephanie Flanders, thank you so much. Of course, a wonderful panel yesterday on central banks. We're going to continue here with Steph running all of our economic shop worldwide. Futures at -14 right now in New York City. Our first word news. Here's Ritika Gupta.
Thanks, Tom. President-elect Joe Biden says containing the coronavirus pandemic is vital to the economic recovery. He's vowing to spur a rebound in 2021, but also urging Congress to pass a stimulus bill this year to deliver immediate relief to Americans. Biden says it should be like the $2.2 trillion HEROES Act already passed by the House. The general outline of a future trade deal between the UK and EU is clear to both sides. That's according to Ireland's Prime Minister. But he's warning it's not yet clear if his UK counterpart Boris Johnson truly wants an agreement. The UK says it wants to see realism on the part of the EU in the talks. And flexible working could be the solution for businesses struggling to recruit women into senior roles. That's according to a new study by Zurich Insurance. Women applying for management jobs jumped 20% after the insurer advertised the roles with part-time and job share options. As a result, the number of women hired for senior positions jumped by a third. And the strongest storm of hurricane season has hit Central America. It made landfall late Monday in Nicaragua, bringing catastrophic winds and torrential rain. Now 105 miles per hour, its winds are powerful enough to cause deadly mudslides and trigger a humanitarian crisis. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
Ritika, thanks so much. This will be the interview of the day for Washington. Within the headlines, there is one telling reality. The risk of the House for Speaker Pelosi, the battle of moderate Democrats and liberal Democrats. With us, Brendan Boyle of Pennsylvania. This is Bloomberg. Good morning.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
A competitive approach to China was inevitable, but keeping it healthy and not pernicious is vitally important, and that won't be easy.
But unless there is some basis for some cooperative action, the world will slide into a catastrophe.
But what I do believe both sides are capable of through the highest level diplomacy at an early stage of the Biden administration is to define the parameters.
We should build an open world economy that works for all. We must firmly safeguard the multilateral trading system under the WTO and unequivocally reject unilateralism and protectionism.
When your economy becomes, so big and your interests are all over the world, you have to protect your own interests.
The American administration is about to change, but the clock will not simply be rewound.
I hope that he will be able to focus his mind on developing a framework for an overall constructive relationship with China, because the last 4 years have been quite a tumultuous ride.
Unfortunately, some forces are acting against the trend of the times. They have trumpeted the decoupling and willfully walked away from international commitments, posing challenges to multilateralism.
I don't think we're going into a world of deep protectionism going forward. I see more regionalism.
Some of the top business and political leaders speaking on the future of the U.S.-China relations at the Bloomberg New Economy Forum. Now, later today, also at the Bloomberg New Economy Forum, we speak with the ECB President, Christine Lagarde. That's at 4 p.m. in London. That's 11 a.m. in New York. And certainly the ECB having many challenges on how to recalibrate monetary stimulus after the second wave of the pandemic. Let's get back to Stephanie Flanders, Bloomberg Senior Executive Editor for Economics. He's still with us. Stephanie, thank you so much for staying with us. How does the ECB recalibrate given the challenges ahead?
I think that what they're looking at is how much they can. I mean, what's interesting about what we've heard from Christine Lagarde recently is a sort of rejection of the idea that their existing approach needs to be completely retooled. She would argue that there is scope for them to continue to use all the instruments, including the new instrument for bond purchases that they've introduced this year. A little bit of skepticism about that, given the scale of the challenge, where you look at where the inflation forecasts are now, where they're expected to be, even if the Eurozone bounces back from this second wave of shutdowns, as we hope and expect.
But Stephanie, if you look at the vaccine, will it come too late to actually, support the economy? How much more damage can we see on a lot of these European economies? And is there anything more, apart from cheap credit, than the ECB can do?
I think they are going to have to think again about, or at least continue the conversation around fiscal support. We do have the recovery. I mean, one thing that's good about the timing is that it's been sort of very fast by EU standards, but still not actually getting the money out of the door yet, that 750 billion euro recovery fund. For some of the key economies, some of the worst affected economies, particularly in the fringes of the Eurozone, that is going to be a big boost as a share of GDP if they can get the money out of the door into those projects. So I think that the focus will shift there and on what they're spending the money on. Are they putting it into things that will support growth, not just hold the economy together or hold it in standstill. And I think otherwise, governments are going to continue to be under pressure to keep up these sort of job support programs. But with any luck, we will see a bounce back at the end of the year from the lifting of restrictions. Most countries look like they are on course to have at least a partial lifting.
Stephanie, it is 15 years on. I can't believe I'm saying that. 15 years on from Dooley, Folkerts, Landau, and Garber's seminal paper on international adjustment. They didn't write that paper at the negative bound. How does Lagarde, how does Europe adjust with negative interest rates? I don't see it in the textbooks, and I don't see it applied. How do they do that?
Well, partly through the fiscal, and that's why the recovery plan is so significant. If we end up with a form of risk sharing, a form of fiscal policy, if you like, European fiscal policy, we're going to have European EU-funded bonds to support part of that plan. Then we start to see a capacity to adjust. I mean, you're right. There isn't the countries by themselves, without control of their own currencies, are going to struggle to come up with enough impetus, enough impulse. But with the support of that plan, well, maybe you can chart a course. But it doesn't suggest that the ECB is going to be able to start moving back to normal anytime soon.
Yeah.
Stephanie, given where we are in the UK and we're still, negotiating, although we seem to have some positive noise coming from the negotiations on Brexit, how likely is it that in 2021 we'll see negative rates in the UK?
We've had a little bit of pushback from the Bank of England just over the last few weeks. I mean, they would claim that they have done their duty in doing the due diligence of going through what is, I think, they're still in the process of doing their market review. They don't think about whether or not they can do what the implications for markets and for financial institutions would be for negative rates. I don't sense it's on the near horizon. They've known about the adjustments to the non-transition era of Brexit, the kind of proper Brexit in January, for a long time. We know that's going to be a jolt. Even with a deal, we know there's going to be a big jolt because it's a big change in trading conditions. I don't see it in the very near term, but it is clearly part of the toolbox if you're looking further ahead, if they really struggle to pull the UK out of this.
Stephanie, thank you so much. Our Stephanie Flanders, our Bloomberg Senior Executive Editor for Economics, joining us this morning. Now, also join us a little bit later for more of the Bloomberg New Economy Forum. We have great guests, including the Indian Prime Minister Narendra Modi, Banco Santander Chair Anna Botín, Ray Dalio of Bridgewater, and you can watch all of that live on Bloomberg.com, on the Bloomberg Terminal, or of course Bloomberg New Economy's social channels on Twitter and Facebook. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
learned how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
And the joy of vaccines. Yesterday, a conversation with its chief executive officer of Moderna. What we know is, well, there's 2 vaccines out there, many more to come. We need to step away from the vaccine frenzy, what it's clearly done to the markets, and speak with Dr. Fazeli right now of Bloomberg Intelligence, just wonderful on pharmaceuticals, the pharmacology that we're looking at. Sam Fazeli, I want to move away from Moderna and Pfizer to the other kinds of vaccines. From where you sit, is it the land of messenger RNA and this new science, or can more traditional vaccines be part of the game forward?
Good morning, Tom. Well, yes, they can. At the end of the day, we need to see how these vaccines all behave over the longer term. And we won't have enough doses from Pfizer and Moderna. At max, we'll have about 2 billion doses by the end of next year. So that falls far short of what's needed globally. So we do need other vaccines. Also, in case the longevity or the durability of these other vaccines, or the Pfizer and Moderna vaccines, aren't as good as what we would hope to see, and perhaps other vaccines are needed to come and boost that up.
How close are we to those other vaccines? Are we going to see spectacular joy and announcements, or is it a long slog ahead within traditional adenovirus and other vaccines?
Yeah, so the adenoviruses from AstraZeneca and Johnson & Johnson, I just put out a note this morning saying that I'm a bit worried about the Astra trial data that we're expecting by the end of this year from the UK and Brazilian trials. The US trials just kicked off, so has Johnson & Johnson. So that data will be in the first quarter, but of course the infection rate's so high that we might get that a bit earlier than we would have done before. And then beyond that, we'll get the more traditional vaccine data. So there's still more to come, but obviously Pfizer and Moderna have set up a pretty high bar.
So Pfizer and Moderna, Sam, I mean, if you have 2 vaccines that have such, great trial data, is it quicker to distribute? How are these 2 vaccines actually different?
Well, they are actually a lot more similar than different. They use very similar technology. That the piece of RNA that they use is pretty similar. So, and the fact that one needs a slightly lower temperature to be kept at is probably because they haven't studied it for as long, and over time that might evolve. So we just have to wait and see how they differ in the longer term in terms of their durability or any other details, such as which one's better for older people, etc. But I'm going to assume until we see something different that they are going to be pretty much the same.
Sam, what are some of the questions that you still want to know about these vaccines? If you look at the markets, they're very optimistic that we go back to normal, maybe early to mid 2021. Having a vaccine, what are the questions that we don't know? Can you still pass the infection even if you take the vaccine yourself? What are the other things that we should be thinking about?
Yeah, Francine, the list is a bit too long for a short TV hit, but you've just hit on one crucial one that you've just mentioned, and that is, if you're vaccinated and you don't get symptoms, are you still infectious? That's something that has to be worked out. And unfortunately, I don't think the trials as they are today from Pfizer and Moderna are designed to answer that question in detail. So someone else needs to study that. And then, of course, is how long does immunity last? If I take my jab today, am I good to go for the next 1 year, 2 years, 5 years, 10 years?
We learned the complexity of this from Sam Fazeli. Sam, just treasure. Thank you so much with Bloomberg Intelligence this morning. Futures negative 16, red and green on the screen. A little bit of a lift to the NASDAQ right now. The VIX shapes up, coming in from a 24 level to 23.10 with a 22 handle yesterday, showing the good markets. Let me give you the level on the Dow futures, 29,768, a real dash to 30,000. Yeah, we're on the 30,000 watch, I'll admit it. Bonds come in a basis point, really not much action there, 0.89%. Curve flattening. The real yield, well, negative 0.86% there. We'll have to watch that carefully. Sterling, we're watching, of course, off that Brexit headline Francine Lacroix mentioned, 1.3243 as well. On the application of central bank theory to fiscal markets and also to the interest rate market, Christopher Rupke will join us with MUFG. It'll be a good time to catch up with him. Stay with us. From London, from New York, this is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
This morning, there is no room at the hospital. The constraint is not cases or deaths. The constraint is exhausted nurses and doctors. Sweden will make a, quote, unprecedented response. Philadelphia is closing high schools. Iowa will limit gatherings, spiritual gatherings accepted. Markets, they're spared at Dow 30,000. It is in sight. Pacific Rim currency strengthened. And Donald Trump is his own Secretary of Offense and Secretary of Defense. He wants to, quote, strike Iran and withdraw troops from Afghanistan, Iraq, and Somalia. Good morning, everyone. Bloomberg surveillance from New York, from London. Tom Keene and Francine Lacroix. So much to talk about as well. The news flow at this moment is really quite extraordinary. We're expecting Home Depot earnings. I see same-store sales for Home Depot up a pandemic number, 24.6%. I don't believe that number. We'll have to see if that's true. It's truly an unbelievable number. And Francine, these are seismic announcements from Amazon where they dive into the competitive field of how we get our pharmaceutical drugs.
Right, Tom. So this is what I'm seeing. This literally breaking out moments ago. Amazon is expanding its push into healthcare with this online pharmacy. We understand that Prime customers will be offered fast delivery and discounts for medicines. And this is a new digital drugstore that could come after the acquisition of PillPack in 2018. This could be huge news, Tom, given the fact that Amazon is so big and has so many strides that, the fact that it's pushing into selling prescription drugs is launching a digital pharmacy could be a real game changer for healthcare.
Yeah, as well. Now, we've got this story. We're going to drive this forward, and this is a huge announcement, widely anticipated on the street. Within the blur that I saw from Amazon, I would suggest folks meanwhile, on Home Depot, the pandemic.
Yeah, it does. And we saw a similar trend here in the UK. I mean, the figures are absolutely amazing for Home Depot. And of course, they come a day after the company also announced this block about all the people that are at home, Tom.
All of that backed by Home Depot. Francine, I really want to point this out because I think it's so important, folks. Apple, Amazon, Apple, tech, in all. The Amazon story as well. What a news day with our first word news in New York City is Ritika Gupta.
Morning, Tom, Francine. The Trump campaign is withdrawing a key part of its lawsuit against the election result in Pennsylvania. It's abandoning demands that but his transition team is still She's postponing major decisions until next week after being unable to reach a deal with regional leaders. Instead, she's urging people to limit public and private gatherings. And 4 astronauts have arrived on the International Space Station after a 27-hour voyage on the SpaceX Dragon capsule. They'll now begin their 6-month scientific mission aboard the orbiting lab. It's the first time in NASA's history that a full crew has been ferried to the space station on a commercial vessel. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
Ritika, thanks so much. Short data check here. We've got to get to Kevin. Really, futures red and green on the screen. I'm very good. As part of our new economy forum, it is always good to speak to former presidents. Here, William Jefferson Clinton.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
Bill Clinton, always a pragmatic person. We learned that over his very successful presidency over 2 terms. Kevin Cirilli joins us now, the pragmatic one from Pennsylvania. Kevin, I want to take your Pennsylvania knowledge and fold it into where we are right now, which is Speaker Pelosi and the gentleman from the 2nd Congressional District, Mr. Boyle, who we will speak to on surveillance today, in middle-of-the-road Democrats dealing with the liberal left, as they would say on Fox. How petrified is Speaker Pelosi, and for that matter, Congressman Boyle, of losing the House?
You know, over the next 2 years, I think that there's definitely this baked-in optimism amongst Republicans that I speak with, Tom, about that they are on the cusp, from their point of view, of a resurgence of sorts in the 2022 midterms. I can tell you that people like Congressman Brendan Boyle, as well as other more moderate progressives in the House of Representatives and suburbs all around the country, feel that they have been really muted on their microphone as a result of a lack of digital advocacy in their wheelhouse. And they feel that the reason they've been able to make gains in the past several years previously in the House of Representatives is because they ran as more moderates, because the AOC model wouldn't work in the suburbs of major cities. That's just what they believe. And so it will be fascinating to see whether or not that tension is going to still be on display. But President-elect Joe Biden has made clear, based upon the names on his transition landing teams, for example, that he is much
to the congressman from the 2nd says the left, Fox and the rest of, Fox and the rest of will say defund the police is the hot button.
with the younger, more newer members of the Senate.
Make not that much difference.
Well, the markets haven't blinked upon the various developments, the legalities within Pennsylvania, another withdrawal of some of the lawsuit. Look, I think that here in Washington, D.C., Republicans that I speak with are rolling their eyes at best. And in other times just shrugging their shoulders. But they do view it as a potential political asset in terms of strategy, Francine, for politics, especially ahead of the runoff elections in Georgia in the first week of January. So it's getting a reaction, but not it's not viewed as a hindrance, so to speak, on folks being able to go about their work in this lame duck session.
So the transition, Kevin, will be put in place. I mean, we were discussing yesterday with Tom whether, at some point there'll have to be legal challenges to force the transition from the Republican side to go into place. Is that slowly becoming easier to manage?
Here's what I'll say. I talked to sources last week at the State Department, and I asked them about this notion of the transition. As is typical every go-around, staffers prepare binders, transition binders for their predecessors. And so it can be utilized for both individuals who are going to take their job if there is a second term, but also obviously the handoff for other individuals if it's a new administration. That work typically takes months and is started at the end of the summer, and that is precisely what members at the State Department have already begun preparing. And so in that regard, they're on track for that. I think the pomp and circumstance of a public transition, which is a staple and a historic, sobering tradition in the United States, that's where there's the biggest question mark at this point.
Kevin Cirilli, thank you so much. Our Chief Washington correspondent. We've got much more coming up here. Of course, the news from Amazon as they dive into a widely anticipated pharmacy, maybe a drugstore, by mail, by cardboard box as well. Home Depot out with earnings. On the central bank story on monetary theory, Alan Blinder will join us at Princeton, the former vice chairman of the Federal Reserve System. Red and green on the screen. Futures at -20. This is Bloomberg. Good morning.
Are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The notion
notion that the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential.
My favorite panel that we've seen at NEF, Janet Yellen, Mr. Ragan of the Booth School in India, as well as a few other worthies there on central banking with Stephanie Flanders. Really, really valuable. Joining us now to carry that conversation forward, Christopher Rupke joins us with MUFG Union, their chief financial economist. And Chris, I want to go to your wonderful, wonderful, wonderful research note, which is classic Rupke, where you go into the equations and look at the dynamics. And the dynamic is the desire and the demand of investment just isn't there. What have you learned?
Yeah, it's, well, we're factories, they're not spending on office space, not as much warehouses, and especially they're not doing oil and gas drilling structures.
The textbooks tell us that the greatest variability in a slowdown comes from the investment side. Great. What have you gleaned from a natural medical disaster? Is it the same as a recession, or is the investment dynamic, the negative aspects of it, is it different in a pandemic?
Yeah, it's very interesting. I mean, it is fair, I think, to call this a pandemic recession. You know, we're going to get industrial production later today, which kind of defines the business cycle for over a century. And it fell for 2 months, and then it hit bottom. So the recession should have been over in April and May, theoretically, based on this number. So it's very much COVID-based, and I'm going to be very interested to see retail sales today. It's October. I'd rather see November data, but October data for retail sales, we want to see if this second wave of the virus spreading, is that going to bring down actual spending on the part of consumers?
To enough people globally by, let's say, the end of the first quarter of 2021. How much does that limit scarring to the economy?
I think, I mean, usually we use, I just heard Janet Yellen in the background on your program. And, yeah, the scarring tends to be, and she's brought this up before, the scarring is that the job losses become more permanent. People are out of the labor force. Their skills grow rusty. Now, people have just lost their jobs in the last handful of months here, so I don't think they're losing their skills right now. But it would be important if the virus can give people confidence so that the social distance I do as well. That business travel is not going to be coming back as quickly. I don't know if I buy that. The only thing that kind of worries me here at a stay-at-home economy. Well, what if we're not going to be at a stay-at-home economy this time next year? Just something isn't adding up here in terms of the stock market's lofty valuation.
Chris, just very quickly, I mean, we heard this morning that Amazon was going in
Interesting. I don't know. I mean, new companies, I think it's a little bit slower than you think here. Another 15.3%. Disruption, if you will.
Chris, thank you so much. Chris Rubke there, MUFG Union Bank Chief Financial Economist. Now, coming up, we'll have plenty more on central banks and scarring with, of course, Christine Lagarde, an exclusive conversation for the Bloomberg New Economy Forum. That's at 11 a.m. in New York. That's 4 p.m. in London. You can watch it live on Bloomberg, but also Bloomberg.com. This is Bloomberg.
Where you actually got to be an interviewer. How did that actually happen?
Well, what happened was this is what I now. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25, then you're 30." So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000,
Right.
So they kept me on and said, "We'll put you on this talk show just to run out your contract."
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I'm a huge believer in UK finance.
Good morning, everyone. Francine Lacroix in London, Tom Keene in New York. Francine knows it is different in the United Kingdom. position want to be a
at the same time, the major drugstore chains have been freaked out about it for years and years and years, and you've seen that reaction in their investors as well. Amazon has gone after every other part of the drugstore, and it always felt inevitable that they would go after the prescription counter in the back. And I think this makes that as final. Like they have been doing, I think. Or something like that, and you might not want to be out around other people. Like, this is it.
Okay, I totally agree with you, but to me, it's so much about price and the fury that older people have about drug costs in America. I just went in and signed up for this thing, folks, like everybody else is going to sign up. I had to I lied the entire way through, Drew. I said I was healthy and all that. Drew, the first thing Amazon wants to know is what state I'm in. Is it your understanding that this can be a national effort, or are they going to be blocked by selective states?
Yeah, I was just paging through to just see exactly where they're available. The reason that they're asking that is because to operate, you need, to be in the pharmacy business, you need a state pharmacy license. This is a state licensed business. And so, you have to actually have the ability to do that. The PillPack acquisition, as well as some of the efforts Amazon has taken subsequent to that, they've been going out and doing the state licensure process over the last several years. I think there have been a number of reports of them going out and making sure they're okay to operate. So it looks like they're available in just about everywhere. I haven't gone through every last state to check that. But, yes, this is going to be a business that I suspect a lot of people will pick. Price will matter, but they're also going to go after insured customers. I think it'll be interesting to see what happens with those folks who actually, need to go and speak to their pharmacist and like to go and speak to their pharmacist, and how they work around that. PillPack has done a lot of that business by phone, but there's people who like to be able to go and and visit with their pharmacist and see their pharmacist and talk to their pharmacist and check on their medication. Obviously, again, though, with the pandemic, I suspect a lot of that has been curtailed, and that is a moment of opportunity for Amazon.
Drew, the media was disrupted. If you look at hotels, it was disrupted. Travel was disrupted. The healthcare seems to be the last bastion of industry that has not been disrupted yet. Is this just the first wave of disruption for pharma and health companies?
I think it is going to be interesting to see whether this represents a broader entry into trying to shake things up in healthcare or an opportunity to pick around the edges. We've seen lots of people who have looked at opportunities to pick around the edges, but run into plenty of trouble when they try to disrupt healthcare more broadly. And, you can put Amazon into that second bucket as well. Remember, they had that effort with JP Morgan and with Berkshire that they were going to hire, a tool go on day and have Haven Health and start remaking the health system. And it appears to have gone absolutely nowhere. It is very, very, very hard to truly disrupt healthcare in a meaningful sense once you get into the area of, hospitals, doctors, insurance plans, where a lot of the real money is. Drugs are a chunk, but they're, around 10, maybe 15%. So this may be just the case of something that this is the last retail. Think of this rather as the last retail item that they were going to go after than the first healthcare thing.
Drew, thank you so much. Drew Armstrong there, Bloomberg News senior editor for healthcare, joining us today on this big news on Amazon and pharmacies in the U.S. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Thanks, Francine. President-elect Joe Biden says containing the coronavirus pandemic is vital to the economic recovery. He's vowing to spur a rebound in 2021, but also urging Congress to pass a stimulus bill this year to deliver immediate relief to Americans. Biden says it should be like the $2.2 trillion HEROES Act already passed by the House. The general outline of a future trade deal between the UK and the EU is clear to both sides. That's according to Ireland's Prime Minister. But he's warning it's not yet clear if his UK counterpart Boris Johnson truly wants an agreement. The UK says it wants to see realism on the part of the EU in the talks. Flexible working could be the solution for businesses struggling to recruit women. Analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. As we spoke to Kevin Cirilli of Pennsylvania, our chief Washington correspondent, we got a nice briefing on the tension that's out there. Now, with any congressman, there's like 14 ways to go. But with Brendan Boyle, it is different. His father was immigrant from Ireland. He started out with the most basic of family upbringings in the Philadelphia area, and has really made something of it. He is a gentleman from the 2nd District of Pennsylvania. We're thrilled that the moderate Boyle could join us this morning. Brendan Boyle, I want you to explain right now to our international audience the threat of the majority that Speaker Pelosi and you face by the left. How afraid are you that with action over the next 2 years, Congress could be tossed to the Republicans?
Yeah, well, thanks. It's good to join you even at this ungodly early hour.
Got that right.
I give you credit doing this every day. Let me say, I'm certainly not afraid. Look, I think that for any political party to reach a majority, to get to the magic number of 218, it's going to require a certain amount of ideological diversity. Certainly, I saw that when the Republicans were in the majority. And now we see it that we've been in the majority. So I think actually the last 2 years speak for themselves, are pretty good. Now, the one difference moving forward is obviously our majority is reduced. We're still in the majority, but it's a smaller number than it was 2 years ago. That said, though, I have previously served in the state legislature in a majority that was razor thin.
Yeah.
And one of the things that you saw is that there was a little bit more camaraderie and the idea that no person could be a free agent, that we all needed to stick together. So oddly enough, in some ways, when you have a very close majority, it actually does improve the solidarity and the teamwork.
Somebody on the left says defund the police. Is that way overplayed by the media, or is that really harmful to Brendan Boyle and Connor Lamb moving Pennsylvania forward as a Democratic majority?
Yeah. That has about 5,000 Philadelphia police officers. Obviously, you know, a slogan of abolish the police or defund the police doesn't exactly help us with them and their families. Now, Was that the only factor at play in the election? No. Sometimes when you look at post-election analysis, people quickly attempt to find one magic bullet solution when, you know, in reality, the answer to what happens in most campaigns tends to be complex.
Congressman, good morning. The fact that Donald Trump still hasn't conceded the election, what does that mean? Does it make it more sympathetic to the Democrats, or do actually, people in the U.S. believe President Trump?
No, I mean, let's be clear. Joe Biden at this point has won 5 million more votes. He's up by about 4 percentage points and 306 electoral college votes. Even if somehow magically the results changed in a couple of states, even if it had changed in 3 states, Joe Biden would still be the president-elect of the United States.
A lot of your stores in your state.
Yeah, I think this is a major systemic question that we have to face in our economy. And that is, especially during the pandemic, the big guys have gotten bigger and the small guys on Main Street are either not open or permanently put out of business. And I think for all of us, just as consumers, we face this as well, because I use Amazon. It's easy. It's convenient. But then the reality is that Amazon has the power of questions that we need to confront. And that certainly when it comes to antitrust, Washington, D.C. really needs to be more active.
Oh, Brendan, let me go there. I think it's important. And yes, it's not Philadelphia. It's maybe Western Pennsylvania over to Cleveland of long ago and far away. Think Ida Tarbo. But it is Standard Oil. I mean, that's basically what we're talking about is a Standard Oil model. Would you suggest that Mr. Biden as president will lead us toward a regulatory milieu that gets us to Standard Oil actions on stocks like Amazon, companies like Amazon?
Yeah, I wouldn't suggest it, but I think the Justice Department needs to take a firmer look at a number of these areas where the power of monopoly is growing. Ultimately, despite the convenience of an Amazon app, monopoly is not good for our free market. It's not good for consumers. And that is something that I think we need to take a less of a laissez-faire look at.
Brendan, what are you going to do about the Philadelphia Eagles? I got 10 seconds. What are you going to do about the Philadelphia Eagles? Fix it.
3-5-1 is a disgrace. Even more of a disgrace is that we are still in first place in the NFC East. I apologize to the rest of the nation for the state of the NFC East.
Very good. Your apologies accepted. Brendan Boyle, thank you so much. The 2nd Congressional District of Pennsylvania. Later today, driving the conversation forward, the Senator from Tennessee, Marsha Blackburn, with us. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news
they've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg surveillance, really interesting show today. Lots of good conversation here across what we do, economic.
It's getting darker in terms of the coronavirus cases we're seeing really across the country, in Europe as well. And more worrying from an economic point of view are the decisions that are being forced upon mayors and governors to go back to their playbook from March and April, restricting business activities, restricting movements, closing restaurants and stores, that sort of thing. That, I think, is something we weren't expecting about a month ago, and makes the winter look that much more challenging.
Right.
And, you know, we'll get a retail sales number later this morning, but what we really want to know is what the retail sales number is going to look like in December.
Our theme this morning, and with John Norman of JP Morgan as well, has been just on simple aggregate demand is not there. Can government institutions
Will it be? And how much damage will have been done by the time it gets out the door and into people's pockets?
Christopher, good
that have been announced, but others will be on the way. Their effectiveness is higher than expected. There is a distribution plan coming into view. It's not going to be all at once, and there'll be some bumps along the way, clearly. But there is a sense that there is a bright light on the other end of the tunnel. We're just still not clear how dark the tunnel is going to be between now and when we get there.
Yeah, what happens to treasuries in the meantime?
Well, you're seeing the markets kind of play out that bifurcation, right? The stock market is pricing in the light, and as usual, the Treasury market is more concerned with the darkness between now and then. And I should say, you know, once we even get through to the other side, we're going to be a global economy that has been scarred by this experience. There will be, you know, weaker balance sheets, a labor market that is damaged both here, not so much in Europe, but still there will be some struggles there. And I think that's what, you know, once we even get through to the spring, we'll be looking at what does 2021 look like. Coronavirus will be behind us, but we'll still be facing all of those slow growth, issues that we had coming into the pandemic.
Christopher, the heart of this is we will manage the method and we will struggle. The institutions, the elites will struggle. The haves will struggle to have smooth reaction functions. And then there's China. How does China play into this? Do they want us to have smooth reaction functions, or are they going to go their own way? And do we look for instabilities because of China?
I think China, at a base level, wants to see the global economy grow because that benefits the Chinese economy. And so I think they're probably rooting for us to succeed and get out of this pandemic as quickly as possible. Having said that, the relationship between the U.S. and China has been deteriorating for several years now. It's not just Donald Trump. It's not just trade. There are issues across the board around North Korea, around Taiwan, around Hong Kong that are going to make the relationship much more complicated going forward. And I think that is going to, at some point, come back into what markets are going to be looking at. Not right away. I think Joe Biden will come in with a fresh start, but very quickly, I think those issues are going to be back on the table.
Christopher, what do you make of Russia? And actually, it seems that investors have so much appetite for green investing and sustainability at the moment that if Vladimir Putin doesn't focus, at least at the margins, on climate change, investors could severely punish Russia because of it.
I think it's, that's clearly part of Russia's problem in terms of its environmental, social, and governance issues, but it's not just the environmental issues that hurt its ESG scores. I think investors are going to be looking at that, but it's part of a broader struggle that investors are facing in terms of how much do they invest in oil, carbon-based energy versus renewables. I think with the U.S. Now very focused on a new climate agenda, that's going to nudge investors across the board to look at how there will be more incentives to shift to a greener economy. And Russia is part of that puzzle, but not the only part.
Christopher Smart, thank you so much. Barings Chief Global Strategist and Global Head of Barings Investment Institute. Now, coming up, we continue tracking COVID-19 and the pandemic. Up next, Amish Adalja, a Johns Hopkins Center for Health Security Senior Scholar. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Now we continue to track COVID-19, and of course, no one better to talk about this than the leading authority on the pandemic. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Joining us now is Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. Dr. Adalja, thank you for joining us. It seems that the vaccine that Moderna, talked to us about yesterday is much easier to distribute because of the need for refrigeration actually at a lesser level for 30 days. Is this a game changer?
I do think that this is going to end up being probably one of the first generation vaccines that is the vaccine of choice, because everybody was excited about the Pfizer efficacy numbers, but we weren't so excited about the fact that it needed to be stored at -70, -80 degrees centigrade. The Moderna vaccine, because it can be stored at normal, achievable temperatures that don't pose a major logistical challenge, does make this prospect a little bit easier. It's still going to be daunting, but it is going to be something that is much less complicated when you don't have to think about freezer farms and trying to make sure that the cold chain remains intact.
If you look at the Pfizer vaccine and the Moderna vaccine, there are a new generation of vaccines called mRNA. What do we understand about them? What do we know about them? And can they actually change vaccine development forever?
I do think this is the case. mRNA vaccines are going to have, a major impact, I think, on vaccine development in the future. And these are the first two that we're really seeing in advanced clinical stages. But what they offer is the ability to very elegantly be able to make a vaccine quickly and put it into clinical trials, because all you need to know is the genetic sequence of whatever you're trying to immunize against. And then you can basically print it off and then inject that gene into people, and then your cells start to make that protein and your immune system reacts to it. So the fact that you can do this so quickly may make a lot of vaccines that have been out of reach or been too expensive because of the cost of research and development much more within reach. And it could change the way we think about emerging infectious disease outbreaks, and there are also applications for cancer and other types of vaccines. So this really, I think, will jumpstart the mRNA vaccine field, and I think will likely pay a lot of dividends in the future when it comes to public health and other medical conditions.
Dr. Adalja, talk to me a little bit about whether the fact that this is a new vaccine, there will be a lot of misinformation. Will, fewer people want to take it, given the very nature of these vaccines that we haven't tried out yet?
This is a definite possibility. Even for vaccines that have a lot of information, we have people who will be susceptible to misinformation and lies about them. And we have a very vibrant and vocal anti-vaccine movement that is poised to pounce on this vaccine the minute it is approved. So I do think we're going to have to be very transparent about the risks, the safety profile, the risk-benefit ratio in a way that we really haven't. Because if this vaccine doesn't get into the arms of the world's people, it's not going to be a worthwhile vaccine. So we have to really make sure we get this right, because during the 2009 H1N1 pandemic, we didn't see very great uptake with that vaccine, and it was something that was done using tried and true flu vaccine technology that wasn't new. So this is going to be even a little bit more difficult of a communications issue, but we do have to start to be proactive about it, and I do think we will get a safe and effective vaccine based on the data that I've seen. But again, there's just always that issue when you're doing something new in the middle of a pandemic, and this perception that this was rushed versus the fact that this is just a function of the fact that they used a really innovative technology that allows you to go fast.
How are hospitals coping? Which hospitals and states are actually at near capacity?
Well, this sort of changes every day, but the ones that we're worried about now are still North and South Dakota, Wisconsin, Iowa, Utah, El Paso, Texas. That's where we're hearing the most stress that's going on. And there are likely going to be more. This is going to be roving. Every hospital now in the country is dealing with COVID-19 patients for the most part. And they're dealing with a higher number than they had even during the peak in the spring. So this is something that is not sustainable if we don't get some level of control, just enough to have some breathing room, because hospitals are not only taking care of COVID-19 patients, they have to do everything else. They have to take care of heart attack patients and trauma patients and stroke patients. And we don't want that care to be compromised. So we have to get some level of control so that the vulnerable populations are not getting hospitalized. And that's what we continue to worry about. That's what flattening the curve is about to me. It's trying to keep it below hospital capacity to a manageable level. And I think we're failing because many states do not have the public health infrastructure to intervene on these cases. And you have a population which is really not listening about the fact that we live in a pandemic and you have to take some common sense precautions.
Does that change with the Biden administration? I keep on reading these, frankly, incredible stories in U.S. press of people dying of COVID-19, but not believing they have it.
I do think it will change with the Biden administration, but you have to remember that the Biden administration isn't going to take office for over 60 more days. So this train will continue to accelerate. It is going to become harder and harder to stop. But I do think that the plan that's been outlined by the Biden transition team about really investing in testing and rapid testing and in at-home testing, as well as looking at hospital capacity. And I do think also just the simple fact that you wouldn't be getting misinformation, you wouldn't be getting lies, you wouldn't get undermining of experts like Dr. Fauci, you would have the CDC back in the front seat driving this. All of that's going to make a major difference in how the American public think about this pandemic. It's just that we have to wait 2 months for that. And I think there's still a lot of damage that's going to be done between, and people are going to die between now and then.
Amish, thank you so much. Amish Adalja there of Johns Hopkins. Be sure to check out VRUS Go on the Bloomberg. Now, coming up, we have plenty more of the New Economy Forum with Christine Lagarde.
A Roma c'è un francese che mi ferma e poi mi fa: Monsieur, la città di...
We're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail, right? We've seen that. So we're going to have to figure out how to retrain that workforce.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
We've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
The market in the next 2 months seriously will start to reprice everything.
Growth will pick up a lot in the second half of next year as people get back to normal.
Normal doesn't look like January of 2020. The world is different.
People have money and they want to spend and they can spend, and I think they're going to.
We've been in a bull market. We remain in a bull market.
We're now through the election and we can sort of face forward into what I think is going to be a very big 2021.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market pulling back from all-time highs. Tom Keene, record high COVID cases meets record high stock markets. That is the stark contrast of the last couple of weeks.
The VIX down to a 22 print. We're just back to 23.17. I'm going to call it market churns. John, you'll do a data check better than me. What I would look at is the news flow that's out there. And John, the clear message I get in every surveillance conversation is corporations are adapting and adjusting to a slowing economy, knowing those vaccines are out there. Obviously, the celebration yesterday.
And that's the market celebration, Tom. Society's celebration about the future, the forward outlook, not the here and now. Nothing to celebrate about the next couple of months. President-elect Joe Biden talking about a dark winter for the next 3 months, Tom. The South Side has started to push back this morning. I think that's important. SocGen, it's understandable, but it's unsustainable. That was Kit Jukes. Bank of America saying the bull might be full. Maybe you should sell the vaccine. Just a little bit of pessimism, or at least questioning the euphoria of the last couple of weeks.
And you see it in the minutia right now with a cyclical play down. We've got red in the screen, SPX and Dow, got green in the screen, NASDAQ 100. John, I mean, you're going to get the back and forth, and somebody's going to be right 6 months later. Somebody's going to be wrong. What I would suggest is you've got 2 quarters of slowing GDP, and then the real debate is what happens out second and third quarter next year. That's what all those year-end outlooks are going to be. John, I know you read every word of every year-end outlook.
Love them all. I wonder how many will have to be rewritten after the next few months, Lisa Abramowitz, given what's happening in the United States of America.
Quiet on the floor.
Have we not got quiet on the floor?
My entourage, John, I'm sorry, my entourage was talking here. Quiet on the floor,
the entourage being Tom Keene.
How many people have you got over there?
I got my usual 4, 5, or 6, which is unlike your 10 or 12 in London.
That is the entourage Tom Keene would love. I've no idea where he's going with this, but he'd love 10 people just like him, surrounding him at all times, and they could all just look at each other.
John, you're entourage.
I think he's
on
playing
radio and TV.
all roles right now.
Lisa, what's so important here is Farrell went over to London, and it's just unreal, the entourage he's got off Queen Victoria Street right now.
They just trail on behind him. Just to bring us back to what we're talking about and to really weigh in on what John was talking about, there is a question about the entry point, the idea that there's a brighter future, but how much pain needs to be felt in the near term and how much pain is currently being felt in the real economy. 8:30 a.m., we will be getting a read on that with U.S. October retail sales. The expectation usually is for October sales to increase. This may be different because we are seeing momentum decline. What are people going to spend their money on if they have to be home and there are restrictions? 1 p.m., Fed Chair Jay Powell is speaking at a Bay Area award ceremony. I'm very interested to hear what he has to say about extending the maturity of the bond purchases they do every month, $80 billion. We did not get any signal from Rich Clarida, the vice chair, yesterday, but this seems to be a bet in markets. They will make a decision on this in their meeting next month. And at 2:15 p.m., I did this for you, Tom, Senate is holding a procedural vote on the Fed nominee, Judy Shelton, and there actually has been some pushback recently by some Republican senators saying, we're not that keen on the whole gold standard thing and the whole non-independence thing. But, if they basically pass her through this procedural vote, she will be up for confirmation.
Yeah, it's really on the knife edge. John, I mean, this is like, it's a distraction. It's not like front and center. But I think knife edge is the word that's being used right now for, did they get Governor Shelton to be a governor?
Last 90 seconds on the show has been a total distraction. Can we just talk about Chairman Powell, the Bay Area Council Business Hall of Fame? Are you in that, Tom?
No,
Did you make the Bay Area Council Business Hall of Fame?
No,
you made it
I'm
yet?
not. No, can we, John,
Chairman
look
Powell
at,
might be.
Can I look at the headline of the moment, John, which really seriously,
please
really,
do.
really
Actually,
matters.
please do.
Walmart right now with that headline from the CEO, John, and this really speaks to where we're going, the idea that new customer behavior will persist. John, that's the money headline for the next 90 days.
Sticky might be the word you hear a whole lot more of over the next 12 months. Let's get to the price action of this morning, this Tuesday morning. Good morning to you all. I'll whip through things for you. A little bit of optimism over the last week, a lot of optimism for that matter. Euphoria, maybe. Futures decline. We pull back a little bit on the S&P 500. We advance on the NASDAQ. Into the bond market we go. Treasuries did not participate in the move yesterday. Basically unchanged, a move of a basis point or so. We come in a basis point this morning to 0.89%. Euro dollar, the euro started to make a move. Christine Lagarde speaking a little bit later. It's a day, it ends with a Y. You will hear from the ECB president. Euro dollar 118.75. I'm not complaining. Crude down about 0.25% to $41.24. Joining us now to kick off our program this morning, Mona Mahajan, Allianz's Global Investors US investment strategist. Mona, Kit Dukes of SocGen said this morning, understandable the last week or so in this market, but unsustainable. Do you share that?
I actually think that the rotation part of this equity move is somewhat sustainable. So, we see, of course, in the next few months, we may get some volatility. We're two vaccines that would produce that. So in our news that could get us through this pandemic in the next 12-month period. So for us, when you think about 2021, where growth may start to reaccelerate because you have a true reopening, not only in the US, but locality, some non-US assets. Some non-US assets. It's clearly their online programs, but also things like a more work from home employee base that's been accelerated through this. We think that's here to stay. To some extent, supports cloud computing. That's why we still think a balance is important. Some of these quote unquote stay-at-home stocks are actually, they have 3, 5, 10-year secular growth trends behind them. And so it's important to have that part of the exposure as well. But, we could see a few months at least of really strong outperformance from the cyclical part of the market as well.
Mona, one of the hardest aspects of this moment is there's the near term, as John was talking about, that's looking darker and darker, and frankly, darker than a lot of people had expected with respect to the pandemic's trends. And then you have the longer term, or the even intermediate term, which looks better than expected given the efficacy of some of these vaccines. You said in periods of volatility to take advantage and go long into the trades that you're talking about. What counts as volatility? What's the entry point that you're looking for?
Yeah, it's a great question because in some cases, and certainly since the start of this quarter, we haven't gotten many pullbacks. In fact, the S&P's up 7.5 or 8% since September 30th, and some of the cyclical sectors are up 13, 14, 17%. So we haven't quite seen a dip to buy quite yet. We do think over the next 2-month period through year end, you're not going to get a continuation of this straight upward movement. There will be pullbacks. Keep in mind, in any given year, 3 to 5 pullbacks in a 5 to 10% basis or 5 to 10% range are normal and are probably healthy. If we go through another period like that, certainly ahead of 2021, I think it's important to start thinking about how you want to position as these vaccines get rolled out, as hopefully we start to see this change and shift in consumer behavior, perhaps a little bit back to pre-pandemic activity levels. And so we do think we'll get a period of consolidation that can be used to position yourself accordingly. So it's important to watch for that.
Mona, to what extent do you think that people were conditioned by the price action of the spring and conditioned to look through what's playing out in America right now? And I wonder what you think the fallout of that actually is.
Yeah, it's a great question, because clearly when the Fed stepped in March, and they stepped in a big way, not only bringing rates back down to the lower bound, adding QE, adding these credit facility programs that really supported the functioning of credit and equity markets, they really did put a bit of a backstop into this market. And so it does feel like markets are conditioned to buy that dip. What we'd say is it's important to stay a little bit active in how you buy these dips and how you position yourself in the marketplace. If you want to have performance that's in line with the broader indices, you do need to think about your weighting in certain sectors, in certain regions, et cetera. And so there is a bit of conditioning, but we think it could be more than just buying the overall market. It's how you position as you move forward. But as long as the Fed is there, as long as global central banks are in play, we think there is a bit of a backstop in the market. And that's to some extent helpful, but longer term, we'll see what the consequences are.
Mona, great to catch up. Optimistic and confident. Here's a quote, a line from what he had to say. I've got more conviction states can potentially worry of wall of money, and Lisa, JP Morgan, I understand, think the Fed might add to it.
Well, that's the interesting thing, is that even though Rich Clarida was really optimistic, people are still basically pricing in an extension in duration, extension in maturities in the asset purchases by the Federal Reserve.
Guys, we're almost
more
at
of the
Dow
good stuff for this
30,000.
market. Tom, it's unreal.
30,000.
You follow the Dow. You've got this.
Okay.
I know, it's important.
S&P 4.
Is former New York Fed President Bill Dudley. I'm looking forward to that conversation. Yes. Kevin Cirilli down in Washington, D.C. as well.
Maybe.
President-elect Joe Biden, here's a serious note.
Before the either. America's effort to revive its virus-battered economy has been put on pause or thrown into reverse. Across much of the country, new infections are soaring at the fastest pace since the earliest days of the pandemic. Soaring today, the electric car maker will join the S&P 500 next month as its largest ever new member. Before today, Tesla's shares had risen almost fivefold this year, giving the company a market value of almost
David Weston, Bloomberg Television.
That's really good news.
Of course, back in April and May.
Keeping up or slowing down?
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
Right now, Congress should come together and pass a COVID relief package like the HEROES Act that the House passed 6 months ago. Once we shut down the virus and deliver economic relief to workers and businesses, then we can start to build back better than before.
Build back better than before. We've heard that a lot, not just in the United States, also in the UK over the last year or so. Joe Biden, president-elect there, pushing for more fiscal stimulus. A Congress that isn't budging right now. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action of this Tuesday morning. We'll pull back from all-time highs at the open potentially, with the S&P 500 down 15 points. We're negative 0.4%. The NASDAQ, that's where your outperformance is. It speaks to the defensive posture of this morning. Yields come in by a basis point or two on a 10-year to 0.89%. Crude, pairing some of the recent gains at $41 and about 27 cents. And euro-dollar, keep an eye on the euro. Bit of euro strength, some dollar weakness is broad-based. I'll talk about that a little bit later in the programme. The Chinese currency just seems to be the shock absorber at the moment in the FX market. Euro-dollar, 118.77. Tom will discuss it. Just how tolerant will these central bankers, these countries, be of a weaker dollar if it continues to materialize?
I brought that up with John Norman at J.P. Morgan. I think you're dead on, John. I noticed there, as you mentioned, renminbi out to new strength. And I'd also note I'm watching euro-yen as a proxy on strong yen. Right now in Washington, Kevin Cirilli joins us, our chief Washington correspondent. Kevin, I want to go to sort of the zeitgeist of the morning, which is who is advising the president? There seems to be a confusion about a secretary of offense where the president wants to go into Iran and do things, or a secretary of defense where he wants to get out of Afghanistan, get out of Iraq, get out of Somalia, and Mitch McConnell saying you're nuts. Who's advising the president?
Well, reportedly, President Trump met with some of his top national security advisors, including Secretary Pompeo, to discuss withdrawals from the Afghanistan region, as well as a potential military strike against Iran. But that according to these reports, he decided against that. Meanwhile, we should note that should he want to utilize significant military force, he would need to get congressional approval, should it be boots on the ground or with regards to that. And quite frankly, as you just alluded to, Tom, Senate Majority Leader Mitch McConnell is not likely going to provide the appetite for that in a lame duck session. Meanwhile, in contrast to that, the president-elect's team, Joe Biden, has been hosting briefings with national security advisors for the media and whatnot. And we should note just the careful role that Tony Blinken, his longtime aide, will play, no doubt, in the transition and obviously in the administration as well.
Kevin, the other side show, and I know you're up to speed on this way better than we are, is the two Georgia distractions. It's a Georgia distraction out there right now. How at risk are the Republicans to mess up this election? They're supposed to win, right?
They are supposed to win. This is theirs to lose. There are 2 Senate seats in the Georgia runoffs up for grabs in the first week of January. And look, make no mistake that I speak with Republicans who have told me that they welcome President Trump's ability to campaign, to mobilize various Republican contingencies who are not likely to vote unless that there's a large path for Trumpism, conservatism support. And there's a lot of different moving pieces now, both in conservative media circles as well as where super PACs are going to be going in conservative money circles. And all of that, the first chapter of that could be in January 2021. It will be, based upon my reporting, in January 2021. Who's going to be able to claim conservative victory, not just in terms of the candidates, but in terms of how they were able to do that. And that's what's really happening. That's the jockeying going on behind the scenes.
Kevin, I appreciate the focus on 2021, on politics and on markets as well, but we need to focus on 2020 and what's happened in America in the last 24 hours. Philadelphia closing down indoor dining, your home city. We're looking at a situation in California deteriorating. In the words of the governor, Newsom, the rate of increase is simply without precedent in California. What's happening down in Washington on this front?
Not much. Look, I think to answer this question bluntly, I mean, Senate Majority Leader Mitch McConnell has looked at the positive developments from Pfizer on the vaccination front, as well as Moderna on the vaccination front, as an argument for a more targeted stimulus approach and not a more wide-sweeping stimulus approach. In contrast to that, President-elect Joe Biden working the phones, working the virtual town hall meetings of sorts, and trying to urge Democrats and to some extent Republicans privately to get on board with a larger, broader sweeping stimulus package. So, you know, not much. I mean, the goalposts haven't moved in terms of where stimulus funding and talks are.
Meanwhile, it's not just the money aspect. It's also the comprehensive plan that the United States has to roll out the vaccine and get the coronavirus under control. How closely is the Trump administration working with the Biden administration at this point? I know Biden's administration has complained that they haven't really been in any kind of discussions. What's the latest on that front?
2 points. Publicly, nothing. Even back channeling, very little. I'm not able to report that there's been any significant, serious conversations on that regard. But the second half of this, right, is incredibly important. It's peaceful transitions of power are deeply rooted in American history. It's a sobering tradition and one that has deep roots dating back to George Washington. But behind the scenes, the bureaucrats, the career officials at the various agencies and the health institutions in the United States, the people who were there in the Bush administration, the Obama administrations, the Trump administrations, and yes, the Biden administration. Those individuals have been working on this for decades in the sense of the supply chain. The supply chain already exists. When I talk to health officials, bureaucrat health officials, the supply chains are there, and the rollout, that's why Moderna is saying that they might be able, should they get approval, Tom, they might even be able to have it rolled out by the end of the year. Kevin, for certain contingencies.
Kevin, nobody cares. What they care about is a gentleman from the 2nd Congressional District of Philadelphia apologized for the nation on the performance of the Philadelphia Eagles. Do you agree with Congressman Boyle that the Philadelphia Eagles are a national embarrassment?
I don't think that. I mean, wow, now I'm on. I don't think they're a national embarrassment, but because I'm talking publicly. But behind the scenes, privately, I have been known to gripe like Congressman Boyle. And I got to say, you know, I mean, I got to be careful because I'm on TV, so I don't want to say what I'm thinking. And I'm looking for discipline.
Don't worry, Kevin.
But I have thoughts. I have thoughts, and you're tempting me and baiting me, and I have thoughts.
I have thoughts, John.
Kevin, given how we opened this show about 20 minutes ago, there's no one left on Bloomberg Radio or Bloomberg TV.
Please.
I guarantee. Kevin,
it's
great
good
to catch
be
up.
back.
Kevin Cirilli, welcome back. Bloomberg Chief Washington Correspondent. Kevin with us through the week on the latest down in Washington, D.C. Tom, the states are making their move. The states are making their move.
John,
where's the federal follow-up?
John, I am so glad you brought us back to the pandemic because in all this happy talk about the markets, Dow through 30,000 and the rest, the news, folks, of the Bloomberg virus update is grim today like it was in those days of April.
Just a couple of weeks away from Thanksgiving. Coming up on this programme, Kevin Giddis, Raymond James, Chief Fixed Income Strategist from London and New York this morning. Good morning. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
From London and New York, this is Bloomberg Surveillance. We pull back from record highs. This is what defense looks like in a world of cyclical hope. Equity futures declined 0.4%. The Nasdaq positive, small caps negative. This morning, just a little bit of pushback from the sell side, starting with Bank of America and their fund manager survey. A lot of hope in that. BofA saying, sell the vaccine, maybe this bull is full. Switch up the board and get very quickly to what is happening in foreign exchange and in the bond market. I want to talk about FX just a little bit and start with what is happening in treasuries first. Yields are starting to push out just a bit last week. Just the tiniest bit to 97 basis points, and that's where we topped out, and then things rolled over, and that's where we've stayed. Many people making this call that we would get this weaker dollar. That weaker dollar's not come through in a very pronounced way. apart from one currency pair, and that is dollar China. Treasuries this morning, 88 basis points. Take a look at dollar yuan. I want to have a look at the offshore first, but you can look at the onshore as well. Dollar China peaked at the back end of May. We've had a move of 8-9 percentage points down. Stronger Chinese currency since then. Dollar China right now, 6.55. That's what you need to keep an eye on. Just how much of this will we tolerate on a central bank side of the ECB, the BOJ, and also at the country level in China too. I want to finish on this, though, just briefly. It's the move in dollar yen. Kit Jukes of SocGen saying that maybe what we've seen over the last couple of weeks is understandable. He thinks it's unsustainable. And if you want to add some longs, Tom, add it into the Japanese yen. Kit Jukes, long yen. On the fact that I think maybe some people think this has gone too far.
Well, strong yen 103, 102 really hasn't happened. What I would note, John, is euro, where a lot of the pros we talk to talk about strong euro into 130, 140 is being angst. I just flat out don't agree with that, John. To me, what we have seen on this show are people getting upset at a 122, 123 euro. How much does it take for strong euro really to be a problem?
Last time it was a problem, it was 120. And we're not far off that right now, Tom. And I'd say that would be the level again.
That's amazing.
We haven't quite breached the levels of a couple of months ago, but it's tough.
I mean, his entourage got him on the litter from the data check floor over to the desk there in that quick a time. It's incredible how they
It's about 20 feet. I get carried.
Yeah, you get carried. I understand that.
They're good.
Yeah, well, Francine's off, so you use her litter. Kevin Gittes with us right now with Raymond James. We look at fixed income here. Kevin, what's so great about your work is it really devolves down to what people do with coupon and what people do trying to protect total return. I believe it's yield up, price down. How do you protect total return?
Well, the only way to protect total return time would be to shorten duration or enhance credit. And so we have stopped really short of starting to walk up the duration curve a little bit in order to protect that trade. And the idea behind that is you find a resting place if you really think yields are going to run up, as we talked about earlier. Between now and the end of the year, we're not necessarily there. I mean, we made a 1% 10-year forecast in March, and now we're trying to, hopefully we live with it and it's true. But what we saw last week is there's the potential to push rates higher, but this week hasn't been that case, even though most of the news is good. So I'm still a little bit skeptical that we've got to pull duration in, but it looks like the better trade to try and protect whatever total return you have. There's just not that much difference between 10s and 7s.
Whenever we get investment strategists on, Kevin, they always talk about Fed being the ultimate put, and they're expecting the Fed to step in with extending the duration of their purchases at their meeting next month, their $80 billion of Treasury purchases a month. Do you think that they will do this, and why?
Well, and I don't see, I'm a little bit on the other side of that. I really don't see that happening. If you looked at last week's numbers, the Fed balance sheet at $7.15 trillion, they added less than $20 billion to the portfolio. And of that, $15 billion were treasuries. So I think they would like to have that portfolio to $7.5 trillion. I don't think that they're going to go rush and do that. I don't think the conditions are such that they need to. And you look at the curve for that validation, I just don't see that they're going to go out and pump a bunch of securities into the portfolio between now and the end of the year, and certainly after we know what next year looks like from a vaccine standpoint.
This is the game of chicken, Kevin, because we've got markets that expect the Fed to step in before there's even a disruption, let alone any sign of consternation, perhaps if the virus is getting that much worse. And on the flip side, as you said, it doesn't really seem like the conditions are there. And Vice Chair Clarida did not seem to be particularly pessimistic yesterday. What's the market reaction? How disruptive is it if the Fed does not step in with that extension of duration?
Again, I don't think all that much. I think Clarida in particular, and we've got a whole host of Fed speakers this week, hit on really 2 points. One, his excitement for the vaccine, and two, the fact that rates are going to stay low for a long period of time. And I would say if I added another one, it's been the banging on the drum, is the need for fiscal support. So they're still trying to get Congress to come up with a package that takes some of the pressure off doing what you're actually talking about them doing. So I don't think there's a big market reaction if they don't. But I do think if we start to see this economy slide down and there's a period of time before the vaccine and there is no stimulus, it will react and probably react that would take us back towards 60 basis points on 10s versus 1%.
Kevin, where do you expect the pain to show? You've talked about the Treasury market there, down to 60 basis points from about 88, 89 right now. Do you expect to see any pain in credit? There's a real comfort at the moment, looking at the credit markets, for many investors that just say the Fed's got our back. If things go wrong, they'll step in again. Where does the pain show?
Yeah, so, John, the part that really, we'll say, baffles me is that IG spreads have come in a little bit since the beginning of the month, but high yield spreads have come in, 70, 80 bips since the beginning of November, and then volatility has gone down during that time. So I think we're not done with bankruptcies. We're not done with business closures. And it'll go beyond the energy space. The energy space is about 44% of all defaults in the high yield market. There are other sectors like telecommunications and others that are seeing down credits. And if we looked at the upgrade downgrade ratio to high yield in particular, downgrades are leading 5-1. So I think there's the pain trade. The pain trade is for all those that reached out to try and get yield. And I think you'll see spreads widen before the end of the year.
Well, back in spring, Kevin, we saw a huge dislocation at the front end of the yield curve in credit markets. In investment grade particularly, it was phenomenal, and not in a good way. Has the maturity profile of some of these companies changed sufficiently now in a material way over the last 9 months that we might not see a repeat of that?
Yeah, no, that's a great point that you bring that out. I think most of the financings and refinancings have been much shorter than where they would normally be given this opportunity. But that's about cash buildup. So I think, if you look at state, county, municipal, I think they're doing deals to provide themselves with liquidity to offset lack of revenues. I think we're seeing it in some of that high yield space, too. But I think we'll see more pain in terms of businesses if they can't reopen, or even the potential of another lockdown or closure is going to put further pressure on those credits, especially those high yields they have in their portfolio now.
Kevin, what's the relative opportunity of municipal bonds?
Yeah, this is a space I like a lot, even though it's rallied quite a bit since March in particular. But if you look out there at the landscape in munis, you hardly see a bad outcome. So we've got the runoffs in Georgia in January. Will determine the Congress. That Congress is either going to raise taxes or they won't. They're either going to have more regulation or they won't. The muni market is positioned quite well for whatever happens. The Republicans aren't going to hurt them, and the Democrats, by increasing taxes, could probably make that trade more attractive. So you can go out 10 years, you can still get 93% of treasuries, and that's a really good trade on quality in munis.
But is the real risk here going out too far? I mean, 10 years for a lot of people is short. They're addicted to the 20-year space. How far out is safe?
Well, I mean, I see to get real value in munis, you really have to go out to about 30 years. I'm not saying that in this market we advocate doing that, but I'm safe there in 10 years. I'm safer in corporate credits somewhere between 5 and 7 years. And I'm not trying to time it. I'm just trying to find a place that I feel safe is going to provide a return and give me credit quality.
Kevin, great to catch up. Thanks for your time, sir. Kevin Giddis there of Raymond James. Thank you very much. Tom Keene, casinos are closing down again, and casinos for some of these cities make up a huge chunk of the revenue streams. And what we heard from the Detroit mayor yesterday was the following line: the budget is not my first concern right now. That's where we're at for many cities across America right now. They've got to make really tough decisions, and the financial ones, the financial considerations, are secondary to what is happening in the hospitals and the ICU units, Tom, across America right now.
Yeah, you can really feel the tension. I felt it outside Mount Sinai last night. John, to be honest, I was walking vet bill out around Mount Sinai, and it's not, to be clear, it's not anything like April, but that tension is back. Nothing like what we see across the greater Midwest. Some of the vectors, John, London is within 2 or 3 days of exceeding the per capita peak of deaths of New York State. I just find that stunning that we're there.
A stat I didn't know, Tom, and very concerning. And you're right to bring up New York is not the hot spot for all the bad news as it was back in spring. Lisa Abramowitz, it's the Midwest. And the numbers coming out of places like South Dakota are really, really concerning.
Well, and the big concern here is that the vector of the trajectory here, if I'm going to talk like Tom, is stunning, and it indicates that don't do that is right. I think everyone's groaning. Is this idea that there are a lot of people who are infected who are not necessarily showing symptoms that are infecting others? We're going to see the consequences of that in the weeks to come. I just want to bring up something that we've talked about over the past few months, which is the bridge to the other side. And the question is, has the bridge been long enough? So far, it hasn't for hundreds of companies that have filed for bankruptcy, even though they've gotten government aid. The question is, how deep will the pain be over the next few months to make the bridge insufficient to get to that other side, John? And that is sort of the big unknown as we enter into a tough winter.
You've got to get better at interrupting and maybe cough a few times as well when other people are speaking. That's a little bit. There you go.
I don't mean to interrupt, John, but is that good?
Yeah, but I meant to interrupt. Gets me every time. Don't understand it. I wonder what the guest feels like, Lisa, when he does it. I don't mean to interrupt, but they're kind of mid-sentence.
It depends.
Just getting their point out.
They're the people who just run right over him, which might be the right approach. And then they're the people who just immediately stop.
It's radio. It's TV.
The conversation never starts if you keep interrupting them.
Velocity. Keep it going.
It never begins.
Keep it going.
I'll keep it going.
Like
Coming up on the programme, Tom Forday, D.A. Davidson, Senior Research Analyst. We'll keep it going.
Forday won't stop talking.
On Amazon and the push into medicine coming up. Really important conversation. Down 21 on the S&P. We declined 0.6%, just off session lows. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Mark Zuckerberg and Jack Dorsey will be defending themselves again today. The CEOs of Facebook and Twitter will testify before the Senate Judiciary Committee. For the second time in a month, they'll have to answer critics who say their social networks silence conservatives. President Trump is rushing to leave his final mark on energy, financial and foreign policy. He's preparing to cut troop levels in Iraq and Afghanistan and is rushing to lease oil drilling rights in Alaska. Meanwhile, he's stalling the transition to Joe Biden. The president-elect warns that further delays could lead to a higher coronavirus death toll. Meanwhile, Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now, a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote this week. And the strongest storm of the hurricane season has slammed into Central America. It's threatening to cripple a region already hurting from a deadly storm 2 weeks ago. Hurricane Iota came ashore along Nicaragua's northeastern coast as a Category 4 hurricane. Its winds are now 105 miles per hour, and it's likely to trigger deadly mudslides. And Amazon is making its biggest push into selling prescription drugs yet. The world's largest online retailer is launching a digital pharmacy. Shoppers can pay using their health insurance, and Prime members who don't use their insurance are eligible for discounts on the Amazon site, or at about 50,000 pharmacies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The announcement of the vaccine, the news of that, we saw an increase in bookings quite significantly. So it shows that the underlying demand is really, really there. And hopefully we can see a strong recovery coming very soon.
A strong recovery in 2021, a brutal winter still ahead for the airline business. Johan Lundgren there, the EasyJet CEO. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Tuesday. Just a little bit more defensive than what we've seen over the last week. It means equity futures are negative on the S&P. They are positive on the NASDAQ. And the FX market, euro-dollar, out to 118.70. We're up a little more than 0.1% there. Bit into the Treasury market. Yields lower by a couple of basis points on a 10-year to 0.88%. And after much demand, I'm going to say it, starts with a B, Bitcoin. I've been asked to give Bitcoin a shout-out, so I will give Bitcoin a shout-out. 17,000, Tom.
Yeah.
Just throwing that out there.
You
can take that wherever you want to go with it.
I don't know where to go with it.
I have a lot to say about Bitcoin.
Oh, well, Lisa, quick, what do you got?
Quickly, it's going toward record highs, and no one's talking about it.
Yep.
This is the story, the fact that it isn't necessarily going to be the topic of discussion at Thanksgiving, but it's had an unbelievable run. This is interesting.
I can somehow see
go
it.
further.
I can see it, Lisa, being a topic at your house because the kids will probably have secret Bitcoin accounts
they want
you don't
one.
know about. Let's get started here. Right now on Amazon, Tom Forte with us with D.A. Davidson. He writes brilliant notes. Yeah, he's a bull on Amazon, but this, of course, on this big announcement today. Tom, I get the type 2 that this is about hurting Rite Aid, hurting CVS, taking market share away, et cetera. What's in it for Mr. Bezos?
So those are the implications to the competition. This is a large trillion-dollar global opportunity for Amazon. So Amazon needs these large global trillion-dollar opportunities to sustain their growth and their multiple. So my question for Amazon is, what took you so long? But I think this is a great move by Amazon.
Okay, so it's there. And I look at Amazon right now. Does this move the needle on their revenues? I mean, is it a 5-year project?
Excellent question, Tom. Collectively, I would say Amazon's healthcare efforts are needle movers. So you think about how they've kind of been forced into healthcare, testing their employees for COVID, opening these mini clinics for their employees' families, and now they're advancing their pharmacy efforts. They had PillPack. Now they're going to open an online pharmacy. I think collectively their efforts in healthcare are needle movers.
Well, Tom, let's walk through things just quickly. The acquisition of PillPack, how does it fit into all of this? And do you think they can do this from where they are now organically?
Complementary to the extent you think of PillPack as making it easier for consumers to follow their prescriptions. I still believe that over time they're going to have physical pharmacies that will complement their online ones. I really thought when they acquired Whole Foods in 2017 they would devote a portion of that box to a pharmacy. So I still think this is only the beginning, but an important move for Amazon given the large total addressable market.
Tom, their Whole Foods acquisition and rollout hasn't necessarily been incredibly profitable. We don't necessarily know. They don't break out all of the data, but their forays into physical grocery stores in the past have not been as successful. Why is this time different? Why are we seeing the shares of CVS and Walgreens plummet on this news?
So excellent points. Historically, Bezos has said, your sales is my opportunity. I feel like historically Walmart said, your gross profit's my opportunity. And Walmart went hard into generic drugs, if you remember. So there is a lot of profitability opportunity for Amazon, especially in generics. Grocery, though, is not a high-margin category. So I would say that expectations of Whole Foods generating materially higher margins were overly optimistic. The case for pharmacy is different, though.
Tom, there is a broader question, especially as Democrats have more power heading into 2021 with Joe Biden taking the role of president. There's a question of how much more antitrust concern this raises about Amazon, the fact that they're plowing into every aspect of people's lives. Does this matter if it's done organically? Does this put pressure to possibly break them up or restrain them in some capacity?
So I think that it's bipartisan support to restrain the impact of Amazon, Apple, Facebook, and Google, but I think both parties are trying to figure out how to do that. It's my understanding at one point Elizabeth Warren proposed legislation to limit acquisitions over $1 billion, so you'll see a lot of smaller acquisitions if that happens, and to your point, more companies building it organically. From an anti-competitive standpoint, though, it's hard for me to imagine that they could prove this is bad for the consumer and that this raises costs in pharmacy.
You know, I'm looking at the margins on Rite Aid, and come on, it's like a grocery store margin as well. Tom, give us the percentage margin we should see there. Forget about the cloud for now. What do they make on all the cardboard boxes on margin? What are they going to make on pharmacy as related to that and related to the razor-thin margins at Whole Foods?
Yep, so collectively, I think of Amazon as having the potential for a 20% adjusted EBITDA margin long term. If I put most profitable, least profitable, it'd be advertising first, then cloud, then pharmacy, then third-party retail, and then ... a huge...
No, but come on, give me a number. Stop. Tom, give me a number here. I get the 20% EBITDA. What's the cardboard box margin, and what's pharmacy going to bring?
Sure. Pharmacy, I think, confidently will bring more than a 10% adjusted EBITDA margin, and the first-party retail margin is flat.
Tom, great to catch up. Appreciate your time today, sir. Tom Forder there, D.A. Davidson Senior Research Analyst, putting a little bit more pressure on the pharmacy giants, Tom, and hopefully putting some pressure on them on Main Street, not just the e-commerce offering, on Main Street. Because I have to say, the compare and contrast between the Main Street shopping experience, Tom, in New York City and across the United States compared to the UK is unbelievable.
And, John, I was saying this to Francine earlier. I mean, people abroad have absolutely no idea, including Canada, about the nuts pharmacy retail in America. And what he just said there, John, what Tom Forte said, if they can make 10 cents on the dollar on EBITDA on pharmacy, that's a ton of money as they create share.
I was talking more about the pristine nature of some of the shopping centres here in the United Kingdom, Tom, compared to some of the United States in New York. Can I just say Whole Foods in London is so much nicer than Whole Foods in New York? How can that be? Why does that make sense? I don't think that makes sense. How can that be?
I mean, we all shop at Whole Paycheck. I get that. What I find fascinating, John, is Whole Foods to Whole Foods, how different they are. One's like on the edge of, you know, clean, like you're talking about, pristine, and another one will be a total dump, and the next one will be even worse. I don't get it. You know,
I know for a fact that where you go, because I know that you spend an extra 20 minutes in a cab to go to the Whole Foods that you prefer.
True story.
Seriously?
True story. Can't make this up, John. I told the manager at the Whole Paycheck I go to that they should pay Mrs. Keene to come to the store. Because if you compare and contrast the normal cart from the attendance by Mrs. Keene cart,
John,
Bezos is making...
Okay.
She bought Bezos' fifth house.
John,
I mean,
if we go into a Whole Foods, anyone out there, and they see a very tall man railing about the apples, everyone should know.
I can tell them where he'll be on Saturday morning.
John,
and I can also tell you, from where he lives, there is one right around the corner that he refuses to go to because he doesn't like the standard of it.
The 365 pesto. She's buying the Bezos margin up from Perugia or somewhere in the south of Italy. It costs like $42 for a teensweens bottle like this.
Well, she's doing the right thing. She's doing the right thing.
Look at those markets.
Because she's doing that, Tom, they can give us a nice pharmacy offering as well. Beautiful thing.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Of 6 to 7 potentially safe and effective vaccines. We've signed with AstraZeneca, we've signed with Sanofi and Johnson & Johnson. We will leave no stone unturned.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
We've seen a massive momentum shift in the last week that we don't think investors should be ignoring.
The market in the next 2 months seriously will start to reprice everything.
Growth will pick up a lot in the second half of next year as people get back to normal.
Normal doesn't look like January of 2020. The world is different.
People have money and they want to spend and they can spend, and I think they're going to.
We've been in a bull market. We remain in a bull market.
We're now through the election and we can sort of face forward into what I think is going to be a very big 2021.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast. Bloomberg Radio, good morning across this nation, and Bloomberg Television as well. John, I love how we end our opening there with Christopher Verona Strategas and Ben Laidler at Tower Hudson. They are bulls. They have been right. And the real theme to me, John, this morning is a lot of people rationalizing where we are and actually beginning to rationalize, now, wait a minute, on Dow 30,000.
I see that from Bank of America with their latest fund manager survey. Cash levels down, growth expectations up, and they start to push back just a little bit. Is this bull full, and do you want to sell the vaccine news? We've heard that just a little bit more this morning, Tom, after a massive rally over the last week. Though let's be clear about something. The phrase you just used, they have been right. Not bullish and wrong, bullish and right through much of the last 8-9 months. And we often talk about the most hated bull markets, despised record highs. We've had plenty of them over the last few months, but this recovery has been underappreciated as well. I've sat here many times waiting for it to fade. It hasn't. Right. But I think now things change. The restrictions are back. The cities are closing indoor dining in the same way they were back in spring of this year. The lockdowns won't be the same as early spring, Tom, but the restrictions are there for all to see, and growth has got to take a hit off the back of that. The question is, how much of this do you tolerate?
We're marching on to Dow 30,000, and what's just as important, John, George Saravelos publishing moments ago at Deutsche Bank on the fact of a weaker dollar. dollar. How weak is weak? What do you see, John, within the literature?
Well, if your ECB President Christine Lagarde, 2 week is 120. We saw that from the chief economist, Philip Lane. So it depends who you are and what side of the currency trade you're on. I will say this, though, in that note from Deutsche Bank that just came out in the last hour or so, this is what he had to say on Asia and China specifically. If Asia, having emerged from the COVID crisis better than others, can't generate inflation, it's hard to see which region can. Think about that when you look at this bond market and Treasury yields struggling to break out through 1%.
Lisa Bramowitz, Christopher Smart at Barings, really talking about the darker tunnel, and I was really taken aback by the narrowness of the pandemic news today. I happen to focus on Sweden, where they're doing a complete capitulation from what they were doing before, but there's other news on the pandemic that's just outright grim. There's no other way to put it.
Yeah, the trajectory in the United States, more than 150,000 cases being diagnosed every single day. And again, that number is climbing exponentially, which raises questions about deaths, about capacities in hospitals. You know, the issue as we look forward is that the tunnel ahead, as you reference, looks darker than it did earlier this year and darker than a lot of people had expected. But the exit looks brighter than people expected with the efficacy of the vaccine. How do you pair those two at a time of such uncertainty? And that, I think, is what people are struggling with, Tom.
Let me do a data check here to get us started. We'll get to Mr. Lowe of State Street in 2 seconds. The VIX at 22 handle, now 23.11, down negative 209 points at 0.7%. Standard & Poor's, I have to do to keep Farrow happy, negative 21 on the S&P. Dollar weaker, and I really want to feature renminbi, 6.55 yuan. That was something when it broke 7. Look at the renminbi strength. And I do want to note Mexican peso and the like really holding that strength here on a weaker dollar. Marvin Lowe is at State Street Global Macro. He is a strategist there. We're thrilled he could join us this morning. Marvin, how has your view changed in the last 2 weeks?
You know what? I think certainly the world is a bit more optimistic. I think that, we might move the timing with regard to when we can re-engage with society, but not all that much. I mean, a vaccine had been expected. And certainly some of the election risk was less than the worst case, but not really a whole lot.
What do you make of the risk right in front of us now, Marvin, over the next couple of months in the United States of America, given what you're seeing from policymakers and the decisions they're making in the last 24 hours alone?
Yeah, absolutely. So, the fact that Washington is stalled with regard to stimulus and all of the statistics that you provided on just this next wave of the virus, appearing to have out of control aspects to it is certainly a double concern that we've got going into the end of the year. Even though, like you mentioned, the light at the end of the tunnel is bright. The tunnel itself is still pretty long.
So how do you trade this, Marvin? Do you try to? Do you just reserve an extra pile of cash while staying invested with the rest in risk assets and wait for an entry point?
Yeah, I think so. I think we're going to have volatility, so there are going to be certainly entry points. I don't think monetary policy is going to be able to let up at all. So, the Fed theoretically still has your back. I know it's kind of an uncomfortable investment thesis, certainly, but that liquidity is important in the market, and we're going to see the next stages of that over the course of the next month, and then going into the first quarter. So you'll have that, but certainly just be wary of the choppiness that's going to exist. I also don't necessarily think that rates are going to jump anytime soon because of the inflation profile, plus the Fed still being in the game.
What does a carefully balanced portfolio look like?
You know what? I do think you do. I think you've got equity exposure. I certainly think that EM is a bigger part of that. And then for the fixed income hedge, it certainly is more of a challenge. Gold is part of that, and potentially, corporate products as an income substitute for these low Treasury yields starts to come into the discussion.
For our audience worldwide on Bloomberg TV and radio, we're with Marvin Lowe of State Street. For our audience on the Bloomberg terminal, you can follow this on Live Go for our Bloomberg subscribers. India's Prime Minister, Narendra Modi, giving a keynote address at today's session of the Bloomberg New Economy Forum, where the focus today is cities. Again, you can watch that on Live Go on the Bloomberg terminal. Also, Tom, streaming on Bloomberg.com.
Yeah, and the overlay here with the virus and the pandemic, and John, this is really profound, is the stunning pollution of Delhi and, for that matter, so much of industrial India. I noted, John, Russia was some pollution today as well, with overlaying there maybe on a warmer Moscow. But John, this is a really important moment for India. They do have better pandemic statistics, but the overlay with pollution is challenging, to say the least.
That was the president's position over the last couple of years, that he wants to see more done from emerging economies, Tom, and not just put the United States carrying the burden. I want to bring back in Marvin Lowe of State Street. Marvin, I want to turn to geopolitical relations, not India, but the United States and China. In the New Economy Forum that we've been doing over the last 24 hours, many people have talked about a reset of US-China relations. How important do you think that feature will be in the coming year with a Biden presidency?
You know what? I think it will be important. Asia and China in particular certainly have come out of this virus, a bit. I won't say stronger, but certainly with a little bit more clarity and additional clarity with regard to just how trade is going to be approached. Will certainly make looking into the region a bit easier than it has been over the last several years.
Meanwhile, Marvin, the strength that we've seen in China, when we talk about Chinese-U.S. relations, we have to also talk about the response to the virus and how China has been lauded as having a preferable response when it comes to how quickly they can exit. I'm wondering how much the strengthening of the yuan, the strengthening of the euro, the weakness of the dollar will add to an inflationary environment, even if we don't get growth here in the U.S.
Yeah, most certainly it's a concern within various emerging markets. I certainly don't see it in the developed markets as a lot of the structural issues that we had going into the pandemic ultimately will remain. But that is, from an emerging markets perspective, a case-by-case type basis that the different economies need to evaluate individually.
Marvin, I think increasingly we're thinking about tolerance levels, pain thresholds for the FX market in various countries. We understand that in Europe, the last time we breached 120, which was late August, early September, we got some pushback from the ECB. One thing we're trying to understand right now, with dollar yuan down at 650-ish, is when the Chinese start pushing back and stop tolerating that move. Do you have a level in mind? Do we know whether they like where the currency is right now?
I think they're fine where the currency is right now because of the economic backdrop that's driving it here, and we're not seeing that inflation response yet. So I think they're happy allowing it to consolidate because of the fact that their ramp out of this virus is the clearest amongst the larger economies.
It has been really strong. Marvin, it's great to catch up, sir. We appreciate your time. Marvin Lowe there of State Street. Thank you. Dollar China, dollar yuan, 655, 6.5548, Tom, on that currency pair. Quite impressive.
Not a small matter. John, I think this has been underreported in the blur of the news here, but to see yuan breaking through 7 and then where we were, 670 or so, but suddenly 655. And I don't have any knowledge on this, John. I really wonder where that tipping point is, where for Beijing it becomes an issue.
Well, on the dollar weakness story more broadly, Tom, I think there's been a lot more comfort pushing into the Asia story off the back of the Chinese strength, and increasingly more recently around the commodity story. As we start to get that vaccine news come through, you start to see the commodity currencies perform. Speaking of commodities, the move we've had in crude and the move we've had in energy equities, wow. Last week and again yesterday.
Well, there it is, 41 on West Texas Brent crude, just a nudging up on 44. John, when you went to commodities there, I thought, the response we've had this morning, it's like nothing we do matters except the international argument on Bloomberg surveillance over pesto. John, you have lit up a fire of debate over pesto. John, is it really like from Francine's Genoa is where pesto's from, or is it from the south of Italy?
It's Liguria, though I like to think that the south of Italy does everything better, Tom. But that's just my take.
John, where's Liguria?
Given my roots down in Puglia, in the northwest.
The northwest. Towards France.
Yeah. You'd like it in Portofino. That's very you.
Okay.
That's very you.
You
do well there.
A viewer emailed in and said, yes, next time we're getting the sea salt from Trapani. Where's Trapani? I have no idea.
Sicily.
Italy.
You should know this. Come on, Tom. Sicily.
Sicily? That's
it's
not
the
near
ball
Genoa.
getting hit by the boot.
That's like.
We'll continue this. Coming up, Greg Valliere, Chief U.S. Policy Analyst at AGF Investments. As we head down to Washington, D.C., Tom, from London and New York this morning. Good morning. Futures negative. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Joe Biden's call for Congress to pass a larger-scale stimulus package has run into swift Republican opposition. The president-elect wants something like the $2.4 trillion bill the House passed before the election, but Senate Appropriations Chairman Richard Shelby says that's not happening soon, and it probably won't happen later either. President Trump is poised to order U.S. troop cuts in Iraq and Afghanistan. A defense official says troop strength would be cut to 2,500 in each country by January the 15th. The Senate's top Republican Mitch McConnell isn't happy. He says there's little support in Congress for, quote, simply walking away from the conflicts. SpaceX's Dragon capsule has safely delivered 4 astronauts to the International Space Station. The mission is the first in NASA's history where a full crew has been ferried to the space station by a commercial vehicle. Elon Musk's company and Boeing both won contracts from the space agency. Turning now to another of Elon Musk's companies, shares of Tesla are soaring today. The electric car maker will join the S&P 500 next month as its largest ever new member. Before today, Tesla's shares had risen almost 5-fold this year, giving the company a market value of almost $390 billion. And America's efforts to revive its virus-battered economy has put on pause or thrown into reverse across much of the country. New infections are soaring at the fastest pace since the earliest days of the pandemic. California has reimposed bans on many indoor businesses. Michigan has ordered a partial 3-week shutdown. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
Bill Clinton there, the 42nd US president, on the relationship between the United States and China. We've got to make it better. Right now, with some of the issues we've got to stop making it worse, particularly the pandemic in America. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Here's the price action, just a little bit more defensive. Here's a flavour of things. Futures down 21, we're down 0.6%. The Nasdaq is where the outperformance is. After the underperformance of yesterday, the bid comes back into the bond market, 0.8783% on a 10-year, we're down 3 basis points. And a bit of pushback from the south side. The much-followed fund manager survey from Bank of America. Cash levels down to 4.1%. From 4.4. The expectations for growth and profit optimism, 20-year high. Tom, a 20-year high. Tells you something about sentiment right now.
And, John, we've got to mention the economic data here in 12 minutes. I mean, this is not a small deal. I mean, this data is going to be important. Retail
I would agree.
Sales and the rest of it as well. Right now in politics, Kevin Cirilli with us earlier. Any number of themes to go with here. Let me get this out of the way, and we can do this with Greg Valliere of AGF Investments. We rely heavily on his wisdom of a morning note. Greg, I want to talk Georgia right now, and what the Democrats need to do to respond in a clearly Republican state, 2 major Republican visible senators right now. What's the Democratic approach to take one or both of those seats?
Well, I think they'll go after the core issues that help them around the country, things like health care, the economy. But it's going to be tough. I think that this assumption that the Democrats could win both seats is not valid. I think that they'll be lucky to win one of the two.
Well, so what are the ramifications if they win one of the two? What does it mean for Senator McConnell and Senator Schumer?
It's huge, Tom. That means that McConnell controls the Senate. That means that the Biden agenda of higher taxes will fail. It means we'll pretty much get gridlock. So the stakes could not be bigger in this January 5th race in Georgia.
And, Greg, once we get past January 5th, we've got about 2 weeks with an outgoing president. How do you think relations between Senate Republicans then look with the President of the United States at a time when Georgia's out of the way with?
There are still so many Republicans who are terrified to alienate the base. The base thinks that the election was stolen. The base still loves Trump. And I think that most Republicans in Congress are scared to say very much. So I think that Trump in the next couple of months will have quite an opportunity to do a lot, changing regulations, maybe getting involved in geopolitical events. It's going to be a really interesting 2 months.
All right, let's build on that, Greg. Let's talk first about international issues, people talking about that in particular with some of the changes in the Defense Department. What are you expecting on that front?
I think he'll withdraw troops, Lisa, from Afghanistan, maybe Iraq, maybe other countries. This will infuriate Republican hardliners like Mitch McConnell, who feel we're just bugging out. But the bigger story, I think, is this deep, deep antipathy that Trump has for Iran. I think he wants to do something to stop Iran's buildup of nuclear weapons. There may be targeted assassinations. As you saw in the New York Times this morning, I think Trump would want to do even more, but he's being counseled that it might not be wise.
You know, Tom has been talking about this, who has the president's ear, and I think it's a really important point as you look to the executive orders, the regulations, the foreign moves that the United States may make over the next 60 days. Who are the key members of Trump's cabinet who are kind of, I don't want to say pulling the strings, but pulling the strings here?
Well, there aren't many left, are there? I think even Attorney General Barr could be vulnerable in the purge that we're going to see over the next few weeks. I would say that Mike Pompeo is the key guy. I mean, the relationship he has with Trump is really first rate. I think Mnuchin will start to become less visible. He had a chance to get a deal with Nancy Pelosi, and they couldn't pull the trigger. I think Pompeo is going to be very influential.
Greg, just final question from me. this conversation assumes that the president understands he is an outgoing president.
Yeah,
Do you believe he believes that?
I think he knows it. He has to know that these states can't be overturned. I mean, you've got a 50,000 vote margin in Pennsylvania. You're not going to overturn that. So I think deep down, and he knows it, I think he wants to influence things for 2024, either him being on the ticket or Ivanka or Don Jr. I think Trump really thinks that's possible.
Greg Valliere, let me go full circle on where we were 2 hours ago, talking about a diminished Democratic House, Speaker Pelosi's agenda. How does she manage middle-of-the-road Democrats with a left that is more than vocal?
Great question, and there's a lot of
my only
dissent.
good one. That's it. That's it till 2022, Greg. No more great questions.
Okay, but Tom, her own troops are not happy with her. They feel that the progressive argument hurt them, defund the police hurt them. And I think her own troops are restive right now. So it's going to be a tough stretch for her. Frankly, I thought she had a chance to get $1.8 trillion out of Steve Mnuchin in October.
Yeah.
And she could not take yes for an answer. I think that's going to haunt her.
Blew it. Greg, great to catch up. Greg Valliere,
right.
AGF Investments Chief U.S. Policy Analyst. Tom, isn't that a story that I just think on shows like this hasn't been covered enough? The Conservative pushback further down the ballot. Really clear.
Yeah, it's there. We talked to Mr. Boyle of the 2nd Congressional District of Pennsylvania, John, Philadelphia and up north, and he didn't mince any words about it. It's really front and center. They've got to defend that middle area where he is versus, of course, the Republicans and also the left as well.
Don't you find that fascinating, though, Lisa, as we go into Georgia, that the band is so wide? You've got the difference of a fiscal plan that could be a couple of $100 billion or a couple of trillion. I mean, that's the story going into Georgia. It could be one or the other.
It also highlights how fractured both the Democrat and the Republican parties are to me. I mean, we think about how hard-lined these are, but they're splintered, they're factions. And I do think about the purple media. I mean, for example, there could be Republicans that get on board with a bigger plan. There are going to be Democrats that push back. It's going to be smaller. And these are some of the sort of the aspects that people are looking at, John.
Well, you might just have a situation where the issue is pushed again. And that's what we saw back in spring. I don't think the appetite was there at the time to push a bill through of a couple of $1 trillion. And it was only the reality of the middle of March when it finally hit them over the head, Tom, and we had lockdowns in America. That's when people woke up. I remember speaking to the administration in early March, and there was no appetite at that point to push a bill with the size that we eventually saw. It wasn't until the governors just took the decision away from them. This is what we're doing. We've got to shut down bank. And then finally people had to get together and make a call. Are we going to let people sit at home without a job, without getting paid, or are we going to supplement or replace their income?
John, I think you've got to the catalyst that it will be, which is the job economy. If the job economy flatlines here or gets worse, higher unemployment rate, whatever, that will be the catalyst. It always is in politics.
If these restrictions get worse. From London and New York this morning, good morning. Really important data point just around the corner. U.S. retail sales, the momentum in America and the American economy. This recovery has been impressive, perhaps underappreciated. Will it continue as we start to see more restrictions come through in America? That data point up next with Michael McKee and Mr. Dudley, formerly of the New York Fed. This is Bloomberg.
it's such an interesting.
The data point 10 seconds away from London and New York this morning. Good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Equity futures are at session lows going into this one. With the economic data in America, we can bring in Bloomberg's Michael McKee. Mike, it's just crossing the terminal.
It's just slowly crossing the terminal with import prices out first, and import prices down 1/10 overall on the month. Without petroleum, it's flat. Now, here comes the numbers on the retail sales. We're slowly getting these, and here we go. A gain of 0.3% for the month of October for the month-over-month numbers. You leave out autos, and we were up 0.2%. Now, both of those are significantly lower than the forecast. The forecast was for a 0.5% gain in overall sales and a 0.6 gain in autos, ex-autos. The control group, which is what economists like to follow because it is what goes into GDP out of the retail sales numbers. Other things go in under separate categories. And the control group is up just 0.1. The forecast was for a 0.5 gain. And last month it was 1.4%. So we're really seeing some weakness in retail sales, which is kind of interesting in a negative way because what we've seen over the last couple of months is people buying a lot of stuff and not spending much on services. And of course, service businesses are the ones that are going to be impacted by the additional shutdowns that we're seeing of restaurants. Let me take a quick look at here at where we saw some gains and losses. Electronics and appliance stores down 3.9% in October. Building materials were up 20%. And we know that housing has been strong, but a big drop in clothing stores, 12.6% on the month. And also a big drop in department stores, 11.9%. We always like to look at gasoline stations because that's really affected by price. And this is interesting, guys, because price of gasoline went down significantly during the month of October, but sales fell by 14%. Well, so it shows you the economy's slowing.
And you got to understand, folks, in the old days, we got all these numbers, boom, 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 and now McKee has to really wrestle here with how they come out slow. The revisions just came out, Michael McKee, and the revisions are demonstrably weaker than what we saw prior as well. How does this fold, not so much into Fed policy, Michael McKee, but how does it fold into the framework of inflation to come?
Well, obviously, it suggests that we're not seeing significant inflation at this point because these are dollar figure reports. And so the declines that we're seeing in a lot of these categories and the weakness we're seeing suggests there's no real additional pricing that is pushing these higher. So it's a concern. What'll be interesting to see is if there's any reaction in Washington because, of course, the stimulus talks at this point seem completely dead in the water. So we'll have to keep an eye on that. One thing I did want to check here, and I don't know if I have it right in front of me, but we have seen, and I thought this was the most interesting number that I had seen recently, is shoe sales had been down. I don't have the number right in front of me, but they were down double digits over the last 3 months. And I know that Lisa would tell you, you talk to people, and they say, I don't know whether I'll ever wear dress shoes again.
Well, that's true. That's called the Dolce & Gabbana effect.
I'm wearing heels.
I'm looking, John Farrow, at the market reaction here. And with this data and with the revisions, John, it's substantial.
Let's reset here. This is the worry. It is one data point, but this is the worry, that this economy loses momentum just as we add more restrictions to it. The bid is clear. It's into the bond market. Where is the bid? At the long end of the bond market, down 5 basis points on 30s. We come in 4 on a 10-year. Last week, we topped out at 97 basis points. The vaccine news couldn't get us through 1%. The news yesterday couldn't either. We roll over. In the equity market, S&P 500 futures, session lows. Russell futures roll over. It's a downside surprise, Lisa, in the economic data. And this is where the test begins. How committed are you to the news that will come in the back half of 21 as we start to normalise? How tolerant will you be of the bad news that could come between now and then, particularly through the back end of this year, as more restrictions come through and this economic data starts to look a little bit worse?
And really the issue here is, why is this a surprise? We saw the virus numbers going up, and we saw the fact that the high-frequency data showed that activity was coming down. Michael, just to sort of wrap things together, I'd love to get your sense of the coverage period of this survey and how much worse things have gotten since then when it comes to lockdowns and restrictions in response to those absolutely spiraling pandemic numbers.
Well, you make a good point, Lisa, because these advanced retail sales numbers basically cover the first half of October. And that's why we get such significant revisions. And we saw big revisions down for the month of September when you include the latter half of the month. So it doesn't portend well. One other number to just throw out here, food services and drinking places were down 14.2%. And that's the very definition of the kind of discretionary spending that we're seeing pulled back as people decide not to go out.
Michael McKee, thank you so much. Greatly appreciate it. With important data and more to come here today and in the coming the rest of this week, I should say. William Dudley is the former New York Fed president, now at Princeton, holding court as a senior research scholar. But far more than that, he developed Goldman Sachs economics pre-Jan Hatzius with Ed McKelvey, and knew that it was about theory, it was about the guesstimates, but it was also the granularity of the data. Bill Dudley joins us this morning. Dr. Dudley, I want to go right to the Dudley. It feels like an Ed McKelvey call here. I want to talk about the Dudley Beige Book, about how you use data like Mike McKee just reported.
Well, you have to look at the data in the context of what's going on elsewhere. So, the fact that the retail sales were a little weaker in October reinforces the idea that as the pandemic gets worse and there's more shutdowns and restrictions, that the November data, which we haven't gotten yet, will be even softer. So, we have a valley that we have to go through over the next 6 to 9 months before the vaccines arrive and we can get people vaccinated. And I think it's going to be a difficult valley to go through because the pandemic's getting worse. And there's no fiscal stimulus package that seems to be about to arrive in a timely way.
This is so important, folks, and why it's so good to have William Dudley with us right now. The only one I can think of, Bill Dudley, is Lawrence Meyer in terms of looking at the granularity of the data week to week as you did years ago at Goldman Sachs. What data are you looking for forward to frame out the next 2 quarters?
I think I'm going to be focused mostly on the course of the pandemic itself and the reaction of state and local governments in terms of the restrictions that they put in place and how much people actually social distance. To the extent that the pandemic worsens and we have more restrictions, that's going to exert downward pressure on the economic data. And I think it's also important to recognize that when we get data like what we got today in retail sales, we're really looking in the rearview mirror. I mean, this data is October data, first half of October data. We're in a much worse place today than we were in the first half of October.
This, Bill, as you point out, is about momentum. Momentum is fading. The data, as you anticipate, is set to worsen from here because of the restrictions. Let's talk about where this leaves policymakers, specifically monetary policymakers at the moment. You wrote an op-ed piece for Bloomberg Opinion in the last month, which said quite clearly that you think, and many others share this view, that they have run out of ammunition. So, Bill, where does it leave them right now?
Well, they can do more. I mean, they haven't completely run out of ammunition in the sense that they could increase their asset purchases or they could extend the duration of the asset purchases that they make. But it just wouldn't have that much consequence because the Fed has actually succeeded in what in terms of what it wanted to accomplish. It's made interest rates very low and it's made financial conditions very accommodative. The Fed did more. Would it help? A little bit. But at the end of the day, this is really about fiscal stimulus and providing support to incomes to help people get through the valley that we face in the months ahead.
On balance, Bill, as a former policymaker at the Fed, when you look at things right now, we have market participants come on this program all day, every day, 5 days a week, talking about risk or lack thereof in the credit market because of the Fed's presence in it. Is that a good thing at a time like this?
Well, I think the Fed's backstops are pretty important because it basically reassures people that there is a buyer of last resort, and so that encourages other people to be engaging in financial markets. The Fed's, the liquidity facilities that the Fed has provided actually haven't had that great amount of takedown. What's happened is that they've served as effective backstops, and I think it's very, very appropriate. Another issue that's going to get some attention is whether the Fed's going to extend the date of when these liquidity facilities lapse. Right now, they're scheduled to end at the end of December, and I think it's very likely that they'll extend them probably through at least into end of March and maybe through the first half of 2021.
Bill, a lot of people agree that the Fed stepped in and provided a backstop to a lot of companies in a good way. But there's some concern that the Fed is dramatically exacerbating inequalities, not just in terms of households, but among companies as well, because right now we're seeing the pain really being felt at smaller companies that don't even register with their bankruptcies since they simply just close up shop and they don't have access to borrowing money in credit markets in the same kind of way. Do you think that the Fed has almost whitewashed some of the pain with their policies, looking at broader markets that have this enthusiasm, and that this is somehow at this point potentially even harmful?
Well, I don't think it's harmful. I mean, in the sense that it's much better to have financial markets operating than not operating. I think the problem for the Fed is that monetary policy is a blunt instrument, which can't really do much about the fact that the impact of the pandemic falls very unequally on households and on the different types of businesses. The Fed introduced the Main Street Lending Program to try to get to a set of businesses that can access the capital markets very easily, and it just hasn't worked very well because there's lots of terms and conditions, and so there's been very little take-up. I think it's much better for the Fed to generate as strong economy as they can, and recognizing that there may be unequal burdens, but then that's for Congress and the administration to come forward with a fiscal package that supports those that are most disadvantaged by what's happened.
Meanwhile, next month, the Fed is expected by some, including J.P. Morgan, to extend the duration of their asset purchases. Do you think that based on where we are, based on what markets are doing, that they should go through with that and that they should make that decision next month, even if market conditions are similar to where they are today?
Well, I don't think there's a tremendous rush that they have to do it in December. If they waited, I don't think there'd be a great consequence with 10-year Treasury note yields below 1%. But it sort of makes sense, right? If you're buying treasuries and agency mortgage-backed securities now, not so much to support market function, but to keep long-term rates low, then why not concentrate your purchases in the long end of the market?
Dr. Dudley, I must ask you about governor-to-be. It's a very close vote right now, Judy Shelton. I want you to explain to our audience what her theory is grounded in traditional economics. If it's not classical or neoclassical, if it's not Keynesian, what is Shelton theory as you perceive it?
Well, I don't think I understand her theory, to be very blunt about it. Look, I think it's unfortunate that the Congress, Republican Congress, is pushing forward to confirm Shelton and Waller. I think it would make more sense to leave those positions open so that Joe Biden could put his imprint on the Fed. End of the day, though, if Shelton were to get confirmed, I don't think it would make a huge difference in terms of how the Federal Reserve sets policy.
Bill, I must ask you, and this is so important, if you don't understand her theory, do you perceive that she's coming from some convolution of Austrian economics and a traditional historical German economics, literally from another time and place?
Well, she's been inconsistent over time, right? On one hand, she espouses sort of gold standard hard money. On the other hand, she now wants interest rates extraordinarily low, even before we entered the pandemic. So she seems to bend with the political winds, and you really want the Fed to not bend with the political winds. You want them to be independent of the political pressures.
Well, Bill, let's talk about process and just wrap things up there. I've lost count of how many meetings you must have been to at the Federal Reserve. If there was someone with a more unorthodox approach to monetary policy and policy setting, how loud could that voice possibly be if she was confirmed?
Not very loud. I mean, the way the Federal Reserve works, it's a consensus. It's a committee. The chairman sets the agenda. If you're, if you have views that are not shared by others on the committee, you can dissent, but you're not going to have any meaningful impact on policy. I think, if Shelton is confirmed, I mean, the main implication of it is just that Biden wouldn't have a chance to appoint governors to the Fed, and that might slow down his ability to put people in place that he thinks are more consistent with his policy views, not so much on monetary policy, but in terms of financial regulation and bank regulation.
Bill, great to catch up. We appreciate how open you've been in the last 10 minutes. Bill Dudley there, former New York Fed president, now at Princeton and Bloomberg Opinion columnist. And, Tom, I think that's important. Whatever you think of Judy Shelton, unorthodox, needed to break up the groupthink, whatever it is, when you work through the process of the FOMC, and Michael McKee, much more familiar with it than you and I, that voice won't be that loud at those meetings. Well, it might make a lot of noise in the media, but when it comes to the decision-making on the FOMC, it won't be as loud at all.
And to your point, she represents a thinking of a not narrow, minute part of America. It's not obtuse. There's a lot of people that have sympathy for the theory she's expounded for years, and I think that that's more important than anything we can talk about.
Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up on the programme, Barry Ritholtz of Ritholtz Wealth Management and Bloomberg opinion columnist. From London and New York this morning, good morning to you all. We decline on equity futures after a downside surprise on retail sales. It is a test of the faith of the year ahead, with the numbers set to get worse from here in the US economy. Down 27 on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Mark Zuckerberg and Jack Dorsey will be defending themselves before Congress. Again, the CEOs of Facebook and Twitter will testify before the Senate Judiciary Committee. For the second time in a month, they'll have to answer critics who say their social networks silence conservatives. Meanwhile, Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote this week. The strongest storm of the hurricane season has slammed into Central America. It's threatening to cripple a region already hurting from a deadly storm 2 weeks ago. Hurricane Iota came ashore along Nicaragua's northeastern coast as a Category 4 hurricane. Its winds are now 105 miles per hour, and it's likely to trigger deadly mudslides. And Amazon is making its biggest push into selling prescription drugs yet. The world's largest online retailer is launching a digital pharmacy. Shoppers can pay using their health insurance. And Prime members who don't use their insurance are eligible for discounts on the Amazon site or at about 50,000 pharmacies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
That the Fed can do all that is required at this point to support the economy is just wrong. And the Fed is really pleading for fiscal relief. I believe it's essential.
The former chair of the Fed, widely rumored to be considered for Secretary of Treasury by President-elect Biden, Chair Yellen. That was a great panel, my favorite panel so far at the New Economy Forum. Stephanie Flanders holding court with elite central bankers, Francine Lacroix with Christine Lagarde later in the U.S. morning, I believe, today. Right now, one Barry Ritholtz is with us, and we have here in this blur of news something foundational to Ritholtz theory. And we're going to go there right now. Barry, all I want to do is I'd really like to make just 27% per year. And it's just simple. Buy Home Depot and don't do anything else. Why is that so hard to do?
Well, first you need a time machine to go back in time and buy these things when they were cheap. Hey, everything is obvious after the fact. Don't tell me what were the big winners of the past year. Tell me what the big winners are going to be next year.
What are they right now?
That's
What
a
are
much
they
more
right now?
challenging. Right. I mean, the harder issue is being able to see the future, and we have a very checkered track record as a species doing that.
Sure. And if you want to not look and predict the future, which you can't do unless you are someone very special and far more special than I, typically people go towards some sort of 60-40 allocation. There's been a lot of angst recently. And really, if people do go toward that, can they just expect to get 2%, 3% based on where Treasury yields are? Is that the new reality of today?
Clearly not. I don't do predictions, but I think it's a fairly safe probabilistic exercise to say the returns that were garnered in the past decade in fixed income are not going to be the same sort of returns we're looking at over the next 10 years. And the reason for that's pretty obvious. A decade ago, the 10-year was yielding 4%. Today, we're under 1%. So not only do you get that yield, you get the benefit of the capital gains. Unless the U.S. goes deep into negative territory, and that's a very iffy situation, the odds are against the same sort of returns in fixed income the next decade as they were the last decade.
You know, I got to say right now, we're looking at markets. We're talking these long-term allocations. Markets are skipping over the near term. And attention on this show for the past few weeks has been the dissonance between the near-term outlook, which is pretty negative, and frankly, the data that we just got having to do with the October retail sales confirming that negativity versus that very positive future without face masks, without social distancing. How do you work around that? How do you trade with that backdrop?
So first, let me just challenge a little bit of your question. I wouldn't say it was the past few weeks. Go back to the end of March. From the beginning of the second quarter, markets were looking over the valley of the pandemic, of the lockdown, of poor earnings, and looking towards a better future. That said, all that said, the big change over this year has been the attenuation of the trillions of dollars of the CARES Act that have worked its way through the economy and is now fading. When we see one of the big things we watched over the past 2 quarters was the rising savings rate. That's not only ended, it started to reverse. We've seen fairly robust sales in retail, at least robust from what people can either do from home or go into places like Lowe's and Home Depot. That is starting to fade also. And so the big question is, are the adults going to step up, and will there be fiscal policy to match the monetary policy?
Barry, we've been in a trading zone here. You know, I don't know, I'll say September, October. It's been a broad zone with some volatility as well, even though we're lifting up to some new highs. What do you do when you're in a trading range in the equity markets? I mean, do you go to Florida? Do you read your last book? Do you write a book? What do you do in a range?
Less is more. I mean, you're definitely hinting at the right situation. My favorite historical example is to think about the period of 1966 to 1982.
Yep.
Remember, the new bull market kicked off in 1982. The Nifty 50 pretty much hit their peak in 1966 and did not surpass that for the next 16 years, certainly not on any sort of sustainable basis. The Dow just barely kissed 1,000 and did not get up and over that until 82. And if you look at people who were making regular contributions to their savings accounts, go back then, there really was no such thing as a 401k, and there were sparsely used 403bs. But if you were making regular contributions to your portfolio, to your retirement account, you went nowhere, and in fact, you lost money on a real inflation-adjusted basis. But then suddenly 82 to 87 comes along, and then even after the 87 crash, the next decade, all of that accumulation of assets during a period of sideways non-growth suddenly exploded in value because you're teeing yourself up for the next cycle. And if the next decade presents us with that, that's what long-term investors are going to have to think about. not this cycle, but the next one.
All right, Barry, thank you so much. Barry Ritholtz doing so much for Bloomberg. I love his podcast. Hugely, hugely successful. Longer discussions with some really smart people as well. Lisa, within the blur of the morning, yield has shifted on the 10-year 0.8701. We're in 4 basis points.
Yeah, what you're seeing was a complete reversal of the reflation trade. And I think it's really interesting to see the commensurate gain in the NASDAQ futures, basically people going back to the stay-at-home stocks. What's interesting to me about this move, Tom, is it comes after the much weaker than expected October retail sales. Yeah. Why is this a surprise? We saw the numbers climbing. We saw the restrictions. We saw the fact that in the high-frequency data, people were not getting in the cars and going out to eat. And surprise, surprise, that has consequences. Yeah. And the question is, how long-lasting will the reversal of the inflation be?
What'd you learn on the show today?
I learned about your salt preferences.
Yeah, exactly. The biggest response, I love it. I'm going to tear up here. I mean, this is very, very emotional. I mean, I learn something every single day. John Farrell's looking at me like I'm supposed to know where they make salt in Italy. I have no clue about that. And Paolo out on Twitter put out maps, Lisa, of where they make the pesto up near where Francine Lacroix's from. Okay. And then way down south is where they make the salt.
Okay, you can't pin this on John. You were the one who started talking about chestnuts from a town in France that you can't pronounce. And Mrs. Keene going crazy with her pesto purchases. I will say, the other thing that I've learned from today's show is there is a growing feeling, perhaps fade the vaccine optimism. John was talking about that. We've been getting that with respect to some of the strategist notes. And are we getting the tipping point today with this retail sales data that does not even show the heart of the slowdown that we could see from
I will take your point that it is challenging retail data today, and we'll see how it goes. I'm looking more there at the labor economy than anything else. Let me look at the data right now. Red and green still on the screen. I'll tell you, you can say what you want about a movement lower in equities, but it's still red and green. NASDAQ ever so slightly positive, down negative 255. S&P futures down negative 25 near lows for the day. Again, the 10-year yield in a solid 3 basis points, 30-year bond in 4 basis points. Oil's not giving me much. And the dollar is weaker. I'm just looking at renminbi. It's been quiet here, 6.56 on the yuan. We advance forward the conversation on economics. Alan Blinder of Princeton coming up on Bloomberg. On Bloomberg Radio and on Bloomberg Television. Stay with us through the day. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They move the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now. With equity futures down 24 on the S&P, we begin with a big issue. President-elect Joe Biden warning of a dark winter ahead.
Things are going to get much tougher before they get easier. And that requires sparing no effort to fight COVID so that we can open our businesses safely, resume our lives, and put this pandemic behind us. It's going to be difficult, but it can be done.
The United States adding 1 million new cases in the first 10 days of November alone, forcing governors to pause reopening plans, reverting back to partial lockdowns. Philadelphia introducing some of the country's tightest measures, halting indoor dining, closing museums and schools. Iowa implementing a limited mask mandate. New Jersey, Oregon, Washington State increasing restrictions yet again. And California putting more than 94% of its population in its most restrictive tier for curbs. The governor, Mr. Newsom, indicating he could go even further.
We also talked about an emergency break based upon data and based upon conditions that would provide for a framework of flexibility to tighten restrictions. We also are considering full disclosure, a little bit of a preview, the notion of a curfew.
So here we are, grappling with a darker winter. Markets have been pricing in a brighter future. An uncomfortable contrast between record COVID cases and record stock markets. Let's bring in the Bloomberg's team. Katie Lyons and Sarah Ponzek for more. Katie, the numbers aren't great. We've talked about them over the last several weeks. Now the policymakers responding in a bigger way.
Yeah, John, the simple fact of the matter is the virus here in the U.S. is getting worse, not better. When you look across the Atlantic over in Europe, a number of countries that have put in place more restrictive measures are starting to see the growth in COVID-19 cases level out or even fall. Places like Belgium, Germany, and France. While here in the U.S., cases just keep climbing. Over the past 7 days, the average growth rate is 37%. And just on Monday, at least 10 U.S. states logged records in terms of daily new infections. Nationally, that number was 166,000 just on Monday, very close to the peak of 177,000 earlier this year. And we have to note, John, that it isn't just about the actual case count, but also about hospitalizations. And that number currently sits above 73,000 as of Monday. Hospitalizations hitting a record every single day except one in the past week. As a result of those grim numbers, as you just ran through, a number of states moving more toward restriction rather than reopening, be it in California, on the West Coast, Oregon, Washington, and here in New York, we are very close to that 3% positivity rate that would shut schools down. So as a result, all eyes are on the possible solution, which, of course, is a vaccine. We did get that positive data from Moderna yesterday, 94.5% efficacy rate following Pfizer, which posted similarly positive results last week. But the fact is, John, that these vaccines, even once they're approved, still need to be scaled. They still need to be distributed. It's going to be a long time before the population is actually vaccinated. So the vaccine, yes, a longer-term solution, but in the near term, John, the numbers are still looking bleak.
Kelly, thank you. The numbers are bleak, and this is the challenge. This is the question for our audience, for market participants. How committed will you be to the second half 2021 reopening trade? How tolerant will you be of the likely deterioration, worsening economic data between now and year end? The downside surprise we had on retail sales about 30 minutes ago was an early test of just that. This is what Bank of America had to say this morning. This was the most bullish fund manager survey of 2020 on the back of the vaccine election and macro. The November results show a big drop in cash, a 20-year high in GDP expectations, and a big jump in equity exposure. Sound the vaccine, we're close to full bull. For more on that, let's bring in Bloomberg's Sarah Ponczek. Hey, Sarah.
Hey, John. And Bank of America is not alone in this more pessimistic sentiment this morning. If we just take a look at futures markets this morning to see what we are shaping up for at the 9:30 open, we do see a fade. Granted, though, this is after a record high for the S&P and the Dow. At the same time, you look at the S&P up more than 10% over the last 11 days. We also had a downside surprise on retail sales. Over in Europe, the stock 600 had gained more than 15% in 11 days. We see a fade there, too. The NASDAQ, though, we do see it buoyed, of course, by Tesla's addition to the S&P 500. Tesla up 13% this morning. Tesla has a more than 3% weight in the NASDAQ, so that will help the tech-heavy stock out this morning. If we flip up the board, though, we take a look at commodities and currencies. We also look at the 10-year yield. We see a bid to safety returning today. Yesterday, we barely saw bonds budge after the Moderna news. Well, today we see yields headed lower. That's a change. 10-year at 0.8685% this morning. You also look at the offshore yuan at the highest against the U.S. dollar since 2018. This off the back of the expectations for easing political expectations, also easier trade tensions, possibly a contraction in commodities too. But bring it back to equities, because technically, if you look at a 14-day RSI for the S&P 500, not technically overbought. We have not surpassed that 70 mark that does demark that. However, we see the S&P climbing further and further and further away from its 200-day moving average. You mentioned Bank of America, but I'll give you a trifecta this morning. Cantor Fitzgerald yesterday turning tactically bearish, in part due to sentiment and the fact that positive vaccine news is now behind us. At the same time, Peter Cheer of Academy Securities writing this morning that this is the perfect storm of, quote, sell the news moments. He's referring to the vaccine news behind us, the election behind us, Tesla being added to the S&P 500. So this growing bearishness asserting itself in the trade lightly this morning and also across many strategist notes too, John.
Trying to top tick is a tough business. Sarah, it's great to catch up. We'll touch base with Sarah a little bit later this hour. Morgan Stanley's Mike Wilson is just leaning in, continues to lean in, seeing opportunities in the reflation trade and writing the following. We continue to lean cyclically in our recommendations. This means small over large and cyclicals over defensives. The recovery will be surprisingly V-shaped and bring inflationary pressure. Mike, I'm pleased to say, joins us now for more. Mike, let's just start with a number from 36 minutes ago. It's an early test of how tolerant people will be of potentially some bad news between now and year end. How tolerant will you be of that, Mike?
Well, John, it's always good to be with you here. I think you have summed it up well as usual in the opening of this show. I mean, we find ourselves at a juxtaposition between the 12-month view, which is unequivocally bullish to us, with this year-end conundrum around, we have a vaccine, but we have to deal with the rising case counts, not to mention just getting through the runoff elections and positioning and sentiment, which has gotten a little frothy. So that's the exact question we've been asking our clients is how committed do you want to be to your 12-month view? And our experience suggests that people are committed until it starts to go against them. And it's interesting, we are starting to see some sell the news type calls out there. We would agree with that, perhaps in the short term. I think most people would assume that you could have a 2, 3, 4% drawdown at any time. That can easily be managed, and you should definitely stay committed to that. If you think it's going to be something more significant than that, then you need to probably de-risk a bit. We're trying to stay committed for our longer-term accounts, and so our message to our longer-term accounts has been very consistent all year, John. As you know, we're in a recovery. We want to be more cyclically geared. We want to be small cap. We want to stay with that view. However, we understand that our institutional clients who are more trading-oriented may have to deal with some volatility here between now and year end. And we feel like the 3,600, the risk reward isn't great for new money entry here. And we could see a drawdown in the short term. That's the tough part of this game. You have to kind of do the short term with the long term. And it just depends on your time horizon.
Mike, it would be disingenuous of me to sit here and characterise you as an Uber bull. You had your trading range. The upper end of the range was 3,500. You came on this programme once we got in and around that level and said the risk-reward wasn't pretty. You're now looking for 3,900. Year-end 2021. That's the destination. Can we talk about the path just a little bit more, Mike? The kind of things you expect to look for in the coming months. One thing that's really struck me is how underappreciated this recovery has been up until this point. No doubt the data now will deteriorate just off the back of the restrictions we're seeing across America. Just walk me through your latest thinking a little bit more, Mike.
Yeah, I think this is the more interesting part of investing at the moment. It's not about the index so much; it's about what's going on underneath the surface. And there, whether it's a rotation call, whether it's sort of the median stock, and that's really our view. So I think this is the path we're looking towards, and where our call may be a bit differentiated. So we've been more bullish on the economy, we've been more bullish on the earnings recovery, and I think we're still there. We're looking for something like close to $180 in earnings next year for the S&P 500. Okay. However, where we're also out of consensus is we think multiples are going to come down over the course of the next year from, call it 22 times down to towards 20 times. So it's this trade-off between better earnings growth but lower multiples. And in round numbers, I would suggest that we're going to have about the forward 12-month numbers will go up about 20%, and the multiple will come down about 10%. Hence our 10% upside to the S&P 500. Now, an average stock could see much more upside than that, right? Because we see many, many stocks out there that are more cyclically geared that could see, earnings revisions that could be close to 30, 40, 50%. And their multiples, don't have to come down nearly as that much. So we see 20% upside for the average stock with 10% upside for the S&P 500, which creates a wonderful stock picking opportunity for active managers. And once again, we want to skew our longs towards those companies that have greater operating leverage potential in a booming economy next year, once we get through this near-term concern. And that would mean you want to skew down the cap curve and towards the more cyclically oriented sectors.
I want to bring the other asset classes into the mix as well. The other call that you and the team have got is 145 on a US 10-year. Do you need the bond market to come with you, Mike? And do you see the same kind of story that you see in equities, short-term, different to what you see long-term? Because what I've seen in the bond market this week is just a 10-year Treasury that's not playing bull in that rotation trade.
That's right. And somebody else mentioned it earlier, which I think is spot on, which is that we had the vaccine announcement from Pfizer last week, very bullish, and rates really had a big move. And we had the big, rotation towards the reopening stocks. Then when the Moderna news came yesterday, which was fairly well expected, even though it was better in terms of the efficacy, it was kind of a muted move in some of the reopening stocks. It was good, but not as powerful as it was with the Pfizer news. And rates didn't budge. Okay, and rates are actually below where they were now prior to the Moderna release. I think there's a lot of information in that, and what it tells you is the market's tired. Like, we've priced a lot of this good news. As you know, we came in and made a buy trading call right before the election because we were down at the low end of our range. And I just think that that's the strategy that has served us well for the last couple of months. And I think we're still in that range, call it 3,150 to 3,600 now. It's been extended a little bit. And so the risk reward, once again, will be much more attractive if we can have a bit of a drawdown. And that's a bond story as much as it is a stock story. If yields probably go lower in this sort of what I would call a growth scare, short-term growth scare in a continuing V-shaped recovery.
Keep the faith. Trust the recovery. The message from the team at Morgan Stanley. Mike, great to catch up, sir. As always, we appreciate your time. Busy morning for everyone. Let's continue the conversation in this market with Bloomberg's Abigail Dillital. Hey, Abigail.
Hi there, John. Well, lots of big name movers to take a look at. Starting out with Tesla, shares are absolutely soaring, helping to explain, as Sarah was mentioning, the NASDAQ 100 futures are higher as the S&P 500 falls. The stock up about 13% in the pre-market. On the news, it is finally being added to the S&P 500. This means index funds and PMs have to buy the stock. Now, this stock already up in a huge way this year. The best performer for the NASDAQ 100 up 388% into today. Zoom is the next best stock, up 173%. So after today, Tesla will clearly be in charge. Also on the move today, big pharma names. This on the news that Warren Buffett's Berkshire Hathaway has added positions to the like of Merck, Bristol Myers, AbbVie, Pfizer. It seems that the firm wants exposure to COVID vaccines and other therapies. However, equally interesting, they have trimmed positions in banks, including Wells Fargo, PNC, and JP Morgan. That, of course, is a part of the reopening trade, the reflation trade. These banks down on this news of Buffett trimming the banks. But also we do, of course, have bonds rallying on a bit of uncertainty this morning. That means yields are down. The yield curve is in. That is also weighing on banks as well, John.
It's an early test. Abigail, thank you. Thank you very much. It is the test. The two questions we'll keep asking through the next hour on this programme. How committed will you be to the second half 2021 reopening trade? How tolerant will you be of worse economic data between now and year end? That'll be the test as we get more restrictions in the United States of America off the back of COVID-19 spreading through the Midwest and beyond. Up next on this program, President-elect Joe Biden urging Congress to pass a larger-scale stimulus package. That conversation coming up next with PGIM's Greg Peters from London and New York this morning. Good morning. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We're not just going to snap right back to the previous economy. I think that's unrealistic. There are people, though, that need to be retrained. This has accelerated, for example, trends in retail, right? We've seen that. So we're going to have to figure out how to retrain that workforce.
Right now, Congress should come together and pass a COVID relief package like the HEROES Act that the House passed 6 months ago. Once we shut down the virus and deliver economic relief to workers and businesses, then we can start to build back better than before.
President-elect Joe Biden there weighing in on the prospect of more fiscal stimulus, calling for a larger package, running into some Republican opposition. Senator Richard Shelby of Alabama pushing back, saying, quote, "Start with the skinny bill. We are targeted to various needs of small business and hiring. Keep the economy going, not a wish list of fixes for political and social problems." Joining us now is Bloomberg International economics and policy correspondent Michael McKee. Good morning to you, Mike.
Good morning to you, John. Nothing, nil, zip, nada, or as you like to say in the UK, nil. At this point, Biden's call for additional stimulus being met with big yawns from Republicans on Capitol Hill. It looks bad. But there are two dates to keep in mind. December 11th, the government runs out of money, so there's a must-pass spending bill coming you could attach something to. If there's a compromise, look to that. The second date, December 31st, end of the year. Look what happens. 13 weeks extra unemployment, gone. Unemployment for gig and freelance workers, gone. Eviction moratorium, gone. Student loan forbearance, gone, and a lot more. So in that context, today's retail sales numbers are bad news. If we're going to lose support for the economy at a time when the economy is already slowing, maybe that'll get some attention down in Washington. You look at retail sales, the weakest showing since April when the pandemic was at its worst, just up 0.3 on a month-over-month basis. Last month, it was up 1.6%. The consensus was for 0.5% gain. 5 out of the 13 retail categories rose. Last month, 11 out of 13 rose. So a definite slowing. And here's the thing. So far, what we've been doing is spending a lot more on stuff because you can't go out and can't do as much as you used to in terms of travel or restaurants or anything like that. And the number of people, the amount of spending we've done on the service economy, nowhere near recovering as it has with goods. So if goods are slowing, then we got problems going forward. So the eyes are now on Washington, and if Congress isn't going to do anything, is the Fed going to do something more? That's a question for later today. Jay Powell speaking, not exactly a format, it's an award ceremony, but he is answering questions. And does he talk about this, the rise in the 10-year yield, the yield curve steepening over the last couple of months, and whether the Fed needs to do anything about that in December? You get more and more calls, John, from people suggesting that that should happen, that they should move out the weighted average maturity, start buying at the longer end. We'll see if we get any kind of hint from the chairman today.
Michael McKee, great to catch up, Mike. Thank you. The tug of war continues. The forward outlook looks brighter. The near-term outlook is looking darker, and a pendulum just swings from one to the other. Vaccine news yesterday, the focus on the data this morning. That's going to be the volatility between now and year-end. PGIM's Greg Peters expecting central bankers to tighten their focus on inflation following the latest vaccine developments. He writes the following. Given the prospects for the aggressive asset purchases to continue, we believe global interest rates will remain low, subsequently limiting the potential increase in US long-term rates going forward. I'm pleased to say that Greg joins us now. Greg, Deutsche Bank wrote something similar to this morning. They looked over to Asia, essentially said if things are good in China right now, the recovery's strong and they're getting downside surprises on inflation, why would you think we'll get anything other than that in the United States, Europe and beyond? Your take, Greg?
No, I completely agree. I don't see what's changed fundamentally from an inflation standpoint pre and post. If anything, I see a more difficult inflation regime going forward. So you look at just the massive amount of debt's been added that pulls down inflation. Growth is, slated to spurt up, but then come back down. You're seeing that already. We're waiting for more fiscal stimulus. So to me, this inflation rise is more of a hope than anything else. So I see real value in U.S. Treasuries, 10 years, 30 years, as I think the market has really been banking on this reflation trade that I really don't see materializing. So I don't know. And it's tied to the risk markets as well. So Wilson just talked about calling for a 140 10-year. I think it's really hard for risk markets to do well in that type of yield environment. So to me, the world needs low interest rates, and I think central banks will help deliver that.
A real recognition of how difficult it will be to get anywhere near 140 between now and year-end. The story seems to be around the hope of 2021. And Greg, to your point, it's just about tolerance levels. We've added a lot of debt to this economy. How tolerant will we be of higher interest rates? You brought up credit. Let's sit there for a moment. Your long US duration, 10s and 30s in the Treasury market. Walk me through the credit call now, Greg.
Yeah, so credit has rallied a lot, obviously, since March. It was just absolutely cheap beyond recognition. It was just so dramatically attractive. That's changed to a large degree, but there's still lots of value within the credit market. What's really interesting to me continues to be in several areas. The BB and BBB space look completely dislocated to me vis-a-vis other parts of the credit market. Long duration IG looks attractive as well. And what's notable is that the CCC part of the high yield market, yields are actually, or spreads are actually tighter today than they were pre-COVID. So there's such a bet on this reflation trade that to me it's overextended. And so that's not where the value is.
Greg, I wanted just to finish on the short end of the yield curve in credit. What we saw back in spring was a huge dislocation in short-end credits in investment grade and high yield alike. Can you walk me through how much the maturity profile has changed? I talked about this a little bit earlier on Bloomberg TV and radio. Do you think the maturity profile of some of these big companies has changed enough, that they've termed out the debt long enough, that if we do have some choppy months ahead of us, similar to what happened in spring, we don't see a repeat of what happened in the credit market?
Well, I'm not sure you won't have a complete repeat, but you have seen this terming out. So it's been a real positive move in credit since March. So there's been this massive amount of issuance. So companies have taken out short-term debt. added longer-term debt at lower coupons. So that's a real benefit. It creates that operating leverage to the cycle. So to me, kind of perversely in here, since March, the credit profiles, even with cash flows getting absolutely destroyed, is actually better and better for the future. So I do think it puts companies in a less precarious place. But there is a big difference between these investment grade, high yield companies, these larger cap type of companies that we invest in versus these smaller kind of medium-sized businesses that don't have access to the capital markets. And that's where the struggle is. And quite frankly, that's where the stimulus needs to be focused on. So to me, there's two separate parts of the credit market, and the public market is in way better shape than the private market.
Some difficult months ahead of us, Greg. Looking forward to catching up with you as we navigate those choppy waters into year-end. Greg Peters there of PGIM. Up next on this programme, the analyst action you need to know in our morning calls. Then later, Oksana Aronoff of JP Morgan. This is Bloomberg. Here are the morning calls. First up, UBS upgrading Monster Beverage to neutral. $85 price target. The analyst expected a pickup in US demand with a more balanced risk profile in 21. Next up, JP Morgan upgrading KB Home to neutral, $44 price target. The analyst citing a stock's valuation and expectations for above-average growth next year. And finally, BMO downgrading Moderna to market perform, $109 price target. The analyst seeing limited upside following the stock's recent rally. That stock is negative about 1.5%. Up next on this programme, JP Morgan's Oksana Aronoff joining us for the opening bell. It's the pandemic versus the vaccine, near-term headwinds versus long-term tailwinds. All of that still ahead. This is Bloomberg.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
The real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell in New York City, set to pull back from all-time highs on the S&P 500. It's the first test for you. The near-term test, COVID rate, not pretty across much of the United States of America. Policymakers responding. We pull back from all-time highs as retail sales delivers a downside surprise. Down 22, going into the open off by 0.6%. The small caps underperform, big tech outperform. Switch up the board in the bond market. Here's the bid into treasuries. Yields lower by just 3 basis points now to 0.8766%. We can't get through 1%. That's the story of the last week, even with the vaccine reality, not hope, reality. That on the horizon is the real deal. You've got to get through year-end first. In the FX market, euro out towards 119 at 118.78. No doubt Guy Johnson will run you through the European side of the story in just a moment. More broadly, though, a weaker dollar. In the commodity market, down about 1% on crude. We break 41, south of that level at $40 and about 95 cents. That's the cross-asset story at the market desk with your movers. Here's Abigail.
John, let's dive deeper into the divergence between the Nasdaq being up a bit, the Dow and the S&P 500 lower. One of the world's largest companies, those shares are popping higher. I'm talking about Amazon.com. This on the news that the e-commerce giant is pushing into an online healthcare, an online pharmacy, and they will be giving discounts to Prime members. This is sending shockwaves through the rest of the healthcare space. You can see CVS and Walgreens both sharply lower. Other names such as AmerisourceBergen, McKesson, distributors, they're also lower as on the fears of Amazon moving into this space. Also moving into healthcare, Berkshire Hathaway, Warren Buffett's firm. We have some of the big pharma names popping on the day, Pfizer and Merck, apparently a push around the vaccine and also other COVID therapies. On the other hand, we have Berkshire trimming positions in the banks, including JP Morgan and Wells Fargo. Of course, the yield curve coming in not helping. But the big story, or one of the biggest stories, Tesla in a class of its own, absolutely soaring. This stock up 11.5% on the fact that the news has finally come out that the company is being added to the S&P 500. Long awaited and hoped for. It's now happening. It means indexers will have to buy this stock, now up more than 400% on the year, John.
Congratulations to Elon Musk and the team and those committed longs. The religion that is being long Tesla has delivered in a massive way in 2020. 2 minutes into the session, we declined by about 0.5%, outperforming consumer discretionary by about 0.1%. Energy bottom of the pile, down by around about 2% and change. It's been leading the way, outperforming in a massive way over the last week and yesterday. Today, bottom of the pile, down 2%. That's the story in the equity market for big tech, just showing a bit more resilience in that defensive posture this morning after losing some of the luster on the heels of the major vaccine developments of the past week. For more, let's bring in Bloomberg's Sarah Pontek for more. Hey, Sarah.
Hey, John, a bit more resilience, but the key word here is really a bit. I'm looking at the Nasdaq right now, up 0.2%. So we're not seeing massive moves in the green, albeit the rest of the major indexes are in the red. I do want to note, though, that the addition of Tesla to the S&P 500, especially at this time starting next month, well, that will increase tech-like stocks' influence in the S&P. It's likely going to be a top 10 stock with a weight of more than 1%. This at a time when we have seen tech start to fade. If we look at the Nasdaq, it had really run up through much of 2020, still up 38% or so, though, year to date. So clearly, we haven't seen it lose too much of its luster. But if you look at it in relation to its 200-day moving average, coming back down to earth just a tad, but still a very, very strong performer on the year. At the same time, though, if you do plot the Nasdaq against the S&P 500, the peak came back on September 1st. So we have seen this quiet rotation taking hold now for weeks at a time. Vaccine news from both Pfizer and Moderna. But first, Pfizer really lit the spark, though. If you take a look at value and growth, we saw the widest dispersion in favor of value since 2008 last week. You can see this right here by means of looking at iShares ETFs, that S&P Value ETF and that S&P Growth ETF over the last month. At the same time, though, we have seen those stay-at-home stocks lose their luster. We're talking Zoom. We are talking Peloton. DocuSign, if you look over the last 2 weeks, has managed to stand its ground pretty much flat over the last 2 weeks. But Zoom, Peloton, Beyond Meat, granted Beyond Meat did also report earnings over this period, all down close to double digits or so over the past 2 weeks or so. This morning, though, we do see a bit of a comeback. Zoom shares up 1%, John.
Sarah Pozet, thank you. Not everybody is bulled up to the eyeballs. JP Morgan's Oksana Aronoff recommending investors stay selective. She writes the following: it could get ugly for the companies that have been able to hang around so far during the pandemic. So security selection is key, as one must differentiate between short-term disruption versus long-term value destruction. Oksana joins us now for more. Oksana, dare I say it, are you saying that fundamentals might actually matter in various parts of the credit market?
Good morning, John. So are you saying that we really shouldn't care about the fact that there are companies out there back to, trading at back to pre-COVID levels with revenues 90% down? That should not matter anymore. Certainly.
I'm saying I'm shocked that someone actually thinks it matters, given the conversations I've had, Oksana, over the last 6 months.
Look, absolutely, it matters. And certainly the market has been riding on the Fed's support. The Fed, however, is sending out smoke signals saying, look, we have done everything we can here, short of basically starting to buy equities. I think it's going to be really difficult for the Fed to garner any support in this upcoming administration and Congress to actually bail out over-levered companies, which we're seeing more and more. In fact, if you look at some of the testimony that Powell has done over the past summer, you see that there's very little appetite in Congress for that. He had to answer some really tough questions. So all of this to say that unless there is really a fiscal stimulus that's coming, which certainly does not look that way, certainly not through the end of the year at this point, these companies will continue to struggle. And I think there's going to be a lot more volatility coming into year end. We in credit, in high yield, we're seeing defaults at 7%, and spreads absolutely are not reflecting that remotely. High yield hit an all-time high last week of 4.5% all-in yield. This is not a market to be here. And you know me, when we were sitting in the studio with you back in, was it March? I said, look, this is Christmas morning for credit. This is when we're going to start to get busy.
Yep,
and there was a time to do that. And this is not that time. This is a time to step back, have optionality in your portfolio, and think about, what actually has the chance to survive, has the cash flow, has the demand, has the discipline on the balance sheet, and what is really going to be long-term destruction.
What does your cash position look like now, Oksana?
Our cash position is at some of the highest level we've had really in the history of our strategy, which we've managed for, close to 15 years now. And our liquidity, which, consists of a lot of different kind of flavors of cash, is over half of the portfolio at this point, because we think there'll be better entry points. In addition to being very liquid, we are focusing on high quality floating rate. So within investment grade, you've seen a ton of issuance on the fixed rate side. You have not really seen a whole lot of issuance on the floating rate side. No one wants floating rate debt. And we think that there's going to be an interesting, potentially price pop there when that interest does return. And remember, we are not really considering, as a marketplace, we're not considering inflation as a risk, and probably rightfully so in the short term. However, in the long term, if we do get that fiscal spend, it is likely going to go into the pockets of consumers as opposed to into corporate balance sheets or even financial asset support. So we think that thinking about inflation here is not a terrible thing to do. Thinking about having floating rate assets, high quality floating rate assets in your portfolio is not a terrible thing to do. And finally, housing continues to be a relatively bright spot. This is the first time we are in a recession with a shortage on the housing side, shortage in supply of housing, as opposed to, a tremendous amount of it or a surplus of it, as we generally tend to in recessions. So we continue to like that part of the market and look at non-agency and other forms of mortgage credit.
I want to touch on high yield just a little bit more with you, Oksana, because I wonder what you say to people when they say to you, Oksana, you're being greedy. Those levels aren't coming back. We're getting nowhere near that. Fed's in the game now. The game has changed. You'll be sitting on those cash levels a long time waiting to put that money to work. It's going to feel painful through the next 12 months. The Fed's in the game. You won't see the spread widening. What do you say back to them when that inevitably comes up in the conversation?
So two things. First of all, of course, it depends on your mandate as a manager, right? There are high yield managers who are strategically tethered to that space and have to be invested in it through the cycle. And their portfolio is going to look very different from ours, which is an absolute return oriented portfolio and therefore looks at capital preservation first. And with that in mind, what is the best return I can generate for you? And right now, this is, the definition of capital preservation right now is you have to step back from the market. So that's number one for someone with our mandate, which is a more diversification-oriented mandate. The second thing is that look at the amount of support the Fed has actually given the high yield space. Most of it has been completely symbolic. The Fed has spent only 3% of its overall secondary market program on high yield, primarily through high yield ETFs, which are, by the way, still lagging the broader high yield index by over 200 basis points year to date, in spite of that support. And again, Powell faced some really tough questions even about that and said back in March, we're not looking to buy individual high yield company bonds, and has seized any support for that market really in midsummer. We have not seen any support for high yield directly from the Fed. So the support has been largely symbolic, even though the headlines look great, right? The Fed supports junk, et cetera. But this has been a largely symbolic support. And if we do see additional volatility through year end, which I think we will, given the rising COVID infections and people kind of retreating back again, the consumer retreating back, I think there'll be better entry points. And it is our job to take advantage of them.
Oksana, you're very active. There will be selective securities, so forgive me for making this really broad, just for the benefit of this conversation that we're having for a wider audience. Right now, high yield spreads are at 430. The risk that you take and the compensation that you get for the risk you assume is very much in the eye of the beholder. And I wonder, from your perspective, when do you feel comfortable to put that cash to work? It's not 450, it's not 450, it's not 500, 525. When do you start to feel comfortable again?
So you have to consider what is the default rate in high yield currently, and it just hit about 7% in October. So current spread levels imply default rates in the lower single digits, not in the mid single digits or higher single digits, which is where it seems to be going right now. So you have to simply marry those two. I mean, bonds are simple math, right? There's no magic. I can't tell you whether the stock market is going to hit another high tomorrow or next week, et cetera. But bonds are a mathematically bound asset class. And therefore, we know that when we see spreads that absolutely do not reflect the reality on the ground of what defaults actually are, forget where they're going, then you know that you're not compensated for the risk. And in terms of where we would start to get interested is when spreads reflect the current default, or get closer to current default realities, which would be probably in the 600 to 700 rate range at least, and obviously more interested north of there.
Oksana, sometimes you make too much sense, and I'm just not sure whether you can make sense of this market at any point in the future, given the Fed's role in it now. Oksana, a conversation that you and I will continue, obviously, in the years to come. Oksana Aronoff there on this bond market. Let's head back to the market desk with Abigail Doolittle. Hey, Abigail.
Hi, John. Well, let's run through some tech movers first very quickly, starting with Apple. Shares are down slightly as Berkshire Hathaway has trimmed its Apple position. Interestingly, they took on a Snowflake position, that software company, as did Coatue and Tiger Global, so the stocks are higher. Facebook and Twitter trading in mixed action ahead of the CEOs of those two companies testifying before a Senate committee. And then retail, you were mentioning those weak retail sales numbers. We have some weakness here around those retail numbers. Plus, we also have earnings out of Home Depot and Walmart that weren't perfect. Both companies basically beat estimates, but just details that folks didn't like. Higher cost for Home Depot, Walmart's outlook a little bit fuzzy. Target reports tomorrow, down in sympathy. But again, those weak retail sales number, John, really begs the question of whether or not it seems as though folks really do need that stimulus to keep spending in the way that they had been, as Michael McKee had pointed out, John.
Yeah, one data point just to shake that confidence up just a little bit. Abigail, thank you. Coming up on this program, world leaders calling on China and the Biden administration to get their relationship back on track. That conversation up next with Franklin Templeton's Sonal does I. From London and New York this morning, good morning. This is Bloomberg.
So when you went to Baltimore, you went initially to be an
anchor woman.
An anchor woman, and then it didn't quite work out.
Yeah, I got fired.
Well,
well, demoted.
You got demoted, but they didn't. They had a contract, so
Yeah.
they didn't say goodbye. Yeah. And then, how did you work out to be on a afternoon show where you actually got to be an interviewer? How did that actually happen?
Well, what happened was this is what I now know with age and perspective, that many times getting demoted is an opportunity for something else to show up, or getting fired. You know, lots of people I've interviewed over the years who have these stories about the best thing that ever happened to you. It puts you in the next best place. I was not a good television reporter. I was too emotional. I was making $22,000 a year, and my best friend Gail, who I met there at the time, she was also working there. She said, "Oh my God, you're 22, making $22,000. Imagine when you're 25." And then you're 30. So I'd be making 60 about now. It'd be good, 62. Once I got demoted, they didn't want to pay out my contract. I was making $25,000 a year. They didn't want to pay me the $25,000.
Right.
So they kept me on and said, "We'll put you on this talk show just to run out your contract."
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
We've been shouting from the rooftops for a very long time. There is a monopoly problem in this country, and in particular, there is a Google problem in this country.
The American administration is about to change, but the clock will not simply be rewound.
There's been more external aggression and more internal repression. So that's just a fact.
He's inheriting a relationship with China that's going to be fraught for the foreseeable future.
We got to give the new administration a chance to articulate an approach.
We all want to work together with the U.S.
The key is, how do you have competition and keep it healthy?
The big challenge with China is to get what I would call a strategic framework.
And let's set it some basis for some cooperative action.
There's great opportunity for the incoming president.
The world will slide into a catastrophe comparable to World War I.
US-China tensions dominating discussions at the Bloomberg New Economy Forum. World leaders urging a US-China reset as the two spar over everything from trade to tech ahead of a new administration in the United States. For more, I want to bring in Bloomberg's chief Washington correspondent, Kevin Cerriti. Good morning to you, Mr. Cerriti. Great to have you back with us on the programme. Let's just start right there. A lot of reports this morning that this administration is going to make some moves that makes it very difficult for the next administration to unwind them.
Well, in terms of a compare and contrast approach, as I've been having conversations with geopolitical sources over the past couple of weeks, the way that they are interpreting a Biden administration is rhetorical predictability. Now, that often could lead to market predictability and market certainty with regards to the rhetorical approach that the Biden administration will take. Now, if you look at the advisors that he has been surrounding himself with, President-elect Joe Biden has really been being advised by a return to sorts from the Obama era. Take a listen to what he said yesterday about the U.S.-China relationship.
We make up 25% of the world's trading capacity of the economy of the world. We need to be aligned with the other democracies, another 25% or more, so that we can set the rules of the road instead of having China and others dictate outcomes because they are the only game in town.
Now, in speaking with geopolitical sources, what they say is that he's alluding to a more multilateral approach in terms of how to get Western allies back on board in order to then put pressure on Beijing to act in a more Western way. Jonathan?
Kevin, great to catch up, as always, sir. Looking forward to speaking with you through the week. Elsewhere, Franklin Templeton's Sanal Desai warning investors to remain wary of policy risks in the next phase of the recovery, writing the following. Geopolitics have taken a backseat to domestic issues, but will likely have significant implications in the coming years. Trade and relations with China specifically are likely to come to the forefront. Sanal joins us right now for more. Sanal, when you say that, do you mean that in a more constructive way for risk assets or a less constructive way?
So I'd say if we look at geopolitics, they have essentially taken a complete backseat. In any other year, a year like this one, with all the events which have taken place and all the moves which have taken place in Hong Kong, for example, I think that it would have been front and center in markets' eyesight. We've had COVID, we've had a presidential election. There's been a lot which has taken geopolitics off the stage. Now, if you look at a new year where you actually have some vaccines, maybe you start letting COVID, dare I say it, take slightly more of a back seat than it has this year, together coming at a time with a new administration, which is more multilateral in its approach to geopolitics in general, and China in particular. I don't actually think it's going to be necessarily constructive for relations between China and the U.S., if China and the rest of the Western world, rather. However, from risk assets perspective, I think you will have less uncertainty for sure, and that could be seen as somewhat positive.
That's the long-term story for risk assets. Let's talk about the short-term one. I know where you are more constructive, and that's on municipal bonds. I just wonder, for certain municipalities, they're going to really struggle in the next couple of months, and I've heard some mayors, including the mayor of Detroit, turn around and say that budget issues are secondary right now to the healthcare crisis right in front of us. So now, how do you square that circle right now?
So I think that what we are anticipating is, regardless of whether we have a divided Congress or a united Congress and administration, I think that we will see a second fiscal package. And I think that there's going to be more in it for state and local than we are currently anticipating. I am less negative on the potential for the size of the package, even if we have a small Republican majority in the Senate. I think Republicans will come to the table with something more than that $500 billion, which was initially announced. I think it's going to be closer to being over $1 trillion, I would say. And of course, if we have a sweep, I think we're looking at something closer to $2 to $3 trillion. This is going to assist state and locals. On the other side of things, I also think that eventually we are going to see tax increases in several of these areas, which will result again in tax-free municipal bonds being an attractive place to invest. That is our general view right now. I think that the pessimism regarding a second fiscal package is premature and overdone.
So now a conversation that you and I will have to continue. Sanal Desai there. Great to catch up with you, as always. Just a bit of breaking news. Senator Grassley says he's quarantining after exposure to COVID-19, awaiting a test result. Unclear the potential fallout here, considering the Judy Shelton procedural vote a little bit later today. More still to come on Bloomberg on that. This is Bloomberg TV.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
"25 minutes in, equities retreating from all-time highs. You've got a test of the confidence. How high is your tolerance going into year-end? Retail sales, downside surprise, stocks lower by 0.8%. The relative outperformance coming from the Nasdaq, the underperformance from the small caps, as you might expect. Here's the trading diary. What you need to be watching through this week. Through the next couple of days, the CEOs of Facebook and Twitter testifying before a Senate panel at the top of the hour. Fed Chair Jay Powell speaking at 1 p.m. Eastern. Plus, we'll hear from Fed Presidents Bostic's Daly, Kashkari and Rosengren. Williams and Kaplan speaking on Wednesday. And on Thursday, we get another round of initial jobless claims and existing home sales as well. From London and New York, that does it for me. 26 minutes into the session, equities decline. For our audience worldwide, this was the countdown to the open. Continue the conversation with me on Twitter at FerroTV. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. In London, I'm Guy Johnson, my co-host in New York, Alex Steele. Welcome to Bloomberg Markets, everybody. Alex, that retail sales number, that weaker than expected retail sales number really caught my attention.
Yeah, and the stronger industrial numbers, which is something we've seen play out in Europe as well, that's casting a pall on the market. You're seeing tech still down by about 0.6%, but outperforming the rest of the indices. So it's your typical kind of safe haven play in so many ways. You know, you buy the bond market there. And the interesting thing, though, is people are selling the dollar, particularly against the cable rate. That really the outperformer, up by about 0.4%. I also wanted to highlight gold. Macquarie says it's the end of the bull gold market, yet the price action not really showing that today. That's not the gold price there. That's different equity. But nonetheless, in terms of gold, it is still sort of playing out in terms of the safe haven. I did want to highlight, though, the full bull market, the title, that's the fund manager survey from Bank of America. I thought that was the cleverest title. They're basically like, look, we're capped out here. And if retail earnings and retail sales are any indication, maybe there's some point to that. Retail earnings rolling out this morning. Economic data showing customers are slowing their spending. October retail sales data revealed the slowest growth in about 6 months. Joining us now with a breakdown, Michael McKee, Bloomberg International economics and policy correspondent. Hey, Mike.
Good morning to you both. And Guy, we call it getting whacked upside the head here in the colonies by the numbers. This is the worst, as Alex said, since April. Just a 0.3 gain for retail sales during the month of October. That's down from 1.6% in the month of September. When the pandemic was at its worst in April, it was much worse than it is now. Only 5 of 13 categories rose last month, compared with 11 of 13 in the prior month. The data from October in November, it seems to be getting worse. JP Morgan economists report that Chase card spending has fallen notably in the first part of this month. It is, as they say, really dropping off, and that suggests a weaker month ahead. Who knows what will happen with Black Friday, if anybody cares about that anymore. But it's clear Americans are cutting back, which makes the news on retail earnings today kind of interesting. The actual results, much less meaningful, of course, in that their third quarter numbers. We know that was a big quarter, but it's about who is doing well and why. Take a look at the chart here. Walmart beats expectations pretty much across the board. Earnings up 6.4%. Kohl's, their same-store sales fell 13.3% compared to Walmart's 6.4% gain. And it's because Walmart's an essential retailer. They're selling stuff like toilet paper and groceries, whereas Kohl's is selling apparel. Retail sales apparel down 4.2% in today's retail sales report. So it depends on who you are and what you're selling at this point, which maybe bodes difficult for the coming quarter. Home Depot slipped in early trading. They had a good quarter in terms of sales, but they're expecting higher costs because of the pandemic. So everybody being affected by what's going on with the virus, and it just gets back to what we've always said, the virus decides.
Absolutely. As you say, the market getting whacked in the head by this data. You have to wonder, Mike, what the November number is going to be looking like, because many of the restrictions that we've seen starting to be put in place by the states over the last couple of weeks, well, they're not in that data series. They're going to be in the next one. They're going to be in the November number. I'm sure you'll be back around to tell us what that number looks like when it arrives. Mike McKee, thank you very much indeed. Let's carry on the conversation about what's happening with the U.S. consumer. Joining us now, Chuck Grom, Gordon Haskett, senior retail analyst. He has a buy rating and a 115 price target on Home Depot and an accumulate rating, 150 price target on Walmart. Chuck, I actually want to start big picture. The retail sales number today was weaker than the market anticipated. And as I say, we're going to see the next data factoring in the significantly greater restrictions as a result of COVID when we get to the November number. What is your big picture view of what is happening with U.S. retail?
Yeah, well, good morning. And we expected some of the commentary this morning, actually, on Walmart and HD's call to be a little bit negative. Our traffic data in the beginning of the month pointed to a little bit of a deceleration. And you could, sort of articulate that to the CNN effect, warmer temperatures throughout the country. But ironically, I just got off the calls for both Walmart and Home Depot, and Home Depot said that so far in November, the first 2 weeks have actually sequentially accelerated from a 23% pace in the month of October. And Walmart outlined that the back half of the quarter got better as back-to-school selling resumed more normally and food strengthened. So, we'll see. I mean, I know that the retail sales number were a little bit softer. They actually, on a year-over-year basis, were actually pretty healthy. So we'll see how it plays out. But the real-time data that we're getting from both Walmart, HD, two big companies, is actually pretty constructive this morning.
So let's just take Home Depot for 1 second, because we did get housing number. NAHB housing market index beat expectations again. The housing market's been, and autos have been two of the really big bright spots. What does Home Depot forecast then for the first quarter as rolling lockdowns continue?
They didn't specifically give a guide, but I would say that their tone on the housing backdrop was about as constructive as I've ever heard them. So I think that bodes well for them. In addition, they spoke to how their pro business, which is about half of their sales, the backlog on the pro business continues to grow and get bigger, which echoes commentary from a number of other home improvement names. So I think the outlook for the home improvement space is very good as we move into the fourth quarter and into the beginning of next year.
Okay, let's explore that a little bit. Are these stocks you want to own when the vaccine effect kicks in? Am I going to be wanting to fix up my house, or am I going to be wanting to go to a bar? Am I going to be spending money at Home Depot or at the bar?
Well, personally, I'd rather go to the bar, but that's just my own thoughts. But I do, just to be serious, I do think that you need to be balanced. I think you have to have, and we outlined this in our retail playbook that we published last week. We do think you want to own some names that are going to be comeback players. In my view, that would be the off-price retailers. But I think to abandon some of the COVID winners, just because tougher compares, I think will be short-sighted. A lot of these businesses are going to be significantly better off today than they were 9 months ago. Take Home Depot. Their cash balance surged over the past few quarters. They went out recently and purchased Home Depot supply. A number of other retailers are going to buy back more stock. So I think a balanced approach next year is really the way to play it.
Then let's just end here on Walmart. I'm curious as to how they're looking then at their inventory over the next few quarters, particularly when we got the news today that Amazon is launching an online pharmacy. And I'm sure they didn't mention it, but I can't imagine that that's not worrying them in some capacity.
Yeah, I actually asked that question on the call, and they I think they feel comfortable about where their health and wellness business is at this point in time. I think they're still probably digesting the results on your question on inventory. I mean, their inventory was flat year over year relative to sales up 6%. So they're in very good position. And the bright spot in Walmart's results was really on the gross margin line. Their gross margins are really strong, and part of that's being fueled by better profitability on their digital business. So I think Walmart, which is flat now, should be up. I'm not sure why it's down. That was one of the best prints from Walmart in quite some time. I know the stock closed at a 52-week high yesterday, but the results this morning were really very strong.
All right, Chuck, really appreciate it. Thanks very much. Chuck Brum of Gordon Haskett joining us there. All right, coming up, we're going to take a look at the Fed composition and the implications on policy. Alan Blinder, Princeton University professor of economics and former Federal Reserve Vice Chairman, will give his thoughts on stimulus, what else the Fed can do, and who's in line to take the chair of the Fed, as well as Treasury Secretary in a new Biden administration. This is Bloomberg.
Our aim was from the beginning to have a portfolio of 6 to 7 potentially safe and effective vaccines. We've signed with AstraZeneca, we've signed with Sanofi and Johnson & Johnson. We will leave no stone unturned.
Let's check in on the Bloomberg First Word News now. I'm Ritika Gupta. America's effort to revive its virus-battered economy has put on pause or thrown into reverse. Across much of the country, new infections are soaring at the fastest pace since the earliest days of the pandemic. California has reimposed bans on many indoor businesses. Michigan has ordered a partial 3-week shutdown, and Oregon, Washington, and New Jersey have tightened restrictions. Former President Bill Clinton says it's clear that Joe Biden will work to strengthen ties with organizations such as NATO and the World Health Organization. He spoke at the Bloomberg New Economy Forum.
We shouldn't accept or assume that it's all going to be bad without working to make it better. We got to try to, we got to give the new administration a chance to articulate an approach and then try to achieve, in cooperation with Europe and the United States and the international bodies.
The former president also said that Xi Jinping's long-term reign has upended U.S.-China relations. He said the U.S. and its allies need to take a more coordinated approach with Beijing. Meanwhile, Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now, a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex?
Thanks so much, Ritika. Well, former Fed Chair Janet Yellen is said to be among those under consideration to be Joe Biden's Treasury Secretary. Speaking with Bloomberg's Stephanie Flanders at the Bloomberg New Economy Forum yesterday, the former Fed Chair didn't push back on those reports.
I have to ask you, would you like to be more closely involved in that as a Treasury Secretary for the new administration?
I don't have anything for you on that. I'm sorry.
You don't think you'd be a good Treasury Secretary? Could I ask you that? I could probably ask the rest of the panel that.
It's for other people to decide, I think.
She would be a great Treasury Secretary.
Great exchange. Joining us now, Alan Blinder, Princeton University professor of economics and public affairs and former Federal Reserve vice chairman. Professor, it's so great to talk to you on this. Do you agree? Would she make a great Treasury Secretary?
I think so, yeah. I mean, I have no idea if President-elect Biden is going to choose her. They're not telling me anything about that, but I agree that she's very well suited to the job. She'd do it very well if she gets it.
Do you think in that situation that we could see monetary policy and fiscal policy working more closely together? We're certainly seeing that here in the UK at the moment with the Treasury and the Bank of England.
Very, very much so. Now, there is a danger there. You don't want to get too close. There's a separation, which Janet Yellen knows better than anybody, a necessary separation between the executive branch or the legislative branch and the central bank. But in terms of close cooperation on things that are of common interest, like the Fed's liquidity facilities and many other things, it's hard to imagine a tighter relationship than Janet Yellen and Jay Powell, for example.
Well, fair point. And the other question is what it means for Lyle Brainerd, who is also reportedly in the running for U.S. Treasury Secretary. But either way, it looks like enhanced cooperation. Do you think something like that is enough to do things like extend all the Fed programs past December, things like definitely getting some kind of stimulus done?
Well, the stimulus done, that's in the hands of the Congress, but extending the liquidity facilities past December. Look, I don't see why Steve Mnuchin is hesitating on that for 1 millisecond, but apparently he is. But if there's a change at the Treasury to Janet Yellen, to Lyle Brainerd, and you could keep listing other candidates, I don't think there'll be any hesitation. It's borderline crazy to stop those things now.
Borderline crazy. Okay, why is that? What do you expect from the economy between now and January? We saw today with the retail sales number an indication perhaps that the COVID restrictions are starting to have an effect, and that is being done at a time when we don't have that stimulus that we did have earlier on in the year. How bad could those sorts of numbers get, do you think, between now and the end of the year?
We don't know, but they could get very bad if we don't have another package. I want to correct one thing you said. I don't think it's COVID restrictions that are doing it. It's the voluntary actions of people that don't want to get sick and die. People were afraid in March, and they're afraid again now. And that kind of thing can wear on consumer spending and the economy more broadly. To your question about borderline crazy, the Fed has been amazingly successful without putting much money at risk in backstopping the municipal bond market, the corporate bond market, and several other things without really putting much money on the line, but putting their pledge on the line that will be there if necessary. Why in the world would anybody dream about taking away that pledge now?
And you're really echoing what Vice Chair Rich Clarida said yesterday that the markets kind of glommed onto. He said the Federal Reserve is committed to using all of our available tools, not just the federal funds rate and forward guidance, but also large-scale asset purchases to achieve our dual mandate goal. JP Morgan kind of after this change, or right before this actually, changed their Fed call and sees more Fed bond buying come December by about $80 billion. A, do you think that that's going to make the difference without stimulus? And B, what does it do, I guess?
I think the answer to your question is a tiny difference. The Fed is grasping for straws now. It's shot almost, I won't say it's shot its entire wad, but it's shot most of its wad. It can do a little more. And what Rich Clarida mentioned is one of those little bit mores that it can do, buy more bonds than even that it's buying now. I think you have to be incredibly optimistic or trying to put on a brave face, which is what I'd be doing. I'd be doing what Clarida is doing if I was vice chairman of the Fed now, putting on a brave face. But realistically, it would be a positive for the economy, but a very small positive.
Alan, one of the things the Fed could do, now that it's no longer really supporting market function, is extend the duration of the bonds that it's buying. Do you think that is a logical next step?
Absolutely. I think those are the two. You've now hit the two most likely things the Fed will do if it feels it needs to do more. And that's tied up with whether there's a fiscal package. Buy more and buy longer. There's no really reason that the Fed, by historical standards, the Fed is buying out the yield curve. It usually is dealing with Treasury bills. But it could go a lot further than it is. And that would have some marginal positive effect on long-term interest rates. But look, the 10-year bond rate in recent months has been 0.7, 0.8, 0.9. I think right now it's about 0.9. You have to ask how much lower could it be pushed? The answer is somewhat lower. But if you believe, as I do, and as the Fed has said many times, it's not going for negative rates at the short end. It's not obvious that you could go very much lower on the long end, even by concentrating more purchases out there. Don't get me wrong, I think they should, but I don't think we should have high expectations of how much good that will do.
Today, we're going to see a procedural motion in the Senate to approve President Trump's Fed nominee, Judy Shelton. If this goes through, which is a question, do you think that this changes the Fed's calculus at all, changes how they're thinking about monetary policy?
Not much. If she gets on the Fed, which I hope she won't, Shelton will be one vote on the Federal Open Market Committee, and she won't take many people with her. She's the only one, really, that has the kind of beliefs that she has. But maybe a tiny bit in that the Fed might think, if we're going to do more, maybe we should do this before we have Judy Shelton voting. Maybe, but not a major effect. But if there is an effect, I think it would be in that way.
Just a kind of broad kind of thought on this. Do you think there's ever been a point? Do you think there is a point where the Fed has suffered from groupthink? And as a result of which, do you think a more diverse group of people may actually be a desirable outcome at this point?
I do think. I think there have been many times when the Fed suffered from groupthink. In fact, it looked that way to me when I joined the Fed in the mid-90s. I joined, and Janet Yellen, by the way, joined right after I did. We were the first Democrats to go over there in like a dozen years or something, and there was, I think, groupthink, and I think it is good to have diversity. Look, that's why we have staggered terms, and the idea is a president gets to make some appointments. But there's a long way between that and putting somebody from the economic equivalent of the Flat Earth Society on the board. I mean, those kinds of views are not going to be taken seriously. A serious conservative or a serious, more liberal voice on the committee might have some effect. And I think in any case, it will be salutary in terms of getting away from groupthink. But somebody that's way out in left field or way out in right field is just not going to be relevant to the debate. There may be more dissents. You could see someone like that dissenting all the time from the majority view, and the Fed would rather not have that, but it's not going to really influence the debate.
Something that also may come up under a Biden administration is regulation. Now, you were really focused on bank supervision and regulation and consumer and community affairs, derivative instruments when you were at the Fed.
Yes.
Do you expect more oversight of, say, big banks, regional, private equity, hedge funds, non-banks? What do you think?
Well, that was a long list. So let's start with the place where I don't think it will change, which is the big banks. The big banks have been under the Fed's supervisory umbrella for a long time now, with not much ambiguity since Dodd-Frank. Before Dodd-Frank, there was a lot of ambiguity about who was really the principal regulator of these giant institutions. There's no ambiguity now. It's the Fed now. It'll be the Fed under the Biden administration. Then you reeled off a bunch of other institutions ranging all the way to hedge funds, which are not regulated by anybody, basically. And it's conceivable that the Biden administration would like to extend the regulatory umbrella to embody some of these other institutions, depending on the details, but likely it'll need congressional authority to do that. And as we all know, if the Republican majority stays there with Mitch McConnell acting like a cement block, the prospects for doing that are pretty poor. So the question will be, what can you actually do with the regulatory authority that exists? And I don't mean to demean that. You can go a long way. We now have, leaving aside the Fed, which takes it much more seriously, a bunch of deregulatory regulators. And if you put in place people that believe that the financial system needs regulation under the same laws that exist now, I think it can make a very big difference.
Alan, just a very final quick question from me. We've just seen the NAHB home builder index come through at a record. Do you think the Fed can ever step away from supporting the housing market?
Ever is a long time. So I guess the way you phrase it, I'll say yes, but it's not on the near-term horizon. Look, the way the Fed supports the housing market is basically by keeping interest rates very low. And that's not going to end for quite a long time. And secondarily, by including MBS in its quantitative easing, which helps the MBS market enormously. And that in turn helps the mortgage market. The Fed's not stepping away from that for a while also for a number of reasons. But I think the principal one is, which a lot of people still don't understand, is the Federal Reserve Act gives the Fed a very limited menu of assets it could buy. The ECB's menu is much broader. The Bank of Japan's menu is far, far broader. The Fed is highly restricted in terms of what other than Treasury issues it can buy. But one of those things are the MBS of Fannie and Freddie. And as long as it needs to buy assets, it's going to want to keep buying them.
Alan, really appreciate your time today. Thank you very much indeed for sharing it with us. Alan Blinder, former Fed Vice Chair. Thank you very much. OK, let's now go to the New Economy Forum, the Bloomberg New Economy Forum. Bloomberg's Eric Schatzker is hosting a panel with Ray Dalio, the co-chairman and co-CIO of Bridgewater Associates, Anna Botin, executive chair of Santander, and Ann Richards, the CEO of Fidelity International. They're talking about what investments will look like in a post-crisis world. Let's listen in.
As we all know, news of major progress on vaccine development has lifted our hopes, and it's certainly lifted financial markets. But we all know that the experience of the coronavirus will be hard to shake. Panelists, what do you see as the most lasting effects of the pandemic for years to come? Anna, why don't you start us off?
Sure. So I think we've all learned a lot on a personal basis, also in our professional lives. And I think this is going to really, result in permanent consumer and companies' behavior. How exactly that's going to happen is not easy to predict right now. I'd say, first of all, there is a much faster digital, adoption. Just to give you an example, in the month of October, and this was the case in Argentina and in the UK, 80% of all our sales of financial products were online. The average for the group was 50%. So I think this is clearly one of the more important acceleration trends. And this is going to result in big changes across many industries, of course. Very importantly, across smaller companies. So companies that have traditionally been very physical, like restaurants and small retailers, have really accelerated the change online. Beyond that, I think it makes us all very conscious of the global trends. So at a much higher level, climate change, like the virus, affects all of us. And if we don't all change together, it's not going to work. So I think this is the other realization. On the one hand, very much an inward-looking, what happens in our community. At the other, what is happening to me in my health, in, again, trends like climate change are important to the rest of the world. And so I think these are some of the things that we'll be seeing. And of course, this is going to have a big impact on our economies and how we live and how society is governed. I think we need to make a big reflection, and I hope that we will do this together, private and public sector, about how this new world needs to be governed, from taxes to regulation to competition rules, because we are going to be deep into the digital economy, and we need to, change the way we operate.
Ray, your thoughts, the most lasting effects of the pandemic? I can't hear Ray. It appears we may have lost Ray's mic. Ray, if you can hear me, Ray, perhaps turn your mic back on the screen. We may have. I'll tell you what. While you work on that, Ray, let me turn this question to Ann Richards. Anna just gave us her sense of how things are going to change over the long run because of the pandemic. What do you think?
So I totally agree with what Anna said. I think there's three things that have meaningfully changed in the last 9 months. And the first is around the general macro environment. I mean, the situation that we have been in with the incredibly rapid monetary policy shift that we saw in March, April, the speed of the central banks, the extent to which, frankly, indebtedness has just, as a way of navigating through the trough, if you like, indebtedness has risen up. That debt burden is going to be with us for a very long time to come. And how we deal with that debt burden and the effects of that debt burden are going to absolutely drive, and the choices that we make around that debt burden are going to drive, I think, the next decade in terms of what the path of the economy is going to be. So I think that's the first thing, which is a really lasting change. I think the second is around the conversation around sustainable capitalism. And Anna touched on this. She talked about the climate. She talked about a new kind of governance model, if you like. I think it's really interesting that business is probably ahead of government and policymakers now on the issue of sustainable capitalism, perhaps because they've had a near-death experience. And perhaps because we've all looked into the abyss and suddenly realized that shocks, which might seem tail events, actually really can happen, like a pandemic. And maybe it's brought the reality of climate change a little closer to home on that. So I think that this business-led approach to sustainable capitalism is a real driver, and that's not going anywhere soon. And then the third thing, and I suspect that a lot of people watching this will understand what I'm saying, is that we've learned that the radical, that the unexpected, that the really innovative can be done far, far faster than any of us ever thought was possible. When we looked at rolling out Zoom, for example, across the business, we did it in more than 25 countries in less than 2 weeks. Now, as a normal project, that would have taken us probably 8 months in the normal way that you would do it. And yet, because we were put in a position that we had to do it, we did it with remarkable rapidity and actually with almost no problems or consequences in the way that we did it. So I think it's shown us that when we really need to, we can be much more radical and we can move much more quickly. So I think those are three of the things that have meaningfully changed as a result of everything that we've seen in 2020, and the effects will be long lasting.
Ray, we've heard from both Anne and Anna about this idea that the shock of the pandemic has awoken the world to the need for a more sustainable version of capitalism. This is something that you touched on well before the pandemic. I want to hear your thoughts on that point, and also more broadly, what kinds of long-lasting effects you think the pandemic will have.
I think that there were vulnerabilities that existed under the system, and the COVID is a stress test, and it'll go away. But there'll be some things that are broken for a long time, and then there's some things that are profoundly changed. I think, first of all, the financial gaps between entities is clear. The rich, the poor, those who have good income statements and good balance sheets, and those has been a defining characteristics. Some of those will be broken, and it has enormous political consequences. The left and the right will be, I think, in greater conflict. And so that issue has also been connected to the changes in money and credit that Ann was referring to. In other words, before that, interest rates hit zero, and there was not classic monetary policy. And also when there was QE, it didn't pass through to those who needed the money the most. What we now had was, we're in a new era in which there's going to be government borrowing money and directing that money more than the normal capital markets, and central banks buying money. And that is going to have a profound impact on the value of money, probably reserve currencies and so on. And then related to that is it's a defining moment in terms of the strong and the weak, which, for example, China has come out of this very well, and it's going to change the nature of capital flows, I think. So I think that those are the main. It'll have political and wealth implications that will be very important and will be clarified over the next, I think, 2 years.
All three of you have touched on the macro impact of the pandemic, and I'm delighted about that because I want to delve into that more deeply. But before we go there, I'm curious. Every company has been forced to adapt over the past 9, 10, 11 months, and many CEOs are pleasantly surprised by the results of that adaptation. Briefly from each of you, I'd like to know, what one change have you made because of the pandemic that will become a permanent part of the way that you do business? Anne?
Well, I suppose the most significant is that we've realized that we don't need people to be in the office all day, every day. And so we're moving to rolling out, we call it dynamic working, but we're moving to rolling out a much more flexible approach to who comes into the office, when they come into the office, what they come into the office to do. And we've learned that actually we can focus on the output rather than the input and get really, really good results. I mean, in some instances, we've seen operating data actually improve through this, which is just not what you would expect. So I think that's what I would highlight from us. It's the flexibility which we have, where and when and why do we come to work.
Ray, how about you at Bridgewater? Any one thing that you've done differently as a result that you think is going to stick?
Well, we do have the locations and the digital part of it, but I think I'm a global macro investor, all of the liquid markets in the world, basically. And to use this as an opportunity to about differentiation and diversification of our portfolios to make sure that those kinds of surprises and those kinds of differentiations are reflected in our portfolios.
And Anna, quickly from you as well, one thing that Santander is doing differently now that will stay, that will become a permanent part of the way it does business?
So it's a very important change in the way we manage the pandemic. We didn't have somebody to manage a health crisis, which has a huge impact on our business, which extends horizontally across the company from health to employee safety, technology, customers, public policy. So we organized in a different way. I appointed a business leader to be the head of COVID. He still is. He's the head of our wealth management division. And he created a very specialized group across the whole world. And I think this is a huge lesson and something we're going to repeat and do again. We don't need to be just organized the same way all the time. We can have a much more flexible, way of getting things done, much more effective. And this, I'm sure for many companies that are startups and smaller, is maybe what they do already. For us, it's been an eye-opener that we can manage the business in a different way and do it very effectively. Within 15 days, we had 130,000 people from Brazil to Poland to the US working from home. We were able to help communities to source health materials, and all of that with a very different organization from what is usual for us. So this is very important for us as a company.
The title of our panel posits, not unreasonably, I would say, that we've entered a new world order. And Anne, you already touched on it with debt burdens. Anna, you spoke about it in terms of the awareness of climate change and how there are similarities between that and the pandemic. And Ray, of course, you talked about how governments are going to have to finance themselves. I'd like to quote my colleagues, Tom Orlik and Bjorn Van Roy, because this is how they put this idea of a new order last week. They said, the center of economic gravity is shifting from west to east, from advanced economies to emerging markets, from free markets to state controls, and from established democracies to authoritarian and populist rulers. I want to know from all three of you what you think the new order will be. Are Tom and Bjorn right, or will things play out differently? Ray, this is your wheelhouse. As you look out into the next 5 years, maybe beyond that, give me your macro framework.
I think that this is a good summary. I think when I look at history, I've studied the rise and decline of reserve currencies over the last 500 years. And this is a moment of a change in the world order, very similar to that which happened prior to World War I, prior to World War II, an analogous period. There's large wealth gaps and income gaps and opportunity gaps that exist. There's no time that has been this large since the 1930s. At the same time, monetary and policy and debt policies in which when you have a zero interest rate, there needs to be the expansion of debt and that monetization of debt. That last time that happened like this to this grade was 1930 to 45 period. And the rising power of China, challenging an existing power in its competitions. The last time that existed was in the 1930s to 45 period. There are struggles, fights over wealth and political power within countries and then between countries. That confrontation, that issue about how to deal with that whether it's in a peaceful way or in a confrontational way within countries, like our political divide and our social divide that exists in the United States and in many countries, or between countries, such as the conflicts that exist between the United States world order and the Chinese rise, in which there's conflicts. There's a trade war, a technology war, a geopolitical war, and even a capital war now, and then there's military conflict. We, I believe, are coming into a more challenging environment because of the nature of how this happens over and over again through history in these cycles. So I believe that your summary at the beginning was apt.
And do you share Ray's view? Growing divide, more confrontation, a more challenging environment. Do you see things differently?
So look, I think that is a completely credible path and a completely credible set of, it is one route that we unquestionably could go down. But I think it's also worth focusing on where are the points of shared interest, where are the points of commonality. You know, China in itself has more than 1 billion people with 1 billion different views of what their future should look like, just like America, just like Europe. Everybody has their own view of where they expect to share and what share they feel they ought to get in a size of the pie. But if we can increase the size of the pie, it is better for everybody. So I think it is more constructive, and this is where I hope that we will get to focus on where there are common interests and get back to a more multilateral approach to trying to solve those interests. And climate change is dealing with the climate, dealing with the environment. That's an absolutely classic place where actually humanity has its shared interest, regardless of which side of the Pacific or which side of the Atlantic you're on. And yet we lost a little bit of that shared goal. So I think the opportunity for us now is to focus on where there is a common ground, where there is a common interest. But will be all too easy for us to slip into the scenario that Ray outlined, which is to focus on the differences. And I think that would be a really regressive step.
I want to so agree with Anne and say that I think that this is a defining moment of how we're going to be with each other, internally within countries and externally. But we're still going to have to face the problems of how do you create money and credit and how do you get it into the hands of those people who need it most. So I think that the summary is completely right, and I hope that we follow that better direction.
So, Anna, your thoughts on this idea of a macro framework as you look out into the future and you're making decisions about how to run your company, what are you anticipating?
So, I mean, Ray and Anne have, I think, said it all, and I agree with everything. I think the key is how do we manage the distributional impact of this crisis? I think that is the key, and it's true for regions, countries, sectors, and people. Because other than that, the structural trends we're seeing are the same as pre-pandemic. They're just accelerating and have accelerated at an exponential pace. So how do we deal with those most affected by the pandemic? Because this is really going to make things worse than they were before. The differences that have been alluded to. Monetary policy obviously benefits those that already have financial assets. So I go back to, we do need, I call it a new social contract. What is the new governance of governments and the world? And the key here is that we put fairness and a focus on adaptation and social resilience at the heart, because the economic terms have to be based on fair competition, fair taxation, and distribution efficiency. We need to really together build a more inclusive and sustainable recovery, the building back better idea that has been said many times. And I really believe we need to get public and private sector together. I mean, governments have done the best they could, but in most cases, they were not ready. They didn't have the governance, the leadership to actually deal with this in the same way we did. We've heard from Anne and other companies. We put together teams in 2 weeks. We had leadership where we didn't have it before. We had a plan, we executed. So as we think about the new world, and it is a new world that we are already in, working together, private and public sector is key. Otherwise, we're going to go down a very bumpy road. And I think there is a real risk of that happening because the digital economy is a very different world from what we had before, and it's accelerated. So again, putting fairness, social resilience at the heart, collaboration, to me, those are the key concepts as we build this new world.
Let me stay with you, Ana, because I'd like to understand a bit more about how you adapt to that environment that you and Ray and Anne have articulated. Santander has a big footprint, a big geographic footprint. If my colleagues Tom and Bjorn are right, and there's a pivot from developed markets to emerging markets, is that something that you chase? You don't have to chase it very hard because you're already in emerging markets, but I'm curious to know what kind of strategic impact or strategic adaptation you make to adjust to this new reality.
So look, I'm actually just back from my first trip since February to the United States. I was in Boston, New York, and I was in Brazil, in Sao Paulo. Santander today, 40% of our earnings come from Latin America, with only 13% of our loans. There's a huge potential for growth in the areas of emerging markets that we know well, and we have great talent. So we are going to adapt our strategy, and we announced this a few months ago. We are working along 3 lines. One is what we call the One Santander. We need to become much more efficient, especially in Europe. We need to manage as one entity, not 4 or 5 or 10 different countries. The second is around payments. We're building, again, we've been doing this for 4 or 5 years, but we're going to bring it all together. We just announced the acquisition of the Wirecard assets in Germany this morning, or last night. We're going to build around GetNet, a Brazilian company, which is one of the leaders in payments. And we're going to build around Open Bank, which is a fully native digital bank, and our consumer business in Europe. So what we're going to do is what our consumers, our customers are asking. They want to deal with us more online. I said it before, 50% across the group of all the products we sell in the month of October was sold online. So we need to rethink how we service consumers and how we also organize ourselves, taking the lessons we've learned during the pandemic. And this is true for all companies in all sectors.
And how about you, adapting to the new world order? Other companies in your industry have chosen to go down the consolidation route. And that may not be exclusively because of the pandemic. There are all kinds of other factors, let's say, or variables involved in that equation. But is that something? Is that how you adapt, or do you adapt differently?
And when we've been a company, I mean, we've made acquisitions from time to time, but our growth has largely been organic, and I doubt very much that will change. We see bolt-ons that we can bring into the business, but for us, the core of our investment proposition has very much been driven off of our own research base. And I think that is going to continue to be the case. I mean, we've actually had, in terms of flows and in terms of business performance, we've had a great year this year, which is not where we necessarily expected to be back in March. So we see that there is consolidation going around about us, consolidation in the asset management industry. You know, it's tough to get right. You can get it right, but it more go wrong than go right. So I think we prefer to stay on our own, with our own strategy and build that out organically and with patience, which is what we've always done. But we are lucky in that we have a very broad international footprint. We are present in, as I said, more than 25 countries around the world. So for us, the imperative and the need to fill in some of the gaps is maybe less strong than others in the industry, and we're happy to continue on our organic route.
Anna, same question to you. There's more consolidation in banking than we've seen in some time. What's driving it? Will it continue? Will Santander participate? Is that part of your adaptation strategy?
So we're much more likely to continue buying technology platforms or add-on acquisitions. We did eBury, a fintech in London last year. Actually, we closed this year. Card. We're investing in startups in Brazil across our footprint. We serve today 145 million customers worldwide, more than any bank in the Western Hemisphere. So this has huge potential for very significant organic value creation. And our vision is to be the best open financial services platform on the market. And what we want to make sure is that the structural changes that we have made, I described before, which is the One Santander, the global digital bank, and our payments platform, will help us drive greater and profitable, sustainable growth. So no, we're not about to participate in any, let's say, traditional bank consolidation. We don't believe that is the right thing for us at the moment.
Now, Ray, you touched on this idea of adaptation before. You talked about the need to diversify. You were speaking about the investments, I presume, that Bridgewater is making. Could you give us a little more on that idea? How does Bridgewater adapt to the new world order that you've been thinking about for a long time, I should add? Anybody who is familiar with your writing and your speaking knows that. So I presume that some of the things that you're doing have been in the works for a little while, but nevertheless, here we are, in November 2020, and it's a different place than we were 11 months ago.
To answer your question, there's a business answer to the question, how do we operate business-wise and also portfolio? I'd like to emphasize the portfolio because I think that's probably most relevant to other people. There's a period of, I think, great uncertainty and great risk. And so I think there are three words, diversification, liquidity, and then differentiation. We want to make sure that our investors are not just concentrated in some of the traditional markets. So diversification of how to do that well can reduce risk without reducing opportunity. And that means currency diversification, including the reserve currencies, how much exposure is to the reserve currencies, but it means currency diversification, asset class diversification, country diversification, and that should be the starting point of portfolios. In terms of liquidity, it allows you the flexibility to change as circumstances change. And differentiation is the most important consideration now. There are two different worlds. There are worlds that will be orderly and will prosper in this kind of an environment, and you could see it. And that differentiation versus other worlds and markets related to that, that will be bankrupt and disorderly. That kind of differentiation is important. As far as the business goes, we have the different location considerations and long relationships that we're building on.
Ray, I'm going to ask you to continue because you just said something that at the very least interested me, this idea of bankruptcy and disorderliness. Where do you see that?
Well, you could see it. It's reflected in the income statements and balance sheet. Every individual, every company, every country they're good. How well they are depends on how much their income is relative to their expenses and how much their assets are relative to their liabilities. So you can see radical differences in the financial consequences of that. Second, the ability, the proximity to those who are printing and distributing money. Are you a recipient of that? For example, a lot of the third world is not a recipient of that and is not in good financial situations. And then there's order, political and also social order. So when you could see it differentiated in the countries that are controlling the virus and behaving orderly and well together. So you could see those differentiations reflected in the market's behavior, and you can also see it reflected in the political and social conditions.
Well, we know that markets are discounting mechanisms, Ray. I don't need to tell you interest rates at zero, but I'll remind everybody that stocks keep rising to new records, and not just here in the United States, but globally. PE ratios haven't been this high since the dot-com era. The dollar, to your point about currencies, Ray, has slumped to a 2.5-year low. Do asset prices and valuations make sense given the economic fundamentals, some of which we've talked about here in this panel discussion, and for that matter, the policy outlook and what we can expect from a Biden administration? Ray, what do you think?
You know, when we look at interest rate markets, we look at the earnings yield. When we look at stocks and we look at PEs, they're basically yields. And the capacity of central banks to print money and buy financial assets has essentially led the bond market to go to multiples that are somewhere between 100 times. You know, you put a dollar out and you'll get your money back in 100 years. It's because of the nature of, so it's as a 100-time multiple. You have to compare stock multiples to bond multiples. And so the capacity of central banks to put liquidity into the system and to have that liquidity go to produce high multiples is very real. It also changes the economics of borrowing. In other words, if you can find something that makes anything more than a zero, or they're going to make money. So that encourages the leveraging and the changes. So the financial flows that we're seeing, the market behavior is reflective of that. In my opinion, don't own bonds and don't own cash because they're producing a lot of debt and producing a lot of money to fund it. And so that's changing the nature of capital flows. It's also changing how those flows go to China in terms of the comparison of that market, particularly as it opens up. So I think it's behaving sensibly, but don't use old multiples as reflections of the limitations of what's expensive.
Ann Richards, does that make sense to you? Throw out the old orthodoxy. The fact that we have zero interest rates is changing the way that you need to think about multiples and valuations on assets?
Of course it does. We've never been in a situation where, for this length of time, we have had effectively free money, or you know, it's completely shifted the relative valuation of assets and how you come up to an establishment of what a fair asset is. And I think when you look at the level of indebtedness that we've talked about, this ability to use the central bank balance sheet as a massive buffer to manipulate the price of that money, that experiment has taken us into far further reaches than we ever, and arguably successfully in many respects, than you ever imagined was possible. But there are consequences. The gaps that Ray mentioned earlier about, you know, the fairness gaps. And by the way, I would add one that he didn't mention, which is it's been very easy for large companies to re-equitize themselves. It's been much tougher for small companies to do the same thing. They have been left with proportionately higher levels of indebtedness. And I think that is a potential problem for the recovery, which we need to address. But essentially, when you've got this level of indebtedness, you've got a number of choices. You can grow your way out of it, you can inflate your way out of it, or you can default your way out of it. And there are choices in which route you follow down that. And this is where I think we come put all the way back to sustainable capitalism, because if we want to be successful and avoid the disorderly disintegration of bond markets. We have to think about how we use this free money to invest in job creation, in productive capacity, useful productivity improvements, which ultimately get us on to a positive path for the economy as a whole. And this is a choice. If we waste this opportunity, if we waste the free money, if it only goes into financial asset inflation, then we will have a very large reckoning down the line. So again, I think there is a choice to be had here, and I really hope we make the right choice here.
And there's going to be a new president in the White House on January the 20th. Does anything of what you've said, or perhaps what Ray sketched out as well, because you're broadly in agreement on many of those points, change under a Biden administration?
I think you will see an increased willingness to engage in a multilateral basis, which I think will be helpful in some of the issues that we're talking about. And I think the likelihood of a split Congress means that perhaps some of the more radical and larger fiscal packages which were talked about are perhaps a little less likely than we were. So I think that multilateral approach will be the single biggest change that we see, and perhaps the tone, obviously, of some of the communications. And I think we may see some interesting conversations around large tech and just what the roles and responsibilities of large tech are. They've been part of the solution this year, but also I think there is a sense that concentration of power gives them great leverage. And maybe we need to think about a better framework and a better multilateral framework for them to operate within.
Anna, quickly from you, zero interest rates may have been a boon to stock market investors. They're not the world's greatest things for bankers. Tell me how you're adapting to that reality, and maybe touch on a little bit of what Ann spoke to in terms of what changes we might look toward in the global dynamic under a Biden presidency.
Sure. Well, I think the first thing is that as far as not just Biden presidency, I think this is the case for Europe and countries that actually can do this, is that we should not withdraw support prematurely. It's like, closing your checkbook during a war or something like this. So we need to continue with government support for the small and medium-sized companies and those that have lost jobs and so on. So this is super important. In terms of the U.S., I think the U.S., like the world, has a complex situation, and I think we need to come together and work together to grow out of this in the right way. And this is really the main task all of us in the private and public sectors have ahead of us. For banks in particular, the low interest rate environment obviously is not ideal, but I think it's also a huge opportunity to change and reinvent ourselves like we are doing. Ray mentioned something hugely important, how efficient you are. We continue to have a 47% cost income. This is the best defense. Growth, growing the top line, and being very efficient. Same thing for governments, and do that in a sustainable way.
Anna, Ann, Ray, I'd like to thank all three of you. Great conversation, and great to see all of you.
Thank you.
All right, Eric, thank you so much. And next up is a conversation with Christine Lagarde, president of the European Central Bank, moderated by Francine Lacroix, anchor of Bloomberg Television.
What a great pleasure to be here with Christine Lagarde, the president of the European Central Bank, and welcome, President, to the New Economy Forum. Bloomberg. I have to start where everyone is talking about the vaccine. How will it actually change your forecast, and how will it change this economy if we do get a working vaccine early next year?
Well, it's lovely to see you, Francine, and to participate. To your question, I'm not sure that it's going to be a major game changer for our forecast, simply because what we had anticipated in our baseline was that at some stage in the first half of 2021, there would be a vaccine and that it would be rolled out in the course of 2021. So it might be a little bit accelerated, given the news that we're receiving from the various horizons, Germany, US. But I don't think that is going to be a game changer, so to speak. I think that our forecast is being revisited almost as we speak, and we will be releasing on the 10th of December. So I don't want to anticipate what the outcome will be. But, we've seen before we had this great news about vaccines, we had some pretty negative news concerning the second wave that really came about certainly earlier than anything we had anticipated. And together with that second wave, we have also that list of containment measures and lockdown measures that have affected one country after the other in the euro area. So we had a combination of those sort of developments that affected negatively the situation, and that also has an impact on the outlook.
So what kind of economy do you see for Europe and the world because of the extra restrictions? Is it, a double dip? Is it something that is so uncertain at the moment because even if we get a vaccine, we don't exactly know what shape it will take or how consumers will behave?
I don't want to downplay the very good news that the vaccines were, but I think that, as a central bank, we have to be mindful of not just the short term and the news impact. We have to be mindful of the overall situation. And in that vein, I think that the second wave that we saw presents risks. The first risk that I would think of is the fact that consumers, investors, employers do not regard the pandemic as a one-off, this V-shape that we all aspired to, but as something that will recur over the course of time, and as a result would lead them to completely change their behavior. In other words, how about if they start saving again for precautionary purposes? How about if they continue to freeze and hold their investment plans because of the uncertainty generated by this situation? And the second risk that I see is the potential real/financial spillover, which we have managed to avoid so far. So in other words, we have not had the financial sector amplifying the downside that has weighed on the real economy. And we need to really stay clear of that because that would be an aggravating factor.
What surprised you the most in the economy? In Europe, but also worldwide, given the pandemic? Is it wages? Is it productivity? Is it how quickly people actually started working again when some of these lockdowns were lifted?
What surprised me most from this part of the world where I have relocated is, how in the face of this massive exogenous symmetric shock, all European players upped their game. And I think that we were first out of the gate, putting together a very large package in the first half of March. And we were soon followed by the European Commission, the decision to apply the escape clause, the decision to remove the state aid restrictions, the decision then to put on the table a massive package that was agreed in July. That surprised me because I had gone through a lot of procrastination and laborious process back 10 years ago. And the speed at which we moved certainly surprised me. And that was a strong encouragement in working together, which we did.
President Lagarde, you've been pretty blunt about using asset purchases, but also long-term loans. And this would be to provide stimulus in December. Which is your preferred tool?
Back in March, we decided to actually use two key tools. One that was specially designed for the exceptional circumstances that started hitting us, and that was the Pandemic Emergency Purchase Program. And the second one, which was not as innovative because there had been longer-term refinancing operations, but certainly we changed the terms. We focused particularly on making sure that the credit channels would stay open and would continue to flow credit to the economy. So we had those two tools that were intended, first of all, to make sure that we would stabilize financing and that we would make sure that credit was stable. And the second, which was really intended to put liquidity and to make sure that it was largely available for the entrepreneurs, for the households, and that would sustain the economy despite the heavy shock. So those were the key tools, added with relaxation on the collateral front in order to have an enlarged pool of collateral to draw from. Those tools were extremely helpful and came on the back of an existing situation, which all you listeners, I'm sure, know better. Now, clearly, going forward, as we have indicated after the last Monetary Policy Governing Council, we will be prepared to recalibrate in order to face the situation and the second wave. And I have indicated last week that just as PEP and TLTROs, which are the two tools that I have just described, had been efficient in mid-March and then later on in June when we recalibrated PEP and increased its volume and extended its maturity, that those tools would be certainly regarded as essential, but that everything would be debated and this recalibration and this dynamic recalibration would be discussed in the Governing Council.
So, President, given what you just said and also your speeches in the past, because the duration of the support is so important, does it, mean, is it your way of signaling basically that there could be stimulus extended for longer than the market currently expects?
Faustin, I think what is really important is that we make sure that the financing conditions are stable, are conducive to economic recovery as it comes, and that economic operators not only know that the level of financing is going to be there, but that it will be available for a period of time that will last long enough to actually cover the period during which the pandemic and the various waves will affect the economy. And as we are likely to foresee that second wave affecting the economy well into 2021, we will be looking at all these options, which have to do with levels, which have to do with duration, and which will take into account the specific benefits of the tools that we have and that we have used to good effect under the exceptional circumstances that we faced in March and that we are still facing today.
Last week, you gave a pretty powerful speech about coordination between monetary policy and fiscal policy. How confident are you that the message was received and actually a lot more can be done?
I think what has really been extraordinary during that crisis since March is how fiscal actually operated fast and big and focused. And I think what is remarkable is that the first package of 540 billion was rapidly agreed and has already been rolled out. And I'm here referring to the SURE pillar of that first set of supports that were agreed by the European Council, and how this additional one, the Next Generation EU, which combines, clearly the MFF for a period of years, and then the Recovery and Resilience Fund that will also be effective for a period of time, how that actually was combined together with the monetary support that our monetary policy provided. And it's not a question of, one leading over the other or who was first off the gate, but it's a question of, how we were capable of supporting on the monetary front and how fiscal was able to give a very strong message. And the joint borrowing is a clear, strong message that Europe is together on that. And that the fiscal arm can actually operate in a much more targeted and much more efficient way in that regard, given that the recovery was anything but solid, consistent, and even. It was uneven, it was fragmented, it was incomplete. And the fiscal arm in that regard is clearly operating to better effect than the monetary arm, which has to be around and supportive, though.
Madame Lagarde, you've been in charge for just over a year, and in that we've had a pandemic. I mean, we've had quite a lot going on. What surprised you the most about the European economy or European institutions trying to come together to actually find a solution?
There are certain things that didn't change. I would say the long nights to a degree, the laborious process that it takes. But what surprised me was, nonetheless, the efficiency that was developed amongst 27 member states with 27 sovereignty, and this sort of understanding that we had to face the situation all together. There were some, hiccups in the early days, but frankly, that was overcome on all fronts. And I think that the sort of coming together of Europe at that point in time was, in my view, exceptional.
Does climate reporting for companies actually be mandatory?
Sorry, I missed the beginning of what you said.
So I was going to ask about climate change. I know you've been one of the biggest proponents of sustainability and trying to, get companies to do better. But does disclosure have to be mandatory if we're going to see real change?
This is a personal position, not the ECB, but I think disclosure should indeed be mandatory. And I'm very, very pleased to see how progress is being made in terms of reporting requirements, in terms of harmonization of principles, the way in which the IFRS is coming on board, the way in which the accounting firms are moving along, and the NGFS, which is this network for the greening of finance, which is a club of central banks in many ways, is also largely involved in that respect. And I'm really pleased that the chair of that network is actually going to join the executive board of the ECB as early as January 1st. So it will certainly reinforce, our capacity to analyze and to mobilize us to see where, with our objective of price stability, we can actually include the climate change imperatives in both how we measure price and inflation, how we define the room that we have, depending on where the natural interest rate is moving as a result of climate change, and how we can better analyze the situation as a result of the climate change impact.
Do you think that climate change, yeah, but actually it's being done at quite a rapid pace. Is this the good thing that comes out of the COVID pandemic, that actually a lot more has been done on green sustainability?
I think in many ways the COVID-19 has accelerated trends that were there, that were latent or that were slow moving. And certainly the momentum about climate change, the impact it has, the imperative to participate in whichever capacity and within the remit of our respective mandates, that has been accelerated. I have no doubt about it. And in a way, that's a blessing in disguise.
Do you think that the mandate for central banks to only focus on inflation is now too narrow, given everything that's happening around us?
Well, our mandate here at the ECB is not inflation, it's price stability. And I think that we have to be smart about the components that go into price stability and how we define inflation, how we analyze the situation, how we determine the room that we have to maneuver. So all of that requires that we have a larger horizon than simply looking at harmonized index consumer prices. Clearly, that could be a measurement. That might be the measurement. It's something that we will be debating as part of our strategy review. But price stability comprises a lot more than just that. And I hope we can explore all that as part of our strategy review in the weeks to come.
What's your central expectation for 2021? Are things going to get better? Maybe multilateralism is back, maybe U.S.-China, the relations get a little bit better, or is there a danger of a second wave getting bigger, a third wave? It seems that it's very binary at the moment. How do you view the world?
If I would suspect that we will have a little less uncertainty than what we had in 2020. I would hope that progress, technology, biotechnologies, discoveries are going to help going forward. But I still believe that 2021 is going to be a difficult, certainly first half of the year, and that we will not have caught up with where we were pre-pandemic before the end of the year.
Christine Lagarde, thank you so much for joining us today. That was, of course, the president of the European Central Bank.
As Francine says, ECB President Christine Lagarde in conversation with Bloomberg's Francine Lacroix at the Bloomberg New Economy Forum. Now, you can continue to follow those panels. They're taking place throughout the day. You can go to live, go on your terminal. You'll also find that these panels are streaming on Bloomberg.com and neweconomyforum.com. Let's pick apart what Christine Lagarde just had to say. A bunch of things jumping out to me. The first one is that the vaccine not a major game changer for ECB forecasts. ECB forecasts are really quite gloomy at the moment. The ECB is prepared to recalibrate measures. PEP and TLTROs have been an efficient way of providing support. Joining us now to deal with all of this, Stephen King, HSBC Senior Economic Advisor. Stephen, nice to talk to you. Look, over the last few days, the financial markets have completely repriced on the back of first the Pfizer news and then the Moderna news. Christine Lagarde says that the vaccine is not a major game changer for ECB forecasts. Can both of those two things be right?
Just about, I think. I think what Christine Lagarde is getting at is that the forecasts that they have for next year imply a quarter-by-quarter recovery during the course of next year. And if that's the case, then they've already effectively second-guessed the idea of a vaccine coming through. And I think it's important to remember that most of the forecasts, whether from the ECB, from other international bodies, or from the sort of private sector consensus, most of them were saying there was going to be a sort of V-shaped recovery going through into next year. And the reality of lockdowns is that some of those Vs have turned into Ws. And I think there's now a sort of general admission that one should be a little more cautious about the near-term economic outlook. But having said that, on the assumption that we have an effective vaccine, on the assumption that the vaccine is able to be logistically sort of spread out to as many people as possible and therefore becomes effective in a kind of herd immunity sense, then one could imagine that, yes, during the course of next year, things will get better. But on the other hand, it's also worth stressing that the levels of activity, even at the end of next year, relative to what would have been the case in the absence of the pandemic, are going to be a lot more depressed. So if you think about this as sort of standard output gap analysis, not saying it's the best way of thinking about it, but one way to think about it is say, well, actually, we're still a long way short of where we'd like to be, and therefore the case for continued stimulus and support at this stage is very, very high.
So does that include, say, PEP, and is that enough? I feel like we've seen Christine Lagarde as well as other ECB officials and the chief economist overnight, Philip Lane, talking that program up. I mean, PEP, TLTRO, she mentioned that as well, being efficient, providing support. Is that going to do it for the ECB?
Well, the ECB, of course, is limited in what it can really do. And I think you go back to Lagarde's speech from last week, where she was talking about the importance of fiscal as well as monetary support. I think, in all honesty, most central bankers now, even if they don't necessarily admit it publicly, recognize that there are limits to what monetary policy can achieve. Once you're into the arena of TLTROs, QE of one sort or another, you're into experimental policies where perhaps there are distorting effects that may not work quite so well. I think it's particularly true when you get into the realms of, say, negative interest rates. And the reality is that the most obvious players to provide support at the moment are not monetary authorities. They really are fiscal authorities. We're talking here about massive, if you like, pent-up savings, excess savings from household sectors, from the corporate sectors around the world. That pent-up saving has created funds that governments can borrow very, very cheaply at this stage. And therefore, frankly, there's room for continued fiscal expansion, notwithstanding the fact that government debt levels already are very high by recent standards. So I think the reality is not so much what the monetary authorities can do, but rather whether they should be signaling that there's a limit to what they can achieve, and that actually some of the heavy lifting has to come from fiscal policy instead.
At what point why are we there now? As you say, we're entering a winter that is going to be very, very dark. Clearly, ECB policy is aimed, as you say, at getting BTP yields lower, bonos lower, assisting economies like Spain and Italy to be able to deliver fiscal support. At what point do you think that the ECB is going to turn around and have that conversation with those governments Because that's a really big moment. And I'm wondering how far away it is, because as you say, debt levels are starting to get high. All it's going to take is one political accident in Europe with these kinds of debt levels. Say Italian politics takes a turn for the worse. Say Spanish politics takes a turn for the worse. Do you think the ECB is really brave enough at this point to step forward and deliver that kind of commentary?
Well, it depends on how the commentary is delivered and what the ECB promises by way of a backstop. I think if there's an agreement that fiscal policy should be used in a more aggressive way, then actually one role that the ECB could potentially play is to try to stabilize bond markets in the event that one of them, basically blew up a bit. Of course, we saw this already during the Eurozone crisis, that eventually it was resolved partly because of the ECB providing promises that hadn't been there previously and a level of confidence that hadn't been there previously with regard to the liquidity of these bond markets. So I think it has been done before, and it may have to be done again. Now, of course, that means that the bond vigilantes, what we used to talk about many years ago, are effectively dead and buried, because the purchaser of last resort in these circumstances is effectively the central bank. And bond spreads won't necessarily widen out in the way they might have seen 5-10 years ago, because effectively the ECB is there to provide that support. But I do think that there is now a strong sense, again, not just in the Eurozone, but also in the UK and the US and elsewhere, that it's fiscal policy that has to do the heavy lifting.
So with that in mind, what economy recovers best? Is it UK? Is it Europe, or economy in Europe? Is it the US? How do we know?
Well, if I were an epidemiologist, I might make a forecast, but I'd also admit as an epidemiologist that I wouldn't rely on my forecast too much. What we do know so far is that the costs of the COVID crisis economically have already varied quite a lot from country to country. So if you look at the European countries and where they are today compared with where they were at the end of 2019, Germany and France, Italy aren't looking too bad. I mean, I'm putting this into sort of a broader context. They look terrible, but not as bad as others. Spain and the UK look particularly poor by European standards, and also Spain and the UK look poor compared with both the US and, of course, much of Asia. I mean, if you're looking at sort of who's come out of the pandemic so well so far, the answer, frankly, is the countries that have had the best track and trace systems, the best ways of trying to limit the spread of the virus, and that mostly is in Asia. It's China, it's Japan, it's South Korea. They've all had a pretty good experience compared with others, and actually it's been the sort of freedom-loving West, the US and Europe, which have found it more difficult to suppress the virus in recent months.
In terms of what happens next year, say we end up in a situation where the ECB does deliver more money, and the Bank of England's already doing it. The Fed's likely to do it as well. We're going to hear from the Fed a little bit later on. Does that money find its way to the right parts of the economy? How do these central banks ensure that the policy actions they're taking actually deliver for the people that can use the resources best? Because if you look at Europe, there's over 3 trillion at the moment in the banking system that is not being used. And I wonder how the ECB delivers that.
Well, this is one of the limitations of monetary policy, frankly. And this was discovered in Japan long before any problems in either Europe or the US. You can certainly fill the banking system with money. There's no difficulty in doing that. It's much more difficult to make sure that the money gets out of the banking system into the broader economy. Now, one reason for that might be that the banks themselves are worried about rising non-performing loans during a time of difficulty, as with COVID. And another possibility is that you end up with a loss of demand in terms of the people willing to borrow.
Stephen, we got to leave it there. Stephen of HSBC. This is Bloomberg.
Every era presents its own unique set of challenges and opportunities. Trade CME Group futures with Interactive Brokers at low cost and seize the moment. Start investing today at interactivebrokers.com.hk.
This new law that came down from China's National People's Congress Committee ended up leading to the disqualification of 4 pro-democracy lawmakers.
This is probably the very final and complete crackdown.
I hope you understand it is not anything new at all. This was supposed to happen.
Stocks wrapping up the day here in Europe. We're nearly done. To be honest, compared with the recent sessions, we're seeing quite a quiet one today. We're bouncing back a little bit. Volume relatively muted, except for the FTSE 100. I'll come on to that in just a moment. The Stock 600 down by around 0.2%, trading 388, spot 94. Most of the morning, actually, not really very much happening. We dropped sort of mid-session and went sideways. The retail sales number out of the States, one of the catalysts for the kind of the mid-session lull that we've seen. Nevertheless, a sideways session. Certainly a pause compared with the frenetic activity we saw yesterday and the previous Monday as well. So the FTSE 100 underperforming today, but we are seeing a more positive pound. I'll show you that in just a moment. We're down by around 0.9%, but volume actually fairly strong into the FTSE 100. If you take a look at the fund managers survey out of Bank of America earlier on, suggesting actually this is probably the most unloved developed market out there at the moment. Though Schroders out with a very positive call. I think it was Schroders out with quite a positive call earlier on in terms of this being a real opportunity potentially at some point to put money to work. The FTSE 100, as I say, underperforming the markets on the continent. Well, the DAX absolutely flat. The Madrid market, which has been a big beneficiary of the virus trade, the vaccine trade, the antithesis of the virus trade, just coming down by around 0.6% today. The bank's firmly in focus in that area. The pound is certainly something we want to be talking about today. Picking up, as you could see, on the cable rate, we're trading 132.55. We're up by around 0.4%. One of the reasons for that, more positive noises coming around the Brexit story. We are now anticipating maybe not news this week, but potentially news next week in terms of getting a deal done. And certainly the mood music seems to be improving and the market definitely responding to that. You basically get a pound up, FTSE down kind of trade, which has become kind of almost mechanical since Brexit took place. Imperial Brands talking about returning to profitability. That stock up very strongly on the back of that, 7.38% to the good. One of the prime drivers at the upside of the FTSE 100. Sabadell, we talked about it yesterday, potentially a BVA target. BVA negative today, but Sabadell continuing to stay higher. It was interesting to hear Anna Botin talking a moment ago about the fact that she doesn't see M&A as being a route forward for her bank, but certainly an organic story there. But this kind of mad rush to consolidate in Spain certainly seems to be carrying on and carrying on fairly aggressively. I've just brought up IAG here today. Again, one of those beneficial stocks of the vaccine news of late. The airline sector not really feeling it today here in Europe, just giving back some of those gains, not by much, down by 2.61. That stock up kind of circa 60-odd% over the last few days. But certainly the airline sector here in the UK firmly in focus today, Alex.
All right, let's stay with airlines for a second, Guy. You got EasyJet shares also falling. Britain's biggest discount carrier posting a pre-tax loss of $1.1 billion for the whole year through September. It is the company's first ever annual loss. So earlier today, Bloomberg's Anna Edwards asked EasyJet's CEO, Johan Lundgren, about current passenger demand.
There's very little flying going on across Europe, in its totality. EasyJet, we're predicting to not fly more than 20% of the planned capacity for the quarter that we're in. But I also think it's fair to say that it's definitely a underlying strong demand for travel. We saw that when the Canaries was, for an example, moved from the quarantine list, the bookings went up with close to 900%. And as long and for every day that these travel restrictions are in place, it actually increases the pent-up demand there. And of course, the news of the vaccine is also a very helpful message because it will ultimately give customers, more confidence to make future travel plans.
The bank, HSBC, analysts there have recently said that November could be as bad as it gets for the European aviation sector. Is that your working assumption as well, Johan?
Well, I think it's fair to say that, we have taken a number of steps throughout this pandemic to put us in a good position. We've been reducing the costs. We got access to liquidity. And of course, now we're seeing more of the good news coming out of it in terms of the vaccine, but also then, further development on how the quarantine can be more effective with perhaps less days that you would need to quarantine coming into countries. We see developments also in testing. And once again, just the announcement of the vaccine, the news of that, we saw an increase in bookings quite significantly. So it shows that the underlying demand is really, really there. And hopefully we can see a strong recovery coming very soon. I think it's fair to say that nobody knows exactly when it's going to happen. But what we do know is that the recovery will be strong when it comes, because ultimately people genuinely underlying want to fly and they want to travel.
How much flying do you want to do around Christmas, though, Johan? Is winter a sort of a lost cause for you, or are you still optimistic you can see an uptick in visiting friends and family, VFR traffic over that period?
Well, we know that customers, would like to travel and would like to make arrangements also for the Christmas and the New Year, and as you said, to visit friends and family. But it all comes back to what the travel restrictions will be. And the travel restrictions, as you know, is a consequence also about, how the infection rates are developing. But hopefully, if we are getting some testing in place, and if we can see also a refinement of the travel restrictions and its quarantine, we can also see that there might be an uplift as soon as Christmas and New Year.
EasyJet CEO Johan Lundgren talking to Anna a little bit earlier on, right here on Bloomberg. Let's wrap things up here in Europe. We are just through the auction process. A little bit of a tick higher during the auction, I've just noticed coming through. So we're off session lows. The FTSE 100, though, still down by 0.9%. Interestingly enough, it was AstraZeneca and GlaxoSmithKline that really did, actually, from a points point of view, much of the damage. HSBC also dragging the market down as well. But certainly the healthcare stocks under a little bit of pressure in the London market today. We'll come back and talk more about those in just a moment. We'll continue the analysis of what happened here in Europe at the top of the hour with the Cable Show. John Ferro and I will take you through that hour. We're live on DAB Digital Radio in the London area. This is Bloomberg.
It came in better than expected, not only in terms of job creation, but also a sharp fall in the unemployment rate consistent with higher labor force participation. That's really good news.
Overall, the gain was solid, but even while this is a very robust pace of job gains, it's a lot slower than it has been in the summer months.
Great that we saw the job gains we did, but they still are diminished from what they were, of course, back in April and May. And the scarring, the sort of wounds that were created by COVID are beginning to fester.
I would caution people to look at the top line number because I don't think it tells the entire story. Employment relative to population is still well below where we were pre-crisis, and that's because I think that we're going to have some lasting damage.
Depending on what you look at, jobs creation or the unemployment rate, you have different views as to whether the improvement in the labor force is keeping up or slowing down.
So how many times a day do people ask you when your vaccine is going to be available?
Yes, well, that's definitely a very regular question, whether it's from employees, customers, media, or my mother.
Real downside over the next 2 quarters is, does the resurgence get so bad it forces lockdowns because of overwhelmed healthcare systems throughout the country? That's what we're watching.
Time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. US senators are challenging the CEOs of Twitter and Facebook today. They renewed their accusations that Jack Dorsey and Mark Zuckerberg are failing in their roles as moderators of online speech. And the lawmakers called for changes to legal protections for users' posts. Shares of Tesla are soaring today. The electric car maker will join the S&P 500 next month as its largest ever new member. Before today, Tesla's shares had risen almost 5-fold this year, giving the company a market value of almost $390 billion. And Amazon is making its biggest push into selling prescription drugs yet. The world's largest online retailer is launching a digital pharmacy. Shoppers can pay using their health insurance, and Prime members who don't use their insurance are eligible for discounts on the Amazon site, or at about 50,000 pharmacies. And that's your latest Bloomberg Business Flash. Alex?
All right, thanks so much, Ritika. So let's get some more take here on Amazon's move to sell prescription drugs and the latest vaccine news. Joining us, Drew Armstrong, Bloomberg News senior editor for healthcare. So we're looking at a board where you have the drugstores getting just beaten up. I mean, CVS is down 8%, Walgreens down almost 9%, Rite Aid's also down. How much of a bite does this take out of these stores, and how successful can Amazon be?
You know, I think what's going on here is a move that has been telegraphed for years now by Amazon, but finally they're going ahead and doing it. You know, this was set up by the PillPack acquisition, which brought them pharmacy licenses in all 50 states, I believe. And now they're going directly after that. And they're doing it at a time when we're in the middle of a pandemic. People are ordering all their stuff online. We have rising COVID cases, one excuse after another for people not to go shopping outside of their house. So, I think it's this combination of long telegraph move happening probably at the worst possible time if you're a brick and mortar retailer, though, a lot of these stores do online and delivery for pharmacy. And, using the kind of giant Amazon leverage that everybody was scared of forever, but it's now finally happening.
Where does this ultimately take them? Does it just take them into pharmacies, or does it take them further?
It's a really good question. The big thing that is unanswered here is this Amazon taking a bite on the edge of the healthcare industry, or is it a larger entry where you begin to work your way up the chain? My estimate of this sure feels like it's the first, not the second. Remember, Amazon had already made this effort with Berkshire Hathaway and JP Morgan through Haven to try and kind of change around healthcare and do things with benefits. And that seems like it's really either stalled or on hold or kind of abandoned. So this really does feel more like a retail play that's firmly within their wheelhouse and going after, one more part of the corner drugstore after doing lots and lots of other parts of the corner drugstore and brick and mortar retail, rather than a kind of wholesale entry into the healthcare space.
All right, Drew, before we let you go, I just want to get your take on where we are with the vaccine news. Moderna was the news yesterday. Stocks kind of priced it all in kind of before it didn't get that bounce. Where are we here? New York positivity rate is still okay. Schools can still open, but much of the other parts of the country in lockdown.
Yeah, the news, I was making some notes around what was happening around the country. I mean, California hit this emergency break with new restrictions. Kentucky's probably announcing new restrictions tomorrow. New Jersey just put down indoor dining limits. Detroit's closing the casinos. Iowa's doing masks. North Dakota, 1 out of every 2,000 people in that state is in the hospital right now with COVID. We've got 10,000 cases a day in Illinois and Wisconsin. Hospitalization records around the U.S. Things are not great right there, not great right now around the country. Just about anywhere you look heading into a holiday season, that is probably only going to see continued acceleration of these cases.
Yeah, I think it'd be fascinating to see what this number looks like 2 weeks after Thanksgiving. Drew, thank you very much indeed. Bloomberg's Drew Armstrong. Now, as of today, there are 40 COVID-19 vaccines in clinical testing. That's according to a tracker of the Milken Institute. Moderna's vaccine is one of the two showing the most promise at this stage. We spoke to Stefan Bancel yesterday after his company unveiled his testing results.
But what is very important with today's news is we can now, for up to 30 days, have a vaccine stored in a regular fridge at 2 to 8 Celsius, like you do insulin. And as you know, every pharmacy, doctor's office, hospital has that capability. So we think it's a very important game changer. The other piece too, to keep in mind is our vaccine does not require dilution.
OK, so let's carry on the conversation, talk about how this vaccine story is affecting the whole healthcare story. Emily Field, Barclays Head of European Pharmaceutical Analysis, joining us now to give us her take. Emily, as you look across the stocks that you cover, which of these companies are going to come out as winners from COVID-19 and which of them are going to come out as losers from COVID-19?
Yeah, I would say that it's thinking about the vaccine itself. We're not really factoring any vaccine profits into any of our forecasts. The lead player in vaccines amongst our coverages is AstraZeneca, but we are not forecasting any revenues or profits at this time from our model. I mean, I would say the vaccine coming out of COVID, that it's really good for the whole industry because I think that whilst the entire space was pretty much able to maintain 2020 guidances, which were all issued before the advent of the pandemic in the US and Europe, particularly in third quarter, we did see an impact on new patient starts kind of across the space, which hurts companies that are launching new drugs. So I think that while we think of healthcare as a somewhat defensive industry, and that is true, I think that 2021 will be a better year for earnings for these companies after the vaccines are rolled out.
So, Emily, help me understand how the vaccine, though, does play into it. I mean, on the one hand, you could think the stock would get a boost just from sentiment if one of their vaccines is successful. On the flip side, are these companies going to make any money? I mean, they've devoted so much time, energy, and research into this. Do they make money on these vaccines?
Yeah, Astra has been quite vocal saying that they will not make a profit from the vaccine in 2020. Now, there will be very little of the vaccine available, given that we have not yet gone into approvals and production. And they have also said that they will not make a profit during the pandemic. I think the expectation is that it will be somewhat on sold on a basis to essentially cover costs. I think that what could be beneficial to the industry is that in devoting so much time, energy, effort, and resources that it could buy the industry perhaps some political capital, particularly in the United States, where while it does appear that a split government could lift a little bit of pressure on potential for drug pricing legislation, that is still something, a looming structural threat that investors are concerned about, and particularly as it relates to the U.S.
Talking to the Moderna CEO yesterday, and this isn't a stock you cover, so I'm not going to ask you directly about it, but I'm interested in the derivative. He was talking about the fact that the work they're doing on the messenger ribonucleic acid product that they're producing for COVID, that's accelerating some of their other products as well. Is this true in other vaccines? Like the Astra vaccine is a much more traditional one. What GSK is doing in terms of the catalysts is also much more of a traditional story. Is Moderna different to all those other stocks? Are these stocks going to get the same catalytic effect in other parts of their business than maybe Moderna is?
Yeah, I would say that while different parts of our coverage, such as Astra, Glaxo, Sanofi, are involved in vaccines as part of their, well, not so much Astra, as part of their base businesses, these are such larger, broader, diversified companies. And they are, for the most part, not involved in this mRNA technology. And what I think would be so remarkable about the success of these first mRNA vaccines is that it's almost like a platform technology such that it's very adaptable to new and novel viruses. So if the COVID vaccine is sort of the first proof of concept that these are successful platforms, I think that that would be a benefit to those who are directly involved in that technology, as it would sort of indicate that if we do get into other pandemic situations down the road, that they would likely be able to develop vaccines at a very rapid clip, given the adaptability of this technology.
That's such a good point. And the Moderna CEO said just that. This is their fifth time around doing it. They can adapt it much more quickly, particularly if there's a mutation. For the companies that you do cover, how much longer are they going to be spending on the vaccine before they go back and put a lot more money into other stuff?
Yeah, I mean, so Astra's kind of the last of the lead three candidates that we're waiting for data on. They should have data out by the end of the year. Theirs actually will be able to be stored at standard storage between 2 and 8 degrees Celsius. So it doesn't look like they will have to put in additional resources that some of the other vaccine manufacturers may have to make the vaccine more convenient. I would say that I think that for the most part, the real large part of the investment has kind of already been laid out, because I think that there's been so much learning from these initial efforts that it's going to be, and as you mentioned at the start of this, that there's 40 vaccines in development, that will eventually be a very multiplayer market and spread amongst a number of players. And I think that with each iteration, the second wave will have the Johnson & Johnson vaccine, which will likely just be one shot. So we'll get just so many vast improvements from this initial first wave that I think that a significant amount of the investment has already been spent.
Emily, one final quick question for me. This is a sector that is known for its M&A. Does M&A make a significant return next year? Who is most likely to be doing that M&A, and how are they going to pay for it?
Yeah, I mean, I think that we do have some companies in our coverage universe that have laid out some M&A capital. Recently, Sanofi bought Principia back in August. There were some much larger transactions on the U.S. side with Gilead buying Immunomedics and Bristol Myers buying Myocardia. But M&A is obviously central to the development strategy of the larger pharma companies. And so I would expect that, particularly given the most of our companies do have clean balance sheets and are always in need of pipeline assets. So I would think that M&A will be a significant part of the pharma story in 2021, given that more of the U.S. companies acted on that this year. So perhaps more from Europe next year.
Emily, we're going to leave it there. Great to see you. Thanks for joining us. Really appreciate your analysis. Emily Field of Barclays. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Let's check in on the Bloomberg First Word News now. I'm Ritika Gupta. Senate Republicans are trying to push through the president's controversial nominee for the Federal Reserve Board of Governors, Judy Shelton. Now a third Republican has said he opposes the nomination, Lamar Alexander of Tennessee. That means approval could depend on whether all Republican senators who support Shelton show up for a possible vote. A procedural vote is set for today. The UK and European Union could reach a post-Brexit trading deal as soon as Monday. Bloomberg has learned the two sides are edging closer to agreement on the biggest sticking points. The urgency is ramping up, with Britain's departure from the EU single market on December the 31st fast approaching. Without an agreement, millions of consumers will face the return of quotas and tariffs for the first time in a generation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy?
Ritika, thank you very much indeed. Bit of breaking news when it comes to Saudi Aramco. The company needs to issue some bonds to pay for its dividend, and we're just getting some details in terms of the size and scope of that. Saudi Aramco setting the size of its dollar bond offering at $7.5 billion. That's not insignificant, is it? Right, in about an hour, Fed Chair Jerome Powell will be speaking at the Bay Area Council Hall of Fame Awards ceremony. Joining us now, Mike McKee, Bloomberg International Economics and Policy Correspondent. Mike, this was a late addition to the schedule. What are people expecting?
Well, it's not so much expecting, Guy, as maybe hoping. There's been a lot of talk about whether the Fed would take action in December to add some additional stimulus to the economy to the extent that it can, since it doesn't look like we're going to get anything in terms of the congressional type of fiscal help that people had hoped for. And we got some bad economic data today with the retail sales numbers. Now, Powell is speaking at this awards ceremony, and he's being asked questions. So it's possible he could say something that would lead people to believe that they could add to the weighted average maturity of their holdings. In other words, buy more stuff at the long end, trying to bring down the longer ends interest rates, 10 years and et cetera. So we'll keep an eye on that, Guy.
I'll take it from here. Mike, thanks very much. Really appreciate it. Looking forward to that at 1 o'clock. Bloomberg's Michael McKee. That wraps it up for me and Guy here in New York and London. Coming up in New York, you got Frank Luntz, Luntz Global Partners CEO, will be joining Balance of Power with David Weston on Bloomberg Television and Radio. Let's get a quick check in here on the markets. It's a whole lot of nothing. You get the Bank of America Fund Manager Survey saying that they're all full bull market. A lot of good news priced in. Even the NASDAQ has a hard time holding up here, down by 0.2%. This is Bloomberg.